Sudarshan, thanks a lot for that update from the FNO side. We'll keep an eye out on all of these cues. Time for a short break here on Power Breakfast. Up next, we get you important updates on Infosys that faces the demand from the DGGI and the Karnataka state authorities for tax evasion. Stay tuned, back on the other side. Back with us here on Power Breakfast. Now, Infosys is facing a demand from the DGGI and the Karnataka state GST authorities for tax evasion for the period from July of 2017 to 2021-22. Now, Timsy is joining us on the phone line to tell us more on this story. Timsy, good morning. What are you picking up?
Well, that's right. DGGI Bangalore zone claims Infosys for tax evasion of about 32,403.46 crore rupees. Bangalore zone has issued an incident report to Infosys on 30th July. And as per the claims, the company has received services from overseas branches and has not paid IGST under the reverse charge mechanism on import of services. The DGGI Bangalore zone, in a detailed two-pager incident report, has actually said that overseas branches have supplied services to the company and same shall be treated as import of services by the company as per Section 211 of the IGST Act. And to implement the on-site project-related work, the company has set up branch offices outside India for the purpose of carrying out business, and thus, hence, overseas branches would be treated as distinct person. In lieu of receipt of these services from overseas branches, the company has paid consideration to these branch offices from the overseas branch expenses, and thus all of this comes under as part of evasion. And this is the modus that they have claimed, on which the claim worth amount 32,403 crore rupees has been arrived. Meanwhile, reacting to the DGGI claims, Infosys in a statement actually said, and they said, we would like to clarify on this matter. And I quote, Karnataka state authorities have issued a pre-show cause notice for payment of GST of 32,403 crores for the period July 2017 to March 2022 towards expenses incurred by overseas branch offices of Infosys Limited. Subsequent to the publication of the news articles, the company has also received a pre-show cause notice from DGGI on the same matter, and the company is in the process of responding to the same. They also say that the company believes that they have actually cleared all the dues and there are nothing that is unpaid on their side. So let's see whether DGGI gets a satisfactory response or not and how this matter proceeds further.
Timsy, thanks a lot for that update. We'll keep an eye out on Infosys through the day. Time for a short break here on Power Breakfast. Up next, we'll get to the latest on the landslides in Kerala's Wayanad. Stay tuned, back on the other side.
I would like to humbly state this. I'm sure all the members know that in a budget speech, if a state is not named, it doesn't mean that no money goes to them. And therefore, that was a misleading campaign, which, being in the opposition, unfortunately, a lot of members did speak about. It pains me to know. That they could say that if you're not mentioned in the budget speech, your state gets nothing at all. I'm picking up on the budget speeches since 2004-5, 5-6, 6-7, 2007-8, and so on, sir. 2004-5 budget did not take the name of 17 states. I like to ask the UPA government members at that time, did money not go to those 17 states? Did they stop it? Then if they stopped it, they have every business to ask this question. I presume they didn't stop money going to those 17 states because they didn't name it. So when it is one thing for them, it's all right. When the same thing happens somewhere else, no, it's not all right, you've deceived. 17 states were not named in 2004-5. 18 states were not named in 2005-6. 13 states were not named in 2006-7. 16 states were not named in 2007-8. Money didn't go to them. 2008-9, 13 states were not named. 2009-10, 26 states were not named. 26, which means only 2. Sir, oh yes, sir, if we are being blamed that only 2 states were named and the other states are not getting anything, 2009-10 budget had only 2 states, Bihar and Uttar Pradesh, and no other state. What does that mean then? It's all right when you do it. You didn't give money to those states which you didn't name. So, sir, you can't have it both the ways. You do one thing and then you blame the same thing on somebody else. What happens to the states which were not named? I'm asking now, 2009-10, 26 states of India did not have a mention. 2009-10, the full budget, 20 states. Interim budget did not have 26. The full regular budget, 20 states did not have it. So what does that mean, sir? They continue to ignore states. 2010.
Welcome back. The death toll in the landslides in Kerala's Wayanad district has crossed 167. Now, Kerala's chief minister has confirmed that over 1,000 people were rescued from the landslide affected sites and as many as 8,000 people have been shifted to relief camps in the past 2 days. Now, according to the district administration, 96 bodies were identified and post-mortems of 166 were completed. The leader of opposition, Rahul Gandhi and Priyanka Gandhi, are expected to visit the landslide affected areas later today. Day 5 of the Olympics was a good run for Team India, with shuttlers Lakshya Sen, HS Pranoy and PV Sindhu moving on to the next round of the pre-quarters, while boxers Lavlina Borgohain grabbed a win on her debut bout and is one fight away from a medal. Now, Deepika Kumari, representing India in archery, also moved to the next round, while table tennis stars Manika Batra and Srija Akula have been knocked out of the round of 16. Now, today, the men's hockey team will go up against Belgium, and in badminton, Chirag Shetty and Satvik Sairaj will play doubles against the Malaysian team, and PV Sindhu will also be playing the singles in the round of 16. And that's all we have on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call takes the action forward.
15 states were ignored. 2011-12, 15 states were ignored, they didn't mention. 12-13, 16 states were ignored. 13-14, 10 states were ignored. So, sir, for that matter, the interim budget of 2014-15 ignored 26 states. Was there a noise? Did people say you ignored those states, you didn't give money?
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details, and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are coming to you live as always from the CNBC TV 18 Motilal Oswal studios, and I think today will be the day when we will say that the Nifty's crossed past 25,000 in a clean, nice way. Not this point, this much left, or 30 points left, 20 points left. 3 days now the market's been biding time ahead of the Fed event. That's done now, and as the GIFT Nifty is indicating, it's going to be a good start. I'm Prashant. With me, my colleagues Nigel and Surabhi is with us today. Guys, hi, morning.
Hi, good morning, guys. I like your confidence. I mean, don't want to spoil the party. Asia is down, but yeah.
You know, I remember on closing, it was the day before yesterday, you guys were taking bets. I'll take a bet today.
Today okay, fine.
It's much more certain.
It's a safer bet, right? He's playing the odds well.
Well, and we've got plenty of cues, right? The Fed didn't disappoint overnight. You've got plenty of result reactions, and then you've got that tax notice on Infosys. So we've got an action-packed day ahead. And it's Nifty weekly expiry as well. So, Prashant, let's kick start.
Oh, absolutely. And definition of hands full.
Absolutely.
And how. Well, let's just quickly sort of rewind the clock back and take you to what the Fed did, because I think that's the big mover this morning for Asia, for India, for, so much else as well. So you had the Fed Chair Powell now basically confirming the Fed is closer to rate cuts if data cooperates. That's point number one. Essentially, the gist of all of it, the press conference, the statement, the Q&A, everything is essentially that they're closer now. And the important thing is that all of the commentary essentially suggests that the bar for a September cut is not very high. They're not fixated on one point, on the data being this or that. It's a process, as Chair Powell in the Q&A sort of addressed many times. The market's base case as a result has moved to a 25 basis point cut in September. That's the base case which the market is building in. But if you look at, what the market pricing is indicating, last night after the Fed meeting and everything, it moved up to 30 basis points for September. So that is, essentially that suggests that maybe it's, some are saying 50. Could it be 50? Well, let's not go that far. 25 is the base case. And the market's now kind of very anchored towards the fact that we will get 25 in September. Remember, they're still data dependent. And in that sense, the job market data tomorrow, Friday, is going to be important. The monthly number, the NFP, which we get. US equities responded. So Nasdaq was up 2.6%. There were earnings to boot as well. I'll get to that in just a bit. But the S&P was up about 1.5%. Yields across the board, the 5, 10, 30, everything came off very sharply between 11 and 15 basis points. The 10-year on the US was down 11 to 4, just about 4% now. So, it could be 3 point something from 4.5, 4.6, not very far away. That's a big change. And of course, the dollar index is below the 104 levels, around the 104 levels as well. So dollar is also weaker. Now, after the New York close, you had Meta, which reported earnings, and the earnings beat expectations. It's one of the so-called Magnificent Seven, and the market is watching the signaling impact from this very closely. Remember, so far what we had from Microsoft and early last week has not been all that great, Google, etc. but Meta beat. There was also Qualcomm, which gave a bullish forecast. And I think this is adding to optimism that maybe what we saw overnight will continue this morning and into US later as well. Oil prices, I mean, they'd sort of fallen one way, 8% or so till day before yesterday over the last 1 month. But there was this geopolitical premium, especially in the Middle East. So there was a 3% pop. I think we're back above 80-ish, $80.5 a barrel. The impact, the implication from a Fed cut. I mean, it's not as if Fed hikes have hurt markets, global markets. Fed has hiked interest rates by 500 basis points. But the US market is at a record high. The Indian market is at a record high. And global markets have done very well. But for emerging market perspective, what matters from a Fed perspective is essentially flows, foreign flows, which have been hard to come by lately. Last 3 days, FIs have been sellers and the market has struggled. And the sort of idea is if that starts to turn, you essentially get one more support apart from domestic liquidity. So circling back to specific levels on the way up, as I've said, the resistance for the Nifty essentially is 25,000 to 25,337. Focus on the upper end of that band. That's the extension level, 25,340 or so. Supports come in at the 40 hourly average, which is 24,780 is the nearest support. And of course, 24,530 is the 20-day moving average. Bank Nifty needs to take out the recent high, which was 52,340. We're very close to that level. And on the way down, Monday's low, this week, Monday's low of 51,186 will be an important level, which the Bank Nifty must sort of defend if there is any selling, any hesitation which starts to appear. And I'll just leave you with the GIFT Nifty, which I think is indicating that 25,000 par level with 60-65 point gap up this morning. Surabhi.
All right, Prashant, absolutely. So I guess the biggest positive cue is coming from the Fed, right? Yeah. But we do have headwinds around our neighborhood and here back at home. So I have to put that on the table as well. For the Fed, I just thought we'll put out the line from the statement and also Mr. Powell's press conference, because very rarely do you have any Fed chief coming out and actually giving a month as to when the cuts will happen. So just for reference, the statement is up. So the FOMC statement said that in recent months, there has been some further progress towards the committee's 2% inflation objective. That was the wording in the statement. But in the press conference is when the market got the real kicker, because that's where Mr. Powell himself said that if that test is met, meaning if data continues to suggest that inflation is going down, if that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. Not usual to get a specific timing, a specific month from any Fed chief, but that's what we got, and the market was rejoicing. The US yields, by the way, in the tumble overnight, they've gone back to levels last seen in February. In February, early Feb, is when the US 10-year had started its upward trajectory, crossing 4%. The other, of course, headwind is oil. Brent is closer to 81 again, given everything that's happening. It's almost like it's out of a movie, but it's not a movie, it's reality, with the killing of this Hamas leader, that too in Tehran. So lots of geopolitics at play over there. So let's watch for that. The other global headwind is actually coming in from the way Asian markets are reacting. There's no sweeping rally across Asia. The Japanese market is down 3%. That's at the headline index level, the Nikkei. The Topix is down almost 4%. So that market's sort of reeling under its own issues with the Bank of Japan cut coming in yesterday. The yen has crossed 150 to the dollar. Huge weakness in the Japanese currency. So those are some of the Asian cues to keep on board. A lot of regional markets like Hong Kong, even Singapore, they're all down. For us, talking about the fund flows, Prashant mentioned that FIIs, they've been net sellers for a while. That continued yesterday. Sold off stocks worth about 3,500 crores in the market. Good news, as usual, is that domestic institutions are buying. Their buying was almost offsetting the FII selling at 3,300 odd crores. Results, of course, our team is going to tell you more, but it's been a sort of a mixed picture after market hours. Just to give you a flavor, Nigel tells us that Tata Steel was more or less in line. Bank of Baroda has been a bit of a mixed bag. The asset quality is improved because they've sold off a lot of bad loans. The margins, however, are under pressure. So let's see how the street reacts to that. Then you've got some strong earnings. GE, T&D would be the one I'd watch for. Very, very strong top-down beat coming in over there. It's a very heavy results day today as well. The names are on your screen. ITC, Tata Motors, Sun Pharma. Lots of interesting large mid-caps like Thermax, Imami, as well as Zomato. So we have our hands full. And as if we needed more, there's the big Infosys news to react to as well. So the news is that the company has received notices from two separate entities. At the state level, it's the Karnataka State GST Authority, and at the central level, It is the Director General of GST Intelligence. The demand is 32,403 crores. The company is outright denying it, saying that it's already met all its obligations. We'll talk about that in more detail in just a bit. But this maybe is going to be a bit of a dampener on that stock, at least for the day. Let's see if it has a ripple effect across the sector. But it's a big one, and that's a big number. So it's something that can't be ignored.
Well, that's right. The positive overnight cues, that's what's going to help the Nifty get to around the 25,000 odd mark. But the question is, can we stay above that level, that 25,000 odd mark? So we'll know later on in the trading session. The second point is Infosys. That big tax notice has come in there. But will the markets choose to look through that and, in fact, buy the dip? And, from a market perspective, I think that dip could get bought into. So let's see how that goes, because that's going to be a bit of a drag in today's trading session. Just to start off first. By the way, today is the start of August, and historically, August has been quite a good month. If we look at the last 5 August, well, it's been more green than red, though the last one was a bit of a downer. So August normally throws up a 2.5% to 3% move. Let's see which side we go for this time around. Global cues are positive, as I said. 2 indicators. One is the dollar index is weaker, and the yield as well. The US 10-year yield was softer because of the more dovish than hawkish cues coming in from the Fed. Let's focus on Infosys then. And Infosys is going to be a large weight that's going to be lower. It's part of the top 5 weighted stocks on the Nifty itself. So, you'll have to see some kind of support coming in from the others, or Infosys itself will have to see some bit of recovery from the lows of the day. Infosys, the weightage on the Nifty is close to around 6.1% or thereabouts. So they'll be keeping an eye on the others as well. ITC comes out with its set of numbers, but Infosys, 6% will start off a little bit low. So let's see what kind of buying we see on that one. Positioning on index futures, the FIs, they remain net long. Clients remain net short with close to around 60,000 contracts on the short side. It hasn't moved much. That's why I haven't given you the change overnight. What about the options data? Today's weekly expiry and 2 strikes were fairly active. The 25,050 call and the 24,900 put. So just plugging in those premiums out there, you'll get the broad range. On the upside, 25,050. I've been saying this from the start of the week, that's a bit of a resistance level. And because of the options data, that's the vicinity that we're looking at. On the downside, support comes in at around the 24,800. For today, the 24,850 mark becomes rather important. The Nifty Bank, that's going to be the mover for broader direction and, from here on, because it's pat in the middle of the 20 and the 50 DMA. Which side it moves, which side it breaks to, that's going to be important. For the time being, it's pat in the middle out there. The 20 DMA a little bit away, while support is at the 50 DMA. The stock I'm looking at is Tata Steel. The numbers were actually showed a bit of an improvement. The problem is that, they're waiting for a Supreme Court verdict with regard to whether or not the states can go ahead and levy taxes retrospectively. So that's going to be important, and that could weigh on the stock. So though the numbers are important, I think the street takes note of the debt in the books as well as the crucial verdict that's awaited. So that could be a stock of the day.
You never get away from taxes, right? Company level, personal level, taxes are a reality, and they, hold the key to our happiness or unhappiness, whichever way it might be. Let's move on. Get to some money market views for the morning. We have Parul Mittal Sinha of Standard Chartered Bank, who says that the USD INR continues to trade in a narrow range, with local banks accumulating FX reserves at a consistent pace in the 83.40 to 83.60 range. She says local banks absorbed all the month-end FPI flows, while oil import demand led to a gradual rupee depreciation. She continues to expect the pair to trade in a range of 83.55 to 83.90 in the week ahead.
Well, she also weighs in on the bond market. She says that India rates moved lower as draft LCR guidelines released by the RBI has led to expectations of incremental bond buying by the bank. She says RBI has also released circular notifying new 14-year and 30-year bonds as non-fully accessible route securities, that is non-FAR securities, thus limiting the FPI participation in future 14 and 30-year bond issuances, which led to steepening of the bond yield curve. 10-year yield this week is going to take cues from global rates and expected to trade between 6.85 and 7% in the near term. All right, well, let's just get you some global perspective now. Robert Sokin is with us. He's global economist at Citi. Robert, great to have you with us here. Thank you very much for your time. So what has the Fed meet done for markets incrementally? Has it raised confidence that we will get that 25 basis point cut in September? And not just that, that this is perhaps going to be the beginning of a rate cutting cycle? Is there greater confidence after what we heard from Fed Chair last night?
Absolutely. And thanks so much for having me. I think what's always important with these Fed meetings is you get a lot of information about how the Fed is viewing the economy and how the Fed is viewing market pricing. And what we heard from Chair Powell, in my view, is that he and the rest of the committee are really setting the stage to cut in September. And I would be very surprised, given his tone today and the improvement that we've seen so far on inflation, if they were not to cut rates once we get to that meeting. So I think that was one very important takeaway. I think another important takeaway is that Powell emphasized that they are focusing on both sides of their mandate. They've seen enough progress on the inflation front to feel that they're getting close to being able to ease policy, but they're also starting to get a little bit concerned about some of the softening they've seen in some of the indicators on the activity and labor market side. The economy has held up well, but the risks of a slowdown, I think, have risen as rates have been higher. So I think that's the other important takeaway, which, putting both of those together, I think really does pave the way for the start of an easing cycle once you get to September. Now, it's going to depend on how resilient the economy is and how much inflation improves from here. But I think you're going to get one cut in September and then maybe one or two more cuts this year. And then next year is going to depend on how resilient the economy is and the inflation developments.
Okay. Robert, hi, good morning. So typically when the Fed cuts, everybody parties, right? Now, the party's been on for a while in anticipation of this September cut. So what's your sense? And the bond market is rejoicing. We saw the 10-year yield fall to about 4%. Stocks are anyway rallying. Even gold has been moving higher for other reasons as well. So what's the sense? If the cuts start coming in now, then are we looking at elevated asset price levels?
Yeah, I think for these other assets as well, it's going to depend on how resilient the economy is. So in some sense, it's going to depend on why the Fed is cutting rates. Right now, I think what you're seeing priced into markets and what the broader consensus is that we are getting some type of a soft landing scenario. Now, as I mentioned, there are some risks that the economy could slow down more, but broadly speaking, the economy has held up well and inflation has continued to improve. So I think that is a very positive environment for equities. And I think you're seeing that priced into markets. So if the Fed enters a cutting cycle and the economy is resilient, that's kind of the best of both worlds for risk. Now, if the Fed starts to cut and the economy slows down more and they have to cut because a recession is ensuing, that's a very different outcome. To me right now, the data are feeling more like a soft landing. Our house-based case is that you will get a sharper slowdown in activity. But I think most market participants, I think what you're seeing priced in the markets, is more of that soft landing flavor, which would be very positive, as noted, for risk.
Hi, Robert. Morning, and thanks for joining in. Well, you've told us in the past that from the equity markets, India stands out, and that was the preference out there as well. I wanted your reading on what the Bank of Japan did. They've slowed their bond buying program, and also they went ahead and they cut rates. Implications of this: for the time being, the Nikkei is down close to around 3% odd. That was showing signs of coming back. I think it returned to those levels we saw, say, 30, 40 years ago or so. But view on that market as well as implications.
Yeah, absolutely. And, this was a difficult central bank to call because what you have seen in Japan is you've seen inflation pressures hold up or pick up relative, of course, to where they were pre-pandemic. So, there has been hope that Japan will be able to sustainably hit its inflation target. At the same time, the currency in Japan was feeling enormous pressure, and at times you saw very weak currency levels. And so the question became, was Japanese policy going to respond to the weakness in the currency, or were they going to keep rates relatively low for longer to kind of help ensure that they end up hitting that 2% inflation target? And I think what you ended up seeing was that the Bank of Japan was concerned about some of these currency pressures and felt, given how high the Fed has been throughout this year, that it was time to start raising rates as well. Now, if the Fed had cut rates earlier this year, that would have taken pressure off the Bank of Japan to raise rates because I think the currency wouldn't be as weak as it has been. So I think you're seeing the Bank of Japan not only respond to what's been going on in its own economy, but what's been happening with Fed policy as well. And I think more rate hikes are coming from Japan, given what we've seen come out of that meeting. So very interesting dynamics, not just in the US, but what we're seeing with global monetary policy.
Robert, good talking to you. We live in interesting times. Let's see how this plays out. Thank you very much for joining in and for the perspective today. Thanks. We'll take a break on that note, come back on the other side. Lots of stocks to look at, including plenty of earnings. Back with our top 10 list in just a bit.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube.
Welcome back. Well, as promised, let's get straight to our top 10 segment. The entire research team is standing by within all the list of stocks. Ruby, you go first. Tell us about Infosys and that tax notice that's come in.
Oh, it's a big one. Actually, it's 2 notices, Nigel, so very quickly. And the company has acknowledged this in an exchange filing. Now, there's a Karnataka State GST Authority which has issued a pre-show cause notice. The value is 32,403 crores. Then there is also a pre-show cause notice from the Director General of GST Intelligence, which is a center level authority. We don't know the exact quantum, whether this is the same demand by both authorities or different demands, but I'm just stating what the company has acknowledged publicly. The company obviously is refuting these charges, and Infosys goes on to say that as per regulations, GST is not applicable on these expenses. It's also saying that in addition, there are other circulars from the GST Council which clarify that services provided by overseas branches. This is all about GST demands being made on Infosys' overseas branches. But Infosys says that these services are not subject to GST as per prevailing regulation. And also GST payments are eligible for credit or refund under the export of IT services. So Infosys says it's already in total compliance and it has paid all GST dues. Now, this is a big matter. Let's see how this rests. The ADR was down about 2%, so it is a bit of an overhang. Let's see if the rest of the IT sector can sort of put this aside and let this just rest at a tax demand level. But we need to watch for this.
Okay, all right. We'll keep an eye out on Infosys. Then I'm keeping an eye out on Tata Steel. Actually, the numbers were better than what we were working with. The absolute number, the EBITDA as well as the margins. they came a little bit better than our poll. Why was that? Because the India business, that showed some kind of improvement in comparison to what we were working with. And if you have to say at around 13,700 rupees, well, it's more or less in line with what we were working with. So that's about the India business. Europe, well, that was a pleasant surprise because the losses in Europe actually were less than what we were working with. Netherlands has turned around. It was giving losses for the last few quarters. That turned around, and that was the key reason why, in fact, Europe on the whole did do well, though UK business continues to struggle. So that's about the positive news. The net debt has moved up marginally because they have incurred a capex of roughly around 3,800 crores. Or in working capital as well could have got stretched out there. At around 82,000 crores, it's mounting over there. But the problem, I think, is going to be there's a Supreme Court final judgment that's awaited. And, that's post the Supreme Court verdict last week that states can go ahead and, put some taxes on some of these mining companies. And they put out a contingent liability of around 17,000 crores on a retrospective basis. So if this is applicable, then that's a big hit to the stock. For the time being, it'll be a bit of an overhang. And in the next 10 days odd, we'll get the official verdict coming from Supreme Court. If it is, if it is something that comes through, then the stock could pull back close to around 8 to around 10% going by that amount. So we'll keep an eye out. For the time being, expect this to weigh, and that's why going with the red.
So there's one number, 32,400 crores Infosys, and 17,300 crores Tata Steel. Big numbers over there. Let's move on. Bank of Baroda came out with numbers. Abhishek, how do they look?
Well, the headline numbers looked a bit weaker than our poll. However, the internals were pretty good. Take a look at the international net interest margin. It is at all-time high, while the slippages are lower than what analysts fear. So, the overall net interest margin was at 3.18% when compared to 3.27% in the previous quarter. The international net interest margin was at 2.23% versus 1.95% in the previous quarter, and this 2.23% is at all-time high for the bank. The ROE is at 8-quarter low of 17.45% when compared to 20% in the same quarter last year. However, slippages have come in at 3,018 crore versus 3,200 crore in the previous quarter. Analysts were working with a number of 4,200 crores, so slippages are below analyst estimate. Asset quality continued to improve. Gross NP ratio at 2.88% is perhaps the lowest that you are seeing in last 9 or 10 years. In terms of the poll, the PNL is slightly below our poll, 11,600 on NII. We are working with a number of 11,640 crores, and the PAT has come in at 4,458 crores. We are working with a number of 4,517 crores. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Going to Coal India then. In fact, we'll have the management of Bank of Baroda who will be joining in later today. So stay tuned for that conversation at 10:15 a.m. Now, let's talk about Coal India. Well, those numbers look better, though we're not comparing it with the poll because they've changed in the way they account for the stripping activity. So that's why we're not comparing it to the poll. But otherwise, the numbers look quite good. Top line, there was a mild growth. That's on expected lines. The EBITDA number grew by close to around 6%. So that told you that there was margin improvement. Even in the base year, they've regrouped the stripping activity. So that's why, in fact, we're comparing it on a like-to-like basis. How did this happen? Well, the employee cost did come in lower. In the base quarter, there was some kind of provisioning. It was relatively higher. So because the employee cost came lower, that's what's helped them as well. And also the stripping activity, well, that's a credit out there of around 2,400 crores that compares, 2,800 crores that compares with 2,400 crores odd. The profit after tax, more or less in line with what the street was working with. They have not given the breakup between e-auction as well as the FSA sales, but the blended realizations was in line at around 1,670. Given the kind of power demand as well as the coal demand that we have, going with green because these numbers are more or less in line or a little better than what the street was working with.
All right, thanks very much for that. Let's move on to Phoenix Mills now. Sonal is here with details on this one. Sonal, morning.
Good morning, Prashant. Well, for quarter one Phoenix Mills, a lot of new malls also got operationalized, and that's why that is something that contributed to consumption numbers this time around. Revenues were up 12% on a YY basis. EBITDA was up 8%. Margins came down 200 basis points on a YY basis, but profits were up 7% as well. So it's a single-digit growth that we have seen on the profits, but the mall business did well, while the hospitality business did see some decline. Consumption was up 25%. Retail rental income was up 31%. EBITDA was up 31% as well, aided by new malls. However, in the hospitality business, for revenue, St. Regis saw a decline of 2%. Courtyard by Marriott saw a decline of 19%. But going forward, because of all the festive season, they expect strong growth coming forward.
Okay, Sonal, thanks for that. Well, I'm looking at two cement companies then from the mid-sized cement names. First up is Nuvoco. Out there, the numbers were weak, but I think they had indicated that the first half of the year will be weakish. That's why the street was prepared for that. On the top line, the degrowth of 6%, sales volumes as well down by close to around 4%. That's indicating they're losing market share, right? Because the industry is growing on the whole, so that's a little bit disappointing. The EBITDA number as well did come in lower by close to around 12%, which meant margins are now down to around 13%. They're gaining though on the power and fuel costs because they've been focusing out there on reducing the cost aspect, and they're saying going ahead as well, they'll continue focusing out there. And that's why, we did see that the power and fuel costs came down by close to around 17%. The debt in their books though is high, which is denting the profitability. But going with green out here, because the numbers are absolutely in line with what the street was working with, it has valuation support. You're talking about 25 million tons at around $80 per ton. So that's the reason why some kind of support, even if it opens up in the red, you expect some kind of buying. Well, on JK Lakshmi Cement, the numbers were disappointing actually, and they missed street estimates by quite a margin. 8% degrowth on the sales volumes front, and revenues down by close to 11%. So telling you that realizations as well took a hit of close to around 3%. EBITDA number, well, that came a little bit higher, but it's coming on a low base. On a sequential basis, the margins have contracted by more than 350 basis points. How did they gain? Well, the power and fuel cost as well was lower, and the employee cost was low as well. But these numbers go down as a miss. However, what could support them is they've been, they have 75% stake in Udaipur Cement, and now they're talking about a merger between the two. So as is, it was under one company, but now merging it, there'll be some synergy benefits, though they've not quantified that. The ratio is in favor of JK Lakshmi Cement in comparison to Udaipur Cement. Going with red because these numbers were rather disappointing.
Okay, got that. More numbers. Vamakshi is joining in. A bunch of more mid-caps. So Vamakshi, let's start with the good. GET&D, right?
Well, absolutely a good set of numbers coming in from GET&D. It's a beat as far as some limited analyst expectations are concerned. Revenue came in at 958 crores. This is an uptick of almost 34%, but it has come in nearly 8% higher than what the street was expecting. Given that revenue has grown by 34% and the cost of goods sold has actually increased by only 17%, the gross margin has expanded by 861 basis points. Resultantly, we're seeing a very sharp uptick in the EBITDA from 7.1% to 19%, and this too has come in nearly 924 basis points higher than the street expectations. Net profit has also surged multifold to 134.54 crores. Order booking, on the other hand, was a bit muted. Order booking was up only 2%, but the tide seems to have turned for the company because in the month of July alone, they managed to book orders worth almost 1,300 crores. So that indicates that there could be some better ordering momentum in the second quarter. So overall, going with the green for GET&D. KRBL, on the other hand, has reported a rather weak set of numbers. Revenue saw a downtick of almost 15.2%, and this decline is largely being led by a 54% fall in exports. Domestic revenue, on the other hand, was up nearly 9.5%. The gross margins were impacted by lower exports and higher increase in input costs, and resultantly, gross margin slipped by 564 basis points. EBITDA margin also down at almost 9.78%, and net profit came in nearly 55% lower. So going with the red for KRBL. But lastly, let's also focus in on Aster DM. The stock is expected to open higher today, and that is because the company has reported the highest ever revenue for the India business at 1,002 crores, and this is an uptick of almost 19%. This is being supported by ARPOB, which was up nearly 12%, and occupancy at 67%. Margins have improved. The net profit of almost 5,145 crores is what the company has reported as compared to net profit of 5 crores. And this is mainly on account of an exceptional inflow of 5,148 crores on the sale of the Gulf business in Q1. So overall, going with a green for Aster DM as well.
Okay, all right, Vamakshi, thank you very much for that. So lots and lots of stocks on our radar, many of them on the back of earnings. But there is Infosys, which has, of course, everything to do with tax and not earnings. In fact, let's go back to that story and try and understand the issues at play. Abhishek Rastogi, founder Rastogi Chambers, is here to give us some perspective on this. Abhishek, good to have you on. Good morning. So it's clear that there are two different authorities that have issued these demand notices at the state level and the center level. I straight away want to come to Infosys's response and try and understand, how you see it in terms of merit. Infosys is quoting a circular that came out in June, apparently, 26th of June, 2024. That's not too long back, just about a month ago. And apparently that circular, which came out from CBIC, says that services provided by the overseas branches to an Indian entity are not subject to GST. Your thoughts?
I think, first of all, whether these two authorities could issue me summons or notices for one issue? The answer is no. One authority must, conduct these proceedings. That is very clear in terms of law. The problem today is that the import and the exports, which must ideally be treated as mirror images, the export of services very categorically provides for distinct persons, and it says that the service provider and the service receiver should not be merely a distinct establishment, must not be an establishment of a distinct person. Now, this element is absent from import of services. Now, what tax authorities are ideally saying is that when these imports happen, even from a branch situated outside of India, it must be taxable in India, which is ideally should not be the case, because when these services are imported from my own branch, these are services which I am rendering to myself, and the service is not rendered from one person to another. So there is a technical distinction between the way these wordings are there for import and for export of services, because of which there is this huge debate. The predominant question which comes is whether these are services rendered to myself, and that will be the key to see whether these should be taxable or not. Now, coming on to the circular which you mentioned, that circular has clarified with respect to transactions between the branches, but unfortunately that circular is not for import of services. That circular 210 is more or less from the perspective of what must be the invoicing, etc. requirements when the transactions is between the branches, and these branches are situated in India.
Okay, so you're saying that, I mean, from everything that you say, that there seems to be enough evidence that's supporting Infosys's argument, because it boils down to whether the import of services is happening to myself, my own entity, or to another entity. Abhishek, how do you expect this to play out? From what you say, this sounds like it's going down the legal route. So what would the next logical steps be? And in these cases, typically, do companies, do they need to make a provision for the demand in question, which is a large sum here?
I think that's a very fine question. They will have to create some sort of a provision. And why I say that is because whosoever wins at the initial stage, the matter will go up. It also appears that, if the amount is so huge, it may not go through the normal appellate provisions. Infosys may opt to file the writ petition and go straight to the High Court, because otherwise, through the appellate mechanism, they will have to shell out 10% plus 20% to file appeals at different levels. So I think it's going to go to the High Court straight away, and the court may or may not give may not give stay in the very beginning in the first hearing, and hence there will be some need of a provision to be made.
Okay. All right. Unfortunately, we're a little short on time, but we will have you back. This requires, of course, some more nuanced discussion. But thank you. That's helpful. An immediate heads up on how this may proceed. Perhaps a provision will have to be made, as that one expert points out. But Nigel, lots of earnings. Let's focus on Crompton now.
Well, that's right. Let's focus on Crompton. Well, the company's quarter-one performance was in line with expectations. We're joined by Mr. Arunachalam, the Chief Financial Officer at Crompton, to discuss the past quarter's numbers. Hi, sir. Morning, and thanks a lot for joining in. Well, overall, quarter one was in line with what the street was working with, mainly led by the strong performance in the ECD segment. What's the outlook as well as the volume growth you see for the remainder of FY25?
First and foremost, Q1 has been really good for us. This is led by our ECD portfolio, which grew at about 21%, and we continue to deliver industry-leading growth now for fourth quarter in succession. This is on the back of our Crompton 2.0 strategy that we launched about 4 quarters back, where we said the idea is to focus behind our brand, drive consumer-led innovation, and ensure that our go-to-market strategies are optimal, which would enable us to deliver better performances on a consecutive basis. Now, as we speak, this quarter has been one more quarter where we have delivered about strong double-digit revenue growths. We have grew our profits close to 40% PBT on a standalone basis and about 30% on consolidated basis. We see this growth to be broad-based. This is across categories in ECD. Lighting, which was one business where we said we will be arresting the decline and we will be getting back to growth, is on track. lighting business is also back to growth. Butterfly, where we have started taking corrective actions, we are seeing early positive signs in terms of moving towards a profitable business, considering the losses that we had in Q4. Overall, the summer impact was also pretty positive for our business in Q1. And as you know, when we launched Crompton 2.0, the underlying strategy was to deliver a business that focuses on growth and absolute profits than profitability. We continue to stand by that. We expect this year to also in line with that, where we would deliver strong double-digit growth and deliver our EBITDA growth, which is better than the sales growth. The trajectory seems to be moving in the right direction.
Strong summer has led to robust growth, sir, in fans, air coolers, leading to higher growth in ECD revenues. How do you see demand from here on? Can fans touch double-digit growth?
See, fans as a portfolio, there are opportunities both on the product side and on the channel. So now let me start with the product opportunities. As you would know, we are the largest player globally in fans. Last year, we sold about 2 crore fans, and that is a base on which we have entered into FY25, and we have got a pretty good Q1 to start with on that. This is now further divided between our premium induction business, non-premium induction business, and there is BLDC. Now, our focus on premium fans is largely led by the new product launches that we have done over the last 2 to 3 quarters. Is helping us to penetrate better and drive market share in our premium category. Similarly, in our BLDC segment, we have launched an array of bottoms-up, grounds-up built products as compared to a product portfolio that could have been assigned to what we have already in induction and convert into BLDC, but we did a grounds-up strategy. So significant amount of new products have been launched in BLDC, which has helped us to make a reasonable progress on the BLDC market as overall on the fan segment. Now, insofar as the mass premium business is concerned, or the mass business of fans category is concerned, we do see channel opportunities here. As much as we have very, very high market share in some parts of the country, we do see there is still penetration opportunity available in other areas. Now, this being on one side, we also see premiumization playing a big role. That should help us to drive fans value growth significantly better than the volume growth. Now, apart from this, there are also government initiatives that are helping us in a big way. One, starting with the entire PM Awas Yojana scheme, where new households are built in and where our appliances portfolio can have penetration opportunity. Rural electrification is also helping us in a very strong manner. Our rural and MFI portfolio has seen strong double-digit growths now quarter after quarter. On that go-to-market strategy with the other incentives coming from the government in terms of PM Awas Yojana schemes, etc., should also help us to drive that business.
All right, let's focus on Butterfly's performance, which was rather bleak, right? You had margins that were lower, revenues as well was lower because of channel restructuring. What's the revival we see from here on margins for the remainder of this year? Can EBITDA margins touch double digits in the second half of this fiscal?
Yeah, see, what we said in terms of Butterfly performance is we will start improving the business sequentially. If you have looked at our Q4 performance and compared that to Q1, we have improved both on revenue and bottom line. The business delivered a negative EBITDA in Q4. From there, we have moved down to a 5% positive EBITDA in Q1. The price actions that we need to take and the channel corrections that we need to take is ongoing. We expect that to get completed in H2. H1, we should be able to complete the entire pricing and channel action that we have to complete in Butterfly. As we enter H2, we should start seeing the business get back on the track of growth, start delivering about 7 to 8% EBITDA, and then improve from there onwards.
Okay, we wish you all the best of luck. Thank you very much for joining in and running us through your estimation of the business going forward. Thanks indeed. We take a break. We are back. There's 20 minutes to go for the pre-open session, but there's so much to discuss. So Deepan Mehta will be talking about specific stocks that he thinks should be on the move one way or the other. That's coming up in just a bit.
access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Welcome back. Deepan Mehta, Director at Elixir Equities, is with us. Deepan, good to have you on. So much to talk about. Where do we start? Let's actually start with Infosys, this whole business of the GST demand notice. Do you think the market will be able to keep this aside, separate matter? It'll probably go in court. Or can it become an overhang on the stock and, more importantly, others? Because this is about services that any overseas branch is providing to the parent company here in India.
Good morning, Surabhi, and thank you for having me on your show. I think no amount of bad news is denting the market at all. So this also will be completely absorbed and the street will move on. In the past also, when such large tax notices have come, it's hardly made any effect on the sentiment of the stock or its stock price performance. So I don't think it's going to make much of a difference. But yes, it does bring to light the risks of doing business in India. And all this talk about, making business easier, one needs to review in light of such notices. And this is not the only notice which has come. So many companies have been flooded with GST notices of such ridiculously high amounts that one really wonders, whether these are completely justified. And then end of the day, where the accountability, post such issue of a notice, actually what happened and how was the notice actually resulted in how much revenue for the government. So it's a disappointment, but it's not going to have any effect on the stock price.
It's going to be buffeted on the other side by strong earnings, right? I mean, Infi numbers were good, and there is this tech rally overnight as well. Nasdaq was up 3%. So if you're looking at day on day, these things kind of become a little relevant. Deepan, out of the earnings, and we got a thick earnings docket as always. What's catching your eye?
See, I think that, the company you discussed, Crompton Greaves, just before I came on the show, very interesting company and reasonable valuations, pretty well managed. And there's an opportunity in this acquisition which they have made. I firmly believe that local acquisitions play out really well. And this Butterfly Gandhimati is a strong brand. It just requires more management input and it will turn around solidly and eventually they will merge it. There's no doubt about that. They may not keep it separate. So I think that the revival has started for this entire appliance industry. And you can see it across the board in Havells, in V-Guard, in Bajaj Electricals, that the growth has come back after 2-3 years or so. And typically this cycle should last for 2-3 more years. So I'm very confident of that company. Other than that, by and large, results have been in line. I thought I would be disappointed on many fronts, but it is pretty fine. Companies like Varun Beverages, I thought Larsen and Toubro came with exceptionally good set of numbers. Another company which comes to mind, which we perhaps missed out on, was the Zaggle Prepaid. Exceptionally good set of numbers, company worth watching, and we are looking for putting on our watch list as well. So there have been a few positives and hardly any major negatives, except when it comes to steel and cement.
Okay, all right. Morning, Deepan, and good to see you went well. And you've been quite cautious on steel as well as cement. But I wanted your view on two names. One is Coal India, actually, where the numbers look quite good. And we know there's a tailwind out there because more thermal capacities will come on stream and it has monopoly here in India. So the view on Coal India and Tata Steel as well, besides the numbers, that tax overhang is something that will weigh on the stock because the Supreme Court has now said that state governments can go ahead and levy a tax as well. And they have said that the contingent liability that they provided for is around 17,000 crores odd. So view on both these two stocks.
Yeah. See, Nigel, I did not know about the 17,000 crores liability. That really is a bit of a challenge. But on the whole, we are not great fans of steel and cement per se. So I would always advise remaining underweight on these companies. Although Lloyd Metal, I thought, is a company worth watching. And that's a pure play, rather mostly pure play iron ore company with exceptional location. And they demonstrate very good execution capability. And I think reasonably valued, and they're doubling their capacity to get the output higher. So within that entire commodity space, I think as a special situation, that company is worth watching. But, it's a dicey business, as one knows. Secondly, about Tata Steel specifically, the results were pretty decent, but on the whole, as I said, steel demand is not as strong as it is perceived to be. Same is true for cement as well. So it's best to kind of, just remain underweight on these counters.
Deepan, I know you like LIC. And yesterday, Gadkari ji wrote to the finance minister saying GST, there should be no GST, and stocks responded, no GST on insurance products. Of course, I mean, it's a demand. Stocks reacted, stocks like HDFC Life and etc. There's, by the way, a call from Bernstein as well on insurance, which came out post-market hours. So just I wanted your thoughts there. And second, BSE, which you know very well, also went up 7-8% yesterday. So quick views.
So I think BSE went up because in recent action which was taken by SEBI will perhaps do damage more to NSE than BSE. That's the kind of report that I have got. And on the whole, I think BSE is on a recovery mode. The weekly options have picked up. And there are two camps, one which says that it won't make much of an impact on the volumes. In fact, volumes will go up because contracts as have gone up. And one camp which says that definitely volumes are going to be impacted. So we'll come to know the truth in a few months' time or so when actually the kind of changes are implemented. But I'll tell you one thing that with markets the way they are, I doubt that such changes by SEBI are going to affect the volumes in the market, and it'll just more and more money will come to the market through the options trading because of higher margins. That is point number one. So I don't think it's going to have that much of an impact.
Insurance, yeah.
Yeah, insurance, I think LIC is more a play on rising stock market valuations and the kind of impact it will have on the enterprise value that I don't think is completely discounted.
Got it. Deepan, snappy conversation today. Thank you very much for your time. Appreciate it. We'll take a break. Mitesh and Sudarshan are going to be with us with technical trading ideas. Stay tuned.
Way to celebrate our own 25th year. with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Till about 6 months to a year ago, BSE didn't have any volumes at all in the F&O segment, and the only reason they came up was A, introduction of weekly expiries, and two, putting an expiry on a different day in the market. Now, NSE has had the most successful F&O contracts for the last many years, and these are Bank Nifty and Nifty. And asking NSE to choose between the Nifty and the Bank Nifty, obviously, when they use the word benchmark, it's very, very obvious that it has to be the Nifty.
Welcome back. Well, let's get our technical expert Mitesh Thakur, who joins us on the show. Hi, Mitesh. Good morning. Finally, 25,000 is going to be there. You know, we have been asking for the last few days, so that'll be a good start. But what are the levels you're tracking on the Nifty, as well as run us through your stock picks?
Good morning, guys. So today will be a gap up opening. I think with this gap up, as you also highlighted, the level of 25,000 will be cleared. So therefore, it will be important that the gap doesn't get filled. So with that gap as the stop loss, I think assuming that the gap will not be filled, I would look at targets in the range of about 25,400, 450 to about 25,500. So that 25,400, 500 zone is what I think the next level where the index could head to. The key in this entire situation would be Bank Nifty. I've been highlighting that the underperformance of the Bank Nifty has been hurting Nifty's upward march, and that remains a big concern. If the Bank Nifty can get past 51,850, then I think trading continuation on the upside to about 52,250 to 52,300 could happen, and that could add the spice to the Nifty. So post the opening, the first view should be on the Bank Nifty. Let's see if Bank Nifty can get past 51,850. That should signal continuation.
Your trades, Mitesh?
Yeah. So I have all buy calls. L&T is a buy with a stop at 37.80 for targets of 3900. Maruti, I believe with the numbers, the stock might open gap up. So I've taken a slightly, a bigger target on the upside. 13,800 is the trading target, and the stop loss should be below 13,000. Also buy on Bajaj Auto with a stop at 9,600 for targets of 9,800, and DLF is the final buy call with a disclaimer that I have some options positions over here, so there is vested interest. But in the short term, DLF appears to have completed its entire correction of the last about 12-13 weeks, and now is getting into an up move again. So buy here with a stop at 874 for targets of 920 to about 925.
All right. We'll take a quick break here. Mitesh, thanks for those. We're going to come back. Sudarshan also should be with us with more ideas. Stay tuned.
Till about 6 months to a year ago, BSE didn't have any volumes at all in the F&O segment, and the only reason they came up was A, introduction of weekly expiries, and two, putting an expiry on a different day in the market. Now, NSE has had the most successful F&O contracts for the last many years, and these are Bank Nifty and Nifty. And asking NSE to choose between the Nifty and the Bank Nifty, obviously, when they use the word benchmark, it's very, very obvious that it has to be the Nifty and not the Bank Nifty. I think would be a big, big blow to the NSE in choosing. Rather than that, I would have probably gone back to the system of each exchange can choose one expiry day per week so that all the contracts expire on that day in the week. We were opposing this. I think this is a very retrograde move. Rather than asking exchanges to choose a contract, we could have simply said you can have one expiry day for all your weekly contracts, which means that if I have 100 rupees of capital, I can't go on using it for different contracts on different days. I can't rotate it on expiry days every day of the week. If all expiries, let's say assuming it's on Thursday, then I have to decide between if I want to do the Bank Nifty or the Nifty. And that would have at least allowed these indices to be liquid or reasonably liquid and still exist.
On the Map My India notice, see, we have put out a public statement that we will definitely respond to it publicly, and we think it is very opportunistic of them, and Ola Electric is not even in the maps business. You know, we are a group, we have 3 different entities in the group.
Welcome back. We also have Sudarshan with us now, so let's quickly get those technical calls going. Sudarshan, we've all been wondering when that 25,000 milestone is going to happen. Do you think it can happen today? And of course, trading calls and ideas for the day as well, please.
Yeah, good morning. But I think it should happen today. And the problem is not just 25,000. The problem is that for most traders and say active participants, that question keeps coming up, how much further? And really, we don't have to answer that question. The market trend is up. We want to buy every dip and stay long till the market tells us it's no longer possible. That message hasn't come. So for today also, the trading idea is buy this small dip whenever it comes. I'm upbeat on the Bank Nifty. The Bank Nifty had a very narrow range yesterday. Given the fact that the market trend is up, we could see a breakout on the upside. So trading should be considered for both the indices. Now we have the trading calls. Aditya Birla Capital is a buy with a stop under 212. Cummins is a buying opportunity. The stock has had a fantastic rally and that continues. Buy with a stop under 35.57. Havells is a buy with a stop under 17.41. And Muthoot Finance, slowly I think finance companies are coming into play, is a buy with a stop under 17.21. Stay long. Don't make the mistake of doing anything else.
Don't doubt the market, don't doubt yourself. Screen will tell you if something is changing, as Sudarshan puts it. That's good advice. Sudarshan, just 2 names. Infosys, the pre-open is kicking off. The 2 news-related names from a price action perspective, Infi and Tata Steel, if you want to just look at those quickly.
Sure. See, I'm not upbeat on Infi. We've seen a very handsome rally in Infi, and I don't think trading idea, there is any trade there. So I can keep aside Infi. Tata Steel is a buying opportunity. Any dip you see in the market is a buy.
Tata Steel is a buy. Got it. All right, Sudarshan, thanks very much for that. Let's also get some F&O trades in. We have Chandan Taparia joining in from Motilal Oswal Financial Services. Good morning, Chandan. What stocks are you trading today? Or index, for that matter?
Good morning, Surbhi Prasad. Thanks for having me. So finally, it's time for Nifty to hit a new milestone of 25,000 marks. We have seen that index has been making higher tops, higher bottom on the weekly and the monthly scale, and also forming higher highs, higher lows from last 4 trading sessions. Supports are gradually shifting higher, and we believe that till it holds about 24,750, the bullish stance could continue to take the index towards 25,250 to 25,500 levels. So continue to be with bullish stance till the immediate support is not broken in the market. Looking at the data internal, the India VIX is at comfortable zone. Put call ratio has been moving upwards. So falling volatility with rising put call ratio indicate that bulls are dominating the market. So till the key supports are held, the bullish stance could continue. Now looking at the Bank Nifty index, here we have seen some underperformance. Bank Nifty has been moving in a narrow range. Technically, it formed a narrow range 3 price pattern. But multiple supports are also visible at 51,000. So we believe that 51,000 to 52,000 would be the range for the banking index. Now looking at the stock wise, first there is buy on Maruti. Nifty Auto Index itself has given a fresh breakout after the consolidative move of last couple of weeks. Maruti, which was earlier finding multiple hurdle near 13,000 marks, has given a decisive close above the same. We believe build-up of long position with coal unwinding could support the stock to continue the next leg of rally. So recommending to buy on Maruti with support of 12,800. And here we are expecting a run up towards 13,650 marks. Second trading idea, that is buy on Tata Power. The stock has seen the positive weekly setup and follow-up is clearly visible in this week. We have seen a decisive breakout above 445 zone, which earlier used to be a hurdle. So now hold of 445 can extend the move to 478 to 480 zone in Tata Power. Third idea, that is buy on Lupin. We have positive on the most of the Nifty Pharma stocks, and most of the stocks are doing well, including Lupin, Syngene, Granules, Sun Pharma. And we believe that Lupin could do well. It has been making higher top, higher bottom on the daily, weekly chart. Supports are gradually shifting higher. We have seen positive rollover data as well with build-up of long position. So recommending to buy on Lupin with support of 1880. And this stock has potential to rally towards 2,000 plus zone.
Okay, all right, Chandan. Wishing you a good day and a good weekly expiry as well ahead. Thanks a lot for joining in. Let's focus on the next management, Greenply Industries. That's the one in focus. Mr. Manoj Tulsian, the MD and CEO of the company, joins us on the show. Hi, Mr. Tulsian. Good morning and always good to speak to you. But let's focus on the largest part of your business, the plywood business. I think earlier you were guiding for around 8 to 10% volume growth in that business, with margins headed towards double digits. Do you hold on to that guidance?
Morning, Nigel, once again. And, it's always a pleasure to talk to you and be on the show. Yes, as I said last time also, in the long run, for sure, we can move to double digit. But in the near run, there are a lot of headwinds, which is there. The raw material prices continues to move upward. And that has put a lot of pressure in terms of, passing on to the market. But this year, most of the plywood manufacturers have again increased the price. So we have also taken a price increase in Q1, but that was in June. So the effect of the same would be visible in Q2 and onwards. And if needed, looks like we might have to take another price increase in the next quarter.
Okay, all right. But don't you think that will impact the volume? Or do you think that demand is strong enough that even with the price hike you've taken and the other price hike that you're looking at, you can still do 8 to 10% at least? Demand strong enough?
See, last year there was a lot of resilience, and you will see most of the plywood players have actually not taken any price increase. But if you see from last year, from April to this year, April, May, the timber prices have almost gone up by 20%. So whatever we could have done, or most of the players in the plywood industry could have done, internally have done. And now everyone understands that this, this pass on is very much important. So I think this is an industry-wide thing which is happening. So, ultimately the consumers will accept the same. In terms of volume, 8% volume growth basis, what we have done in the past is something which is very much doable. In good times, we can actually do better also. But 8 to 10% is something which is sustainable.
Okay. Mr. Tulsian, good morning. The blockbuster performance was in the MDF segment for you in the quarter gone by. So two things. One, how's pricing looking? Will you consider price increases there as well in the current quarter? Is there need for it? And second, I think you're guiding for 16% margins here for the full year.
So Prashant, if you really see, we have already done more than 16% margin in Q1. Last quarter, we were at around 12% odd. So we have improved significantly. In terms of further improvement in margin is something which is will be determined by the industry. We did a lot of improvement in the operating efficiencies, which we have been speaking last year, because last year was our first year. So this year we knew that as the plant stabilizes, there will be a lot of operating efficiencies which will play internally in terms of the production side. Those are the things which is now benefiting us in terms of taking the margin to 16% plus. We are very confident that this 16% plus in the given environment without any price increase or something is doable and possible. If the industry players, like I said in plywood, if in MDF also the industry players looks at price increase, then possibly we'll have an incremental improvement in the margin also.
The 16% is a given, you're saying, Mr. Tulsian. Got it. Just to go back to plywood for a bit, you're saying that the inflation in timber prices was as much as 20%. How much is the price hike you've already done this year? And what is the additional price hike you are hoping to take? Because I think guidance is that you'll hit double-digit margins in the plywood segment. So are you on track for that? What's the quantum of the price hike you'll need to do?
No, Surbi, just a small correction. I think what the guidance from my side was that 10% in plywood business is a doable margin.
Right.
But this year, in my initial guidance, we had spoken about 8 to 10% volume growth, and margins may or may not expand during this year. Okay, because I knew that during this year, the timber prices either will stabilize at the current level or it may further go up. So, there is a pressure on plywood business in terms of taking the price increase. Coming back to your next question, last quarter, we have taken almost a price increase of around 1.5 to 2%. If needed, we might take another hike of 2% in quarter 3.
All right, we'll leave it there, sir. Thank you very much for your time. Quick conversation, but punchy stuff and good sort of guidance. Stock ended 10% higher after, of course, the earnings beat. And the markets, of course, liking what they've heard. Nifty is set to open above 25,000 levels. That's essentially news which is coming through. And 25,031, so clean break above 25. 3 days now the market's been, dithering. It's been ranged, and now the Fed event behind and a bit of a lift from overnight markets, etc. as well. Dollar is lower, yields are down, Nasdaq is up. So that's the reaction. Just a quick word in the pre-open in terms of how Infi is settled. I think we should look at it because of the large tax demand. It's flat, absolutely flat. And this is what we were talking about earlier as well, that uncertainty. I mean, the demand is large, but it's not. We've seen these large tax demands come through. I mean, they've hurt for a while for some, and it's sort of completely been looked. And people have looked through some of the others, looked through these things for some other companies as well. So in the case of Infosys, the backdrop otherwise is positive, but that Nasdaq rally and the numbers which were pretty strong. So flattish, slightly negative. Maybe that we'll see how it goes. The other one is Tata Steel. We should look at as well. Again, tax-related issue. And we should see what the pre-open is doing, 1 3/4%. So it's turning out to be that kind of a day where markets just wants to look ahead, rather not look ahead, but look up. Sudarshan is back with us with 9-10 calls and just a quick view on what the pre-open is looking like. Sudarshan, what do you have?
Well, the view is that you stay long and buy on dips. Aditya Birla Capital is a buying opportunity with a stop under 212.
Midesh, what about you?
I'll go with a buy on L&T for targets of 3,900.
Okay, L&T for a target of 3,900. Well, let's revisit some of the stocks which are likely to be in action in the cement and steel space. Tata Steel and JK Lakshmi Cement. Nigel, over to you.
Well, let's look at Tata Steel first. The street is looking at the operational performance, and for the time being, they believe maybe the worst case with regard to the pending Supreme Court verdict will not play out, and that explains why the stock has moved higher. The numbers, well, they were better than expected. The EBITDA number was better. If you look at the India operations, well, we were working with a number of around 13,600 rupees per ton, and it was more or less in line. So India business, no worries on that front. Yes, it contracted on a year-on-year as well as sequential basis, but that was on expected lines. There was a positive surprise coming in from the European business. We were factoring in that they will report a negative EBITDA per ton of around $36 per ton. It came in at a negative $28 per ton, and now the street will be hoping that gradually they'll start moving to the green. How is this possible? Europe has two parts, Netherlands as well as UK. Netherlands moved into the green because the blast furnace realignment or refurbishment has already been done. So that's what helped them out. While UK continues to struggle, and that could be the case for the coming few quarters as well. What's the overhang on the stock then? The debt moves up. It's moved up, close to around 82,000 crores odd because they incurred capex of around 3,800 crores. And they're looking at, working on green steel in the UK business. So that's what could keep the debt elevated. Even in the India business, they have an ambitious capex plan that's underway. The problem is there is this Supreme Court verdict overhang, and for now they've put in a contingent liability of around 17,000 crores. If that is actually implied, and it's on a retrospective basis, that's the quantum of the hit. So that's a question mark for now. It'll be a bit of an overhang till we get further clarity on that front. For the time being, the stock is reacting to the numbers and maybe what the Fed did overnight as well. Metals did pretty well. Moving to JK Lakshmi Cement, we told you that the numbers were disappointing. But they've also gone ahead and announced that one of their subsidiaries, which is Udaipur Cement, where they have 75% capacity stake, that gets merged into JK Lakshmi Cement. So for the time being, well, it's actually going by the ratio. It's positive for JK Lakshmi, not positive for Udaipur Cement. And that's why Udaipur Cement in pre-open is down 10%. JK Lakshmi is reacting to its numbers, so it's down close to around 0.5% odd. Both the stocks a little bit subdued. This was in the offing, and it's finally been announced.
Okay, so that becomes important to look at as well in terms of the reorganization within the company. Got it, Nigel. Thanks for that. Over to Nimesh. There are some interesting contradictory notes that have come today on Indus Tower. There's a bull and a bear in the market. Nimesh, fill us in.
Yes, sir. It's an interesting argument, both bull side as well as on the bear side, as far as Indus Tower is concerned. Remember, the stock has been a big outperformer of this calendar year. Now, for the bull case, CLSA has further raised the target price on Indus Tower to 533 versus 450 earlier. They believe that Q1 was pretty much in line or slightly above estimate, both in terms of revenue, EBITDA, as well as PAT as well. They are forecasting a 10 to 15% EBITDA and PAT CAGR over the next 3 years. And they believe that the network expansion, including the Vodafone's expansion, will supplement further growth as far as Indus Tower is concerned. On the bear side, Kotak has to downgrade the stock to sell now on rich valuations. They believe that the core performance was slightly weaker than the street estimates. And further, the expansion from Vodafone as well as network expansion, while it's positive materially for Indus Tower, but it's mostly in the price after the big run-up, and hence a downgrade to a sell now. Even Macquarie, I've not added to the graphics, but even Macquarie today has put out an underperform rating with a target price of 280. So, there is a both case argument, bull versus bear, as far as Indus Tower is concerned.
Okay, all right, we'll watch out for that stock as well. Let's see who prevails. Thanks, Nimesh, for that. Over to Vamakshi. Remember, BHEL came out with a pretty disappointing performance yesterday. Losses at the EBITDA level, losses at the PAT level continuing. Vamakshi, what's the latest?
Well, absolutely. There's a note that has come in from CLSA. They've reiterated an underperform rating on this counter, target price of 189, which implies a downside of almost 40% from the current market price. Yes, it was another operationally weak quarter for BHEL. In fact, they reported another quarter of loss. Gross margin fell to a 7-year low, and the order inflow declined by 39%. They have several large gestation orders, especially on the thermal part, which may take time to execute. The company has significantly outperformed the Nifty on inclusion in passive indices and follow-on buying, but the stock remains quite expensive at 55 times FY26 PE. So given that, CLSA has reiterated an underperform rating. But Morgan Stanley has maintained an equal weight call. They've given a target price of 220, which actually implies a downside of almost 30%.
All right. Vamakshi, thank you very much for that. So there is a lot to track, and the market is going to be at 25,000. The word goes. So that's the first thing I think we get done in that sense, right? I mean, waiting for it for the last 3 sessions, the market's kind of treaded water, not really given us that, but I think we'll have that today. So on your screens, the first rates coming up, and we'll then sort of focus on individual stocks because there's earnings reactions and all those tax issues, etc. So 25,000 plus on the Nifty is what you have, and we are at a fresh all-time high, of course, and a important psychological level has been crossed for the market. So that is the big number which is flashing on the screen, and so many milestones over the last 2 years. I mean, milestone after milestone, and it's coming in fast as we've kind of highlighted for a while now. So last year we left off at I think what, about 22,000, and this year we're at 25,000. So, and this is just half a year done. That's the ferocity of the move that we've seen. The best performing market in 2024, one of the best performing markets in 2023, the best performing market in 2022. I could go on and on, but it's a big one this morning. The Sensex is up about 81,940. You got the Bank Nifty, which is starting about 0.4% higher as well. But we've got lots of stocks to track, so let's get to it.
When the Nifty hit 24,000, it was the 27th of June, just a month back. Nigel and I missed it because instead of watching the shares, we were watching the shares in the jungles. But that's on a lighter note. Here we are, both of us here this morning as 25,000, another milestone conquered by the bulls as they continue to charge down the streets. A big morning today coming through. Okay, stocks. Maruti is still continuing its great form from yesterday after the good numbers coming through. A lot of metal names are looking good. Hindalco, JSW Steel, 2.5% higher. Coal India's numbers are being very well received by the market. There's also ONGC. So basically, a lot of commodities in the mix looking good this morning. Tata Motors will be reporting numbers today. That stocks are very well poised in anticipation of a decent show. Bajaj Auto came out with the monthly sales numbers. The numbers look good. Stocks up about 1.5%. Tata Steel is also reacting positively. Despite that hangover of a potential tax demand, a large one, 17,000 crores. For now, the stock is sticking to numbers and reacting about 1% on the upside. The Bank Nifty is not playing too much of a spoil sport today. That's good news for the bulls. So a lot of names like SBI, IndusInd Bank on the upside as we start off with. Let's look at the downside. Now, even on Infosys, the reaction is about 1% lower. Let's see how this tax demand plays out. That stock's down, but it hasn't taken down the rest of the pack with it. Infosys is the only one that's negative. M&M is still looking at profit-taking after the numbers. And Hero Moto is the other one. That's down about 1.5%. But a good morning, 25,040 on the screen.
Well, it can't be a subdued celebration. 25,000, guys. You know, that's something that we have been looking forward to. And 25,000 it is. We talk about the Nifty moving to 1 lakh odd. At least we are happy to be here at around 25,000 on the Nifty. So a fourth of that journey is what's been completed in terms of the Nifty. And big moves today. You know, Maruti, that's driving away up 3.5%. Tata Steel, well, that's opened up in the green, but actually it's underperforming the metal pack. You have Vedanta that's up, Hindustan Copper that's corrected from more than 400 rupees to around 310 rupees. People stop talking about that, actually, the entire big copper rally that we saw. Stock is corrected 25% from the recent peak, but today as well, that's participating in the up move. And since crude prices popped up, you have ONGC as well as Oil India. Both of them are doing very well in trade. So metals as well as oil and gas stocks, well, they are doing well in trade. We had some news flow coming in on Amara Raja in pre-open, I think. So that stock, in fact, is up close to around 2%. Vedanta is moving ahead with that demerger plan. The street likes it, so that stock is doing quite well. Birlasoft yesterday was under pressure. Today as well is down close to 100%. The numbers very disappointing. We get to the chat with the management in a bit. And Siemens as well. Siemens down close to around 2% odd. But 25,000, guys, we're waiting for this mark. And here it is. Thursday morning, weekly expiry day on the Nifty. The Nifty says, let's party. We like what the Fed said.
You know, I was just looking at the past numbers, 2000 and the horrible COVID year, right? I mean, we left off at 14,000. So, you know, you just sort of, you can reminisce and you can look at where you were and what prices were. And but that's what markets have done. They've belied all, or rather beaten all expectations. Even the most optimistic expectations, they continue to move higher. And it's not just, you should not look at this in isolation. The fact is that, you know, at least for the last 3 years now, and maybe 2024 as well, the way it's panning out so far, we've kind of outperformed every other market. So that is quite something, I mean, which stands out. Mangalam is going to also just join us in a bit to run us through some more. Let's get Krishna Sangvi in, CIO Equities at Mahindra Manu Life Investment Management. Krishna, good to have you with us here. Thanks very much. 100-point gain on the Nifty, past 25,000. First thoughts? Krishna, you're on mute. You'll have to unmute yourself, please.
Sorry, yeah. Thanks for having us. I think 25,000 is a good milestone, broadly, you know, in line with everything, economy stroke, you know, market momentum in place. You know, some of these milestones are good to have, and hopefully we'll have, you know, many more such. But I think the broad connect is simple. Economy is doing reasonably okay, long-term track in place. And yeah, currently the market mood is slightly more driven by liquidity and sentiments. And that's something we need to be slightly, you know, more watchful in terms of, you know, the sentiment and the momentum part of it.
Okay. By the way, I just want to point out that the move on Maruti is absolutely breathtaking. It was up about 4% in the dying moments of trade yesterday, and it's putting on another 3.5-4% on that performance that's come through. Strong margin improvement and beating estimates. It's really the star even today. There are other movers and shakers. Look at 361 WAM. Yesterday we were talking about SEBI looking at pulling up the F&O segment and putting more cups. Look at the broker stocks go. That stock's up about 7-8% on the higher side. So lots of movers on the mid-cap screen.
I think that's earnings came, and so that's more wealth management focused. And you know, Novama, 361, and you know, those of the wealth management stocks have done very well. But Mangalam is here to map the journey to 25,000. Mangalam, take it away.
What a moment this is, right? Nifty at 25,000, and if you just take a look at
Nifty's journey itself, Prashant, for an index that started way back in 1996, April 1, 1996 is where, the Nifty started.
Mangalam,
I think, yeah, you'll have to...
Sorry. Mangalam is here. I can assure you. You heard him. You'll see him as well in just a bit from now. Krishna, just to sort of come back to you, Surabhi was talking about the wealth management names. So you've got to look at if it's logical. If India is going to get richer, market caps are going to go higher, wealth management and specialized services on the financial side, I mean, that's going to be needed. I just wanted your thoughts on this aspect. Could this be a secular story, notwithstanding intermittent falls, etc., which are to be expected in the market? These are at the end of the day market-dependent businesses, but from a longer view, how are they looking, even from a valuation point of view?
Yeah. No, sure. I think from an economy side, clearly India is one of the fastest growing nominal GDP economy. Nominal GDP creates income, and people have income to save because once the consumption needs are met. So I think that macro story of wealth creation is in place through the capital marketplace. Challenge can be possibly valuation, but honestly, some of these valuation concerns are can be diluted only by taking a longer term view, and that's where some things may be useful to say, okay, the macro story is in place and some of these businesses will benefit. But yeah, currently I think broadly the way broad market itself is slightly richly valued. I think some of these companies by default run a risk of earnings in case the market does correct, and because this business is not only the multiples but even the earnings are linked to markets.
Okay, got that, Krishna. Coming back to you, let's map those milestones with Mangalam. He's here. Mangalam.
Well, it's one of those where were you when the Nifty hit a certain level sort of moments, right? And 25,000, no mean feat. And it's poetic that it happens in the 25th year of CNBC TV 18 itself. For an index that started on April 1, 1996 with a base of 1,000, had moved to 5,000 in 2007, then took 10 years to move to 10,000. Remember clearly there was confetti in the CNBC TV 18 office when the Nifty hit that 10,000 mark. But after 15, 20 and 25,000 itself. So while this journey has been long, the important part is that over the last many years since inception, the Nifty has compounded at 12.1%. What does this mean? Every 6 years, this index has doubled. So that's one of the bigger stories. The other story is that while Nifty itself has compounded at 12% since inception, in the last 23 years, Nifty earnings also has compounded at 12% itself. So the Nifty journey is tracking the EPS journey. And at 25,000, the index trades at around 22 times FY25 price to earnings. So that's something we'll have to watch out for too. The last time it hit a big milestone, 20,000, was in September 2023. And since then, it's been a public sector, realty, oil and gas and auto sort of rally, all these indices having done extremely well. The ones which have actually underperformed are the ones like IT, FMCG and, Nifty Bank. Even if you account for the recent rally that we've seen in all of that, if you look at the IT index, it's up around 26%, FMCG 19%, Nifty Bank up 13%, much lower than what the others have done as well. So let's take a look at the broader markets. Those two have done extremely well. Small cap index up 50% in the last 1 year, mid cap index up 42%. The SME IPO index is up 164%. And this is at an index level. A lot of individual stocks have been 5-10 baggers as well. In individual stocks on the Nifty, like I said, it's been about autos and the public sector enterprises. So you have Bajaj Auto doubling in the last 12 months or so. BPCL up 93%, Coal India, M&M, ONGC, all of them gaining anywhere between 80 to 90%. And then you have a bunch of other underperformers as well. Bajaj Finance down 8%, Asian Paints down 6%. HDFC Bank, the biggest weight, is actually down about 0.5% in the last 12 months or so. We're talking about the broader markets. Oil India up 200%, NBCC up 200%, Trent, Oracle, Amara Raja, all of them up around 150 to 175% as well. Here too, we have a couple of underperformers. So that's something that we'll keep an eye out on as those come up for you on your screen. A bunch of underperformers in the broader markets would include names like Z, Dalmia Bharat, Navin Fluorine, IDFC First, and PVR Inox. Now that we've hit 25,000, the big question, where do we go from here? And what are the triggers to track? The first one, will FIs return to buy in the cash markets? Secondly, with the outperformance that we've seen in the mid caps, will large caps now start to outperform mid caps? There is increasing retail participation and domestic SIPs. Will that continue? Irrespective of what, the regulators say, hefty valuations in the broader markets. So what do we do about that? And finally, the impact of geopolitics and global developments on our markets. 25,000 is here, a lot of triggers ahead.
Absolutely, Mangalam. Great perspective there, and great to map the journey as well. That really helps, that 12% compounding, both earnings and the market, they've kept pace, which is why a lot of people argue that there's no reason to start getting stressed or worried because earnings are fueling this rally. Let's go back to Krishna. Krishna, what's your sense? There's been leadership change. This rally has had very different leaders, right? The erstwhile stars, Bajaj Finance, HDFC Bank, or even leave some of the FMCG boys. They have not been the poster boys of this rally. What do you expect from here on? 25,000 onwards, say the next 5,000 point journey, who will be the stars?
Yeah, sure. So if I had to add, one more angle to this long-term compound.
Okay, by the way, Krishna, just hang on for a second because we have a very special guest who's going to be joining in. Great day for him to be coming in here as well. That is Mr. Anish Shah, Dr. Anish Shah of Mahindra & Mahindra. He is our special guest. He's, I think, coming up to the studios in the next couple of minutes. And so much to talk about, right? All the group companies at Mahindra & Mahindra. M&M doing exceedingly well, the auto segment itself, and auto tractors firing on all cylinders, the Tech Mahindra, that story to talk about. And of course, just the animal spirits within India Inc. as the market is celebrating GDP growth, corporate growth, and so much more. So that's Swati accompanying Mr. Shah, and they will be with us shortly.
Oh, absolutely. Krishna, do you own Mahindra, by the way, in the portfolio?
Well, we are Mahindra Manulab, so even as an organization, part of the...
anything
good timing then.
Anything you'd like us to ask him for you?
No, I would like to hear, more like what you're asking. No, I think let's look at that macro picture of economy, earnings, and one variable I'd like to add is even the Indian economy has broadly compounded as 12% nominal over the entire this similar journey right from the time Nifty was, let's say, 1,000 odd. So that biggest connect to economy and markets is what we just simply have to be aware. And coming to those questions about some specific stocks which may or may not have done well in this journey, I think if you look at a longer picture of this 10, 15, 20 years, one macro theme is that as long as economy keeps on doing well, each of these sectors, each of these stocks, have their own chance to participate in the profit pool accretion in the economy, because if you look at earnings profile, I think not every year every sector grows similarly, right? There is this cross current between sectors. Some sectors benefit, some are leads, some are lags. So to that extent, when we look at some of these companies or sectors which may not have done well, I think the same picture changes. Instead of September 23, had we look at maybe September 21 or maybe September 19, the numbers change. Which also brings to the picture that currently what's happening in the market really is that while the valuations are clearly favoring large caps, I think the flows and maybe the momentums are far more in favor of small caps, mid caps, maybe micro caps. I think that's a challenge right now in markets. Economy, as long as we do well, I think one should right now favor large caps as a better outperformance category, especially when it integrates the valuation. But yeah, let's not forget, in a macro journey of last 20 years, too many small caps would have become mid caps, and some of those mid caps would have become large caps also. So that's how these individual companies grow and maybe grow to higher levels of market caps and maybe wealth creation.
Our next two conversations are actually going to be on the auto sector. So let's get your sense in as well. Look at the way the market's rewarding Maruti, for instance, because those numbers were really better than expectations. But there is a school of thought that overall sales are slowing down after the post-COVID high that we had, the big numbers that we had in FY23. 24 has been a little more muted. What's your sense when you're looking at auto, and how would you play it? The stocks have done very well. The question is whether the growth will continue.
Yes, sure. I think growth continues. Maybe the only challenge can be for the market can be the growth rate. So if we are used to a very strong growth rate in FY24, maybe we're talking about something like a single digit, maybe somewhere around 4 to 7%, depending on what agencies would have reported. And maybe individual companies can grow slightly more based on their own volume growth. Maybe there's some companies had a supply constraint last year. So if those supplies are falling in place, they will grow much faster. But as a broad space, I think passenger vehicles should be more in that maybe 5-7% growth, and similarly maybe two-wheelers and CVs too. So growth can be moderated, but yeah, it's still a growth.
Okay. All right. That's the auto space. I think in the next couple of minutes, we'll be touching base with the management of Bajaj Auto as well. And we'll get a sort of, update on the numbers. By the way, the monthly sales numbers for Bajaj Auto have been looking quite good, about 11% up overall. And the domestic sales numbers are up almost 18%. So that growth is continuing. And even exports have shown a bit of an increase. I think just a 2% increase, not too much. But those numbers have been looking very, very well. So, okay. Do we have the management of Bajaj Auto with us? Okay, I think we have them. Krishna, thank you very much. Good chatting with you on the markets. The journey continues 25,000 and onwards. You have a good day. But as promised, let's take that conversation forward with the management of Bajaj Auto. We have Mr. Rakesh Sharma with us. Mr. Sharma, thanks for joining in, and congratulations. Looks like another good month, because on the domestic front, you're firing away. I think the growth is almost 18%. So let's start with the domestic business. I know so much is happening with the new CNG bike as well. How does the second half now look? Because now we'll start getting into the festive season.
Good morning. Yes, the growth numbers look very good, but they don't actually reveal the full story. July is, in any case, a very small month. There is not many degrees of freedom there because of the onset of monsoons in so many parts of the country, and people are also waiting for the festive to kick in, which starts by August and peaks, let's say, in October. But what these numbers don't reveal is the performance of the growth platforms, which we started to launch into the market in June onwards. And Freedom, the CNG bike, has not really kicked in as yet, because the deliveries have just started to happen in the last week. But some of the other things, particularly, our 250cc plus portfolio, Triumph had a really breakthrough month. As you know, it was sort of at 2,000 levels for a few months. Now it is stepped up to above 3,500. And our new launch, the NS400Z of Pulsar, that clocked almost 2,000 units. And if I add that up with our Pulsar 250s and the other 250 to 500 cc's in our portfolio, we are pushing 10,000 units in the month of July. And so that was very good. The other growth platform, of course, is the new launch in Chetak, which was, the 1 lakh, sub 1 lakh pricing new model, which has been received outstandingly well. And we are now jumped presence from about 250 odd stores to almost 2,000 stores across the country, which has increased the market share for Chetak by, a very handsome 6 percentage points. And, bookings have crossed 20,000 units. And the third one I must mention is the electric three-wheeler, which again, thanks to the widening of the network, has had an outstanding month, touching almost 4,500 unit sale and grabbing 5 percentage points of market share as per Vahan registrations in the month of July. So the overall numbers, we are happy with them, but really the new growth platforms kicking in so early gives us another good couple of months to ensure the channel is well serviced, consumer engagement is well on its way for October.
Sure. Just a word, so volume growth is absolutely kicking in. What about realizations and pricing? What do you forecast in the coming months as we get into that peak demand season? Are you looking at price hikes? And if so, across what part of the portfolio?
Well, we had taken a small price hike in 1st of July just to, it was under just about 1%, just to ensure we are in step or slightly ahead of the cost increase curve. Right now, the ups and downs on the commodity front are sort of balancing themselves out. And we are tracking both the cost increases as well as moves by competition. If it is required, we will go in for a price increase. But right now, we are in an equilibrium situation.
Okay, all right. Hi, Mr. Sharma. Good morning, and always good to see you in. Just to reconfirm, Triumph did sales of 3,500 per month, if I got that number correct?
Yes, in fact, it was over 3,500 in India. That's right.
Expecting this sort of a momentum to continue as well?
I hope so. We had put in some, an extra effort on the sales side, and sometimes, you need to just turbocharge this, and that has really worked. And we would be expecting to continue it in the same vicinity in the coming months.
Let's turn our attention a little bit to the exports then, and particularly Nigeria. As you were telling us, Nigeria got hit hard. It used to do, I think, 50,000 units, and it came down to, I think, 15,000 odd. For the past month, how was it? And do you expect exports to gradually improve from here on?
Yes, actually, that is exactly what I've been saying, that exports is not going to be a sharp increase because it's weighed down by Africa, most of the countries in Africa. I mean, to give you an idea about the slow climb back which is there, Nigeria, our retails have gone from 15,000 to 16,000, and the numbers which I got just this morning about July is 17,000. So you can see that it is agonizing slow, but at least the nose is pointing in the right direction. Whereas the other regions like Latin America, ASEAN are showing handsome growth. But when we combine Africa with all the others, then the overall growth which we see is going to be steady, but in small steps.
Okay, all right, Mr. Sharma, we wish you all the best of luck. Thank you very much for joining us. It's always a pleasure having you with us here on CNBC TV 18, and look forward to speaking with you again as sort of you continue to repair some of the sales on the export side, etc. I just want to take a quick look at the market as well. We're past 25,000, comfortably holding those levels, and we're about 100 points higher. So this is a very good-looking screen. And large caps, of course, are doing what they are. But as I've said so many times, it's the broader market which is vibrant and how. Long list, right out of the gates, long list of big volume-led gains across the board. And that is where that's why portfolios are going to sort of feel good about themselves. Greenply, we had the management with us in the morning at 9. Stocks up another 8%. It was up 10% after the results yesterday, another 8% this morning. You got Aster DM, which reported numbers. That one hospital company, 4% higher right now. IIFL, of course, I mean, stocks up 4. It's corrected quite a bit. Markets, of course, have been waiting for a final kind of go ahead, all clear from the RBI with regards to their restrictions which were imposed on the gold loan side and not securities, but IIFL Limited, the NBFC. So that's up about 4-5% as well. So that's essentially the picture, but so much more, which I will get to in just a bit from now. But right now, we're going to focus on one of the largest conglomerates in the country, Mahindra & Mahindra. And we have with us a very special guest who's with us in the studios, Anish Shah, CEO and Managing Director at Mahindra & Mahindra. Anish, great to have you with us here. Thank you very much. I dare say you're one of the most loved CEOs, especially from an investor perspective, Anish. I was looking at returns. Since you took over, stocks up 4 times. We can say markets have done well, but that is still astonishing for a company that size and what the stock has done. So congratulations. And congratulations on a superb set of results once again. I want to start with the tractor business because volumes in the June quarter were flat. They were down earlier. They were flat. You're guiding for a 5% growth for the full year FY25. Monsoon rains are good. I mean, they've gotten better. Could we be at the end of a down cycle, beginning of an up cycle? Your thoughts?
So Prashant, first, thank you for the kind words. We've done a lot of great work as a team. So I would say all the credit goes to our teams. And we've got a very strong operating rhythm. On tractors in particular, we are seeing green shoots. Clearly helped by the monsoons, but beyond that, government spending is up in rural areas. And therefore, we do believe that we should be out of the down cycle now. The second half should be fairly good as well. Navratri comes in at that point. So we're in a much better place from a tractor standpoint.
And if the down cycle is ending and an up cycle is starting, as some are pointing out, could it last? I mean, someone was saying that the up cycle usually lasts 3-4 years. I mean, it's not, It's not 1 quarter, 2 quarters, but once it starts, it continues the momentum. Is that a fair assessment?
That is what we have typically seen. So that's something we would look at as a fair assessment based on history.
Would you like to raise that guidance for 25 a little bit, just a tad bit for right now?
At this point, we feel 5% is a fair guidance.
With upside risk?
As I said yesterday in a press call, taking cues from the Fed governor and the RBI governor, we'd say there's an arrow that's pointing towards the up, but we are at 5% for now.
But at least, we're past the worst when it comes to factors, overall industry and for M&M, and the growth is going to sort of sustain and continue?
For M&M, we've seen growth very substantially, even in a flat market. A tractor market share in the first quarter was up 180 basis points, which when you're in the 40s is a fairly tough thing to achieve. So not just tractor, LCV was up 160 basis points, SCV up 130 basis points. So from an operating standpoint, we've been fairly strong.
No, absolutely. And now I want to come to the cool business, which is bread and butter and SUV. Your leadership, your dominance continues, and I think the market share has only increased even in the quarter gone by. I just want to quote a figure from one of the analysts on the street, Jeffries. Now their projections are they're expecting your auto volumes to show sustained 14 to 15% CAGR over the next 2 to 3 years. I mean, going up to FY27 with dominance. You think these are fair estimates, or do you think you're going to surpass them by a mile?
So the guidance we've given for this year is mid to high teens growth. And the first quarter was 24% growth. So you can extrapolate based on that.
So 15% CAGR next 3 years, auto business?
It seems reasonable in a sense based on the trajectory we have right now and the demand that we've seen for the models right now.
Okay, all right. Hi, Dr. Shah, and thanks a lot for coming down. Besides the shareholders, I was speaking to some of your employees as well. They as well seem quite pleased, so that's good news, I think, so when the home is happy. But let's talk a little bit more about SUV. As you said, you all have been growing quite well. I think the market share as well has been moving up. What's the rough market share that you're headed to, say in FY25 and then FY26? Because you have been guiding that you're going to outgrow the industry.
I think it depends a lot on how the industry will move. The auto industry has been relatively benign and flat for a while. Not exactly flat, but still growing at a slow pace. With India growing the way it is right now, there is a potential for an uptick there at some point in time.
All right.
Now, when is that going to happen? Your guess is as good as mine on that. So, which is what we'd have to wait and watch in terms of where we go.
All right, but SUV, I think you were at around 15%. It's moved to around 18% as of last reckoning, right?
Yes, from a revenue standpoint, which is what we look at, we are at 22% now from a revenue market share perspective.
Okay, all right. And also, if I had to focus on your margin picture, there were some price cuts that I think you took in the XUV 700 segment. But you have been changing your mix. Some part of that mix will be margin accretive as well. So from here on, will margins improve as a consolidated entity?
So we've seen a significant jump in margins in this quarter. And yes, that is a question we've been getting from a lot of our analysts as well. We are putting a lot of effort in to enhance margins. There will be positive and negative pressures to that. So for now, we're essentially saying that we will continue to maintain where we are. We will continue to see some improvements over time. But we also use that in a way to manage both growth and margins, and which is where we decided to have a price cut, because we had increased prices significantly over the last 3 years as a function of commodity price increase, as a function of concerns and issues with semiconductors. As that has eased, it was important for us to pass that benefit back to consumers as well and drive growth. So that is a combination that we will continue to look at, and which is where it's a management of both margins and growth.
On just to continue with the SUV side, for the last couple of years, we've all focused and fixated on the bookings. But the bookings number has come off a little bit. But I think that is also because waiting periods are now lower. I mean, is that the way to look at it?
Yeah, so the main thing that is capacity. Right? We've gone from 19,000 SUVs a month to 49,000 today. And at the end of this year, we will be even higher than that. So we've, at this point, got almost a 3x increase in the last 4 years. Capacity was difficult for us to put in 2 years ago because of the semiconductor issue. We actually didn't like having a long booking pipeline. It's not good for the consumer. And the cost of putting capacity is not that high in the overall scheme of things. So for us, our goal is to try and keep that booking number down as much as possible. Not new bookings, but the backlog, and therefore be able to give consumers a car as quickly as possible. So that's the reason why, yesterday we stated that, look, that's the last time we'll talk about the backlog, because we're starting to get to a point where with increased capacity, we can start meeting that backlog very well.
And this capacity is going to be good for, of course, depends on growth and underlying market dynamics, but your sense?
We still plan to increase from here. We have talked about going to 64,000 from here. So that's something that we will continue to do, because with the 5th hour coming in, we will need more capacity as well. And that's part of what will come in.
In terms of the powertrain or just the vehicle itself, right? There's ICE, there's electric, and there are a lot of electric launches happening. I know you've been quoted in the media, on hybrids. But what's the thought process? And from the company standpoint, both volume and profitability, how do you think this will play out? Because let's face it, electric vehicles are more expensive than ICE. So as those launches kick in, do you think that there could be a bit of a dent in volumes just because of the pricing element there? And I don't know, hybrids are, if they even make sense. There are some states offering incentives on it. So just in terms of technology, what are we looking at over the next 2 years in terms of the product mix, how you forecast the market?
So let's look at why EV is important. If you think about it from a government or a policy standpoint, EVs solve two major problems. One is pollution in our cities, and second is a fuel import bill. So both of these are not really addressed by hybrids as much, and which is why governments around the world have found it very difficult to provide incentives for hybrids for the last 20 years. Hybrid, again, is a powertrain. It is more expensive than ICE. The question is, are incentives required there forever if we have to move there? For EV, that's the other advantage. You may not need incentives forever. And if you take the example of electric three-wheelers, the FAME2 program was very well designed, and that created a stimulus for electric three-wheelers that has gotten to 20% penetration as an industry. And that will go to 100% in the next 5 or 6 years. So that is essentially a very successful use of incentives, because in that time frame, by 2030, we will not need any more incentives for electric three-wheelers.
What about four-wheelers? What would you like the policy to be as we get more and more, EV four-wheelers in the market, your portfolio included?
For four-wheelers, we feel the government has provided all the incentives required. With the PLI scheme that's in place, with the GST program that's in place, there is nothing further required from an incentive standpoint, right? And over time, that will come down as well as four-wheelers expand. What is essential for four-wheelers is a charging ecosystem. And that is one area where we know that the government is very focused on it. They're looking at various different ways to enhance the charging ecosystem. As that happens, we will see four-wheelers start taking off, because it starts with the product. You've got to see the product and say, I love this product. And then you start thinking of charging. And if you have the charging infrastructure behind it, then it's much easier to transition to four-wheelers.
But just coming to complete this point, to come back to that question on pricing, because EVs are priced, above ICE models. How do you expect this to play out, consumer behavior, and in terms of your own targets, in terms of growth of the M&M EV portfolio, what do you forecast this year and say next year, in the near future?
So we've got our born electric vehicles coming up starting January. And I can tell you that I'm very excited about those vehicles, and I'm looking forward to driving them. Incentives have to play that role to bridge that gap in pricing. Because if the pricing is far higher than ICE, then electric is not going to take over. So we feel that incentives have done that job, and that the pricing will not be dramatically higher than ICE. And that will help us transition to electric. And over time, the cost of electric will come down, and incentives will come down as well.
Okay, all right. Mr. Shah, what about the new launches? I think the street is looking forward to the 5-door Thar. When does that come into the market? And also, what are the rough estimates you're looking at there in terms of demand?
So August 15th is the date for the 5-door Thar. And we are very excited about it. It has come out extremely well. And in terms of numbers, we'll just have to wait and watch. We'll have to see what consumers think of this.
By the way, Surbhi was saying, moving on to the cooler business, right, for SUVs. I was thinking tractors are cool.
Of course they are.
I've always wanted to drive one, but I've never got the opportunity.
Actually, you could be looking at it, in a very, very different manner.
Anish, I just want to step back one bit, right? And I began by saying investors and markets see you as the value creator. So when you think about what next in terms of value creation from an investor point of view, one thing, it's not new, it's been sort of, you've been asked this before, is demerger. For autos and tractors separately, because the company still gets a holding company discount. Is that on the anvil? What's the internal thinking on it?
So this is a question we've faced for a few years now, and the response has always been, first we're going to focus on inherently creating value with better products, with better execution, and that's something we've done. In many ways, there should be a benefit given to companies that are together and generate synergies. Today, we've got obviously much higher margins in farm than anyone else because we've got a higher market share. But our auto margins are very well placed in the industry, even when we may not be the number one in the industry. And that's because of the synergies we have. Purchase synergies are significant. Technology, talent, there are a number of other synergies that we have. And therefore, what we're looking at right now is, can we showcase that as an advantage for the group? And we already have certain analysts talking about a conglomerate premium in our recent analyst reports. But that is really what we think we can be able to showcase.
So should I take that as at least in the immediate future, I mean, no? I mean,
not happening.
In the immediate future, no.
Right.
But at some scale, would you like to demerge both the entities?
For us, if it makes sense economically to do that, we will.
Is there a scale in mind?
It's not a question of scale. The question is there more value for it together than apart?
Okay.
Right now, you see more value together.
At this point, we see more value for it together.
Because if you look at, say, I mean, and back in the day, escorts, for example, used to, the valuation, it used to get a higher valuation compared to the implied valuation for the tractor business here. Maybe it's now closer, much closer. Maruti, Hyundai is going to be listing soon. Average P multiples of 30, 35 times. I mean, conglomerate premium, that may happen in the future, but as of now there is that discount. So that's the reason where, that's the point where I'm coming from. But you're saying we're not there yet.
We're not there yet. We are seeing that discount reduce. As I said, we've seen the first analyst report that talked about the conglomerate premium just 3 months ago. And it's coming from the fact that we're starting to show greater value in our businesses. So to me, that's a fundamental question. How can you create greater value? Is it by being together and having intrinsic value that's greater, or being separate? And if the answer is being separate, we'll look at it. But today, we don't believe that's the case.
Okay, so Anish, we've spent a lot of time speaking about auto. Allow me, as we wind up, to request you to wear your other hat as the head of Tech Mahindra as well. The reason we're bringing this up is, I know it's an issue specific to a different entity and company right now. I'm sure you've seen the headlines. Tax demand notice, a rather big sort of notice that's gone to Infosys in terms of how overseas branches need to be treated from a tax perspective. Just as you see, you've already laid out a roadmap for Tech Mahindra in terms of improving margins. Just leave us with an overview. I think the margins as of this quarter were 8.5%. How you see that trajectory play out? And indeed, if such notices start going out to some of the marquee companies, is it any reason for worry from a sector standpoint, from a tech industry standpoint?
So, two parts to that question. First, we see Tech Mahindra on a good path of recovery. This is a business where we've talked about a 3-year turnaround plan. We've outlined the plan as well. Similar in many ways to the plan we'd outlined for Mahindra Finance a year and a half ago. And Mahindra Finance is on a very good track. Now we've seen fantastic results this quarter, better asset quality, strong growth, a lot of work on the technology side. So therefore, TechM will continue well on this path. Phase 1 is to get back to the margins that we were at, which is a fairly short time frame. And then the phase 2 is to look at 500 basis point margin expansion beyond that, which again has been outlined in the plan. So we feel good about where Tech Mahindra is with the new team, with the delivery mechanism that we've put out there. And the second part to your question, look, we feel that the government has always done the right thing in terms of making it easy to do business with. So I'm sure that that is something that will end up in the right place. I don't know the details of the facts, so I can't say anything more at this point.
Got it. Anish, pleasure speaking with you. Thank you very much for taking out the time and being with us here in the studios.
Yes, in person. That really counts.
And I hope we can do this more often here. So much better. Thank you very much.
Sounds good. Thanks for having me here today.
Thank you. All right, well, that is Bossman at Mahindra & Mahindra with perspective on a variety of businesses and, of course, a overview of what the next many years may look like. Well, the market's up about 85 points. We're 25,000 plus still, so holding. We're going to take a very quick commercial break here. We'll come back and we'll have the management of Birlasoft join us on the other side to discuss their first quarter earnings. Stay tuned.
Welcome back. Let's turn our attention to the tech space. And a mid-cap company, Birlasoft, reported a disappointing set of numbers. Growth got clobbered back. But let's find out what's the way ahead from here on. We have Mr. Guha, the MD and CEO of Birlasoft, who joins us on the show. Hi, Mr. Guha. Good morning, and thanks a lot for joining in. Always good to have you on the show. Well, the past quarter was a bit of a dampener for a whole host of issues. There were deferrals. There appears some softness in discretionary spending as well. You tell us, how are things likely to shape up? And I want two numbers from you. Earlier, you were guiding for industry-leading growth, or maybe you'll outbeat the industry growth as well. Do you stick to that? Last year, I think the top line grew by close to 7%. So for this year, what's in store with this, softest start to the year? And also margins, you were guiding, I think, for around 16% on an exit basis. Are you headed in that direction?
So, Nigel, first of all, thank you for having me on the show. So, look, we admit that the first quarter was not really a great quarter for us. I mean, it was disappointing. Even for us, it was disappointing. But Nigel, you must also realize that this is on the back of almost 5 quarters of constant sequential and year-on-year growth. So we disappointed the market this quarter, but I think we will come back strong in Q2. From a margin perspective, again, because we did not deliver top-line growth, and as you know, our business is so heavy on operating leverage, the margin suffered a little bit. But I feel if the revenue growth comes back in Q2, which I think it will, you will see an improved margin.
Okay, so what are the numbers you want to give us then? Margins, a little south of 15%. Revenue, you're expecting things to grow. I'm guessing that the macro hasn't got worse for you. So growth for this year, do you stick to that industry-leading growth? And margins will see an improvement of how much? 150 basis points from year. Previous quarter, you were at 16%. So you get back to that mark?
So, Nigel, we can't give a guidance, and we don't give a guidance. Our job is to execute for the quarter. So I can't really talk for the year. But for the quarter, I can tell you Q2 will be better than Q1. That we are very confident about. As far as margins are concerned, we will see how Q2 pans out from a margin standpoint. For the year, it is difficult to give a guidance only because the Q1 was a little disappointing for us. So we will take one quarter at a time and see how the year pans out.
Mr. Guha, would you characterize the demand environment as still very, very tough?
So, Prashant, the demand environment has not really changed from the last time we spoke. I feel the demand environment is tough, but it is little cautiously optimistic from a standpoint that it probably is getting a little better. We're seeing some green shoots to begin with. But again, there are elections in the US, so we will see how that pans out. But by and large, I'm seeing demand not very different from what we saw in 4Q.
Okay, all right. And what about the total contract value? That as well did see a sharp fall. Any order closing got delayed, which explains the reason for that decline?
So, Nigel, if you look at from a year-on-year perspective, our order booking has actually gone up. We grew 10% year-on-year on order booking. Now, Q4 generally is a strong quarter because we get a lot of renewals. So quarter-on-quarter may not be the right way of looking at it. My sense is, from an order booking perspective for the year, this year will be better than last year.
Okay, this year will be better than last year. Could you talk to us a little bit about how the Microsoft business is likely to ramp up? What's the outlook there?
So that business is growing, Prashant. So we partner with Microsoft very significantly, as you know. They're a big partner. I can't give you specific numbers because we can't talk specific clients, but that is growing above the company average for sure.
Okay. Over 20% on a year-on-year basis?
Again, can't give a number, Prashant, but I can only tell you that far above the company average, double-digit growth for sure.
Okay, far above the company average, double-digit growth. Thank you very much, Mr. Guha. Thank you for joining us and running us through the numbers as you see them. No real sort of guidance with in terms of numerical numbers, but in a tough demand environment, which has not changed from the last quarter, they're saying that they're cautiously optimistic. We'll take a quick commercial break here. Prestige Estates Management joins us on the other side to talk about their numbers. Stay tuned.
Ola Electric and Ola Kritrim, and Ola Electric is not in the maps business, but there are opportunistic players across, so we will definitely respond to them at the right time.
Welcome back. Prestige Estates is the next company on our radar. For the first quarter, the company saw a decline in pre-sales and sales volume, with which collections also saw a single-digit growth. We have Mr. Irfan Razak, Chairman and MD of Prestige Group, to take us through not just the Q1 performance, but of course the outlook going forward. Mr. Razak, great to be speaking with you as always. Now, looking at the slightly quieter start to the year, how does the rest of it look? Because we're almost, virtually practically done with the second quarter, at least 2/3 of it down. So what's the visibility on sales for overall FY25?
Good morning, Nigel. Yes, quarter one was subdued only because there were not many launches, because the approvals couldn't come on time, and that's consequent to all the elections and the code of conduct that was on. But we are quite hopeful because we've got a large launch pipeline, and Q2, Q3, Q4 should do extremely well as we go along.
Sir, just a small submission. I think you're missing Nigel. This is Surabhi here, but I'll tell Nigel that you were asking about him. No, okay, fair. Okay. So let's get back to it. Just give us a sense on pricing as well. First quarter, have you managed to take some price hikes, and what's the visibility? Any more, price elasticity in the market?
Pricing, I believe, has reached a certain number, which actually, honestly, the price is a function of the cost of land and construction, and of course, the overall margin that we as developers would like to aspire to have. And we would not like to price our products too high, which would be counterproductive. I've said this before, I'm saying this again. We have to make sure that whatever pricing that we do on our product is affordable in the circumstances that are there. And I believe that we have reached a certain point where any more price increasing will not really be good for the market. And I think even now it's pretty good in terms of, depends on which location and what type of product we are able to offer at decent numbers. And I'm sure going forward also that will be the endeavor of the company.
Got it. Mr. Razak, hi, morning. I want to just talk about the budget and what is done, right, on indexation. Do you think, because there is, of course, there's no indexation, but also tax rates are lower now from 20 to 12.5, for new real estate sales, sentiment-wise, at least for the potential buyer, it actually makes things a little more attractive for new sales. A legacy, a property, etc., that's a different matter. But what does it do for new sales? Yeah.
No, I personally believe there's a lower rate of tax, 12.5% on long term. And it takes out a whole lot of question marks, a whole lot of guesswork and trying to work out the indexing and all that. So I do believe that this is a good move. And it's very easy for anybody to calculate according to the gain that they have made. And I think it's only a question of acceptance, because a 12.5% gain long term is a pretty good deal. Okay, everybody wants more. If it was 10, it would have been better. But then I think at 12.5 also, it's a good number. And I think we should accept it. And it is good for medium to long-term investors or new buyers. Of course, a very, very historical properties there'll be a marginal difference, but I always used to advise customers whenever they sold a property, even historically, I said your capital gains will be in the region to 10 to 12 or 12, 15%. Now it's at 12.5%, so I think it's pretty good.
Although I must say, we reported this yesterday, Mr. Razak, the government is reviewing representations which have been made on the indexation issue, right? There is no clarity if there will be a rollback or any changes. As they stand right now, things stand, but they are reviewing a lot of the representation, etc., which has been made. But my question was not about legacy. I mean, that's a different debate, and we go into a different realm, which we've done with tax experts, etc. But I'm asking you from a future property purchase perspective. I mean, for a potential buyer in their mind, I mean, even if they want to sell it 2 or 3 years down the line, even if they don't, the tax rate is lower now. So does that spur new sales as you see it? Your thoughts?
No, I think it'll help. You see, people are not buying today only to sell tomorrow.
Correct.
they are investing to buy a home. And
Correct.
if our investors who want to be there long term, they definitely will see that as an incentive because everybody is looking at ways and means how they can save tax and at the same time earn some money. So that's probably a trigger that people can buy some homes and then hope to sell once the product is ready. And then the gain will be 12.5%.
Okay, and that's why maybe the lack of indexation won't pinch so much. Let's see. We'll find out what investor and end user behavior is like. I think the answers will come through over the next couple of months. Mr. Razak, thank you very much for joining in. Always a pleasure speaking with you. Well, with that, we have to take a quick break. On the other side, we'll have the management of Bank of Baroda joining in to talk about their first quarter performance.
I would like to humbly state this. I'm sure all the members know that in a budget speech, if a state is not named, it doesn't mean that no money goes to them. And therefore, that was a misleading campaign, which, being in the opposition, unfortunately, a lot of members did speak about. It pains me to know. It pains me to know that they could say that if you're not mentioned in the budget speech, your state gets nothing at all. I'm picking up on the budget speeches since 2004-5, 5-6, 6-7, 2007-8, and so on, sir. 2004-5 budget did not take the name of 17 states. I like to ask the UPA government members at that time, did money not go to those 17 states? Did they stop it? Then if they stopped it, they have every business to ask this question. I presume they didn't stop money going to those 17 states because they didn't name it. So when it is one thing for them, it's all right. When the same thing happens somewhere else, no, it's not all right, you've deceived. 17 states were not named in 2004-5. 18 states were not named in 2005-6. 13 states were not named in 2006-7. 16 states were not named in 2007-8. Money didn't go to them. 2008-9, 13 states were not named. 2009-10, 26 states were not named. 26, which means only 2. Sir, oh yes, sir, if we are being blamed that only 2 states were named and the other states are not getting anything, 2009-10 budget had only 2 states, Bihar and Uttar Pradesh, and no other state. What does that mean then? It's all right when you do it. You didn't give money to those states which you didn't name. So, sir, you can't have it both the ways. You do one thing and then you blame the same thing on somebody else. What happens to the states which were not named? I'm asking now, 2009-10, 26 states of India did not have a mention. 2009-10, the full budget, 20 states. Interim budget did not have 26. The full regular budget, 20 states did not have it. So what does that mean, sir? They continue to ignore states. 2010-11, 19 states were ignored. 2011-12, 15 states were ignored, they didn't mention. 12-13, 16 states were ignored. 13-14, 10 states were ignored. So, sir, for that matter, the interim budget of 2014-15 ignored 26 states. Was there a noise? Did people say you ignored those states, you didn't give money?
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course. That is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the annual information.
Welcome back. It's earnings time. Bank of Baroda impressed with a lower NPA and hence a much lower than expected credit cost, or what you call provisioning for bad loans. But deposits and advances growth have been soft like in all other banks. Margins are hit by higher deposit costs. Joining me now is Mr. Devdutt Chand, the Managing Director and CEO of Bank of Baroda. Mr. Chand, good morning and thank you very much for sparing time for us. Well, first up, your margins have held up the same pressure that others have felt. But do you think you are going to see a higher cost of funds because of the LCR requirements?
Good morning, Lata, and thanks for inviting me. A couple of things that went for this quarter. Clearly, we wanted to realign the balance sheet in terms of the liability management. And if you look at the growth both on the advances and deposit, these are in line with the market, but we could have grown a couple of percentage higher. But we wanted to reduce the dependency on the bulk deposit.
Yes.
If you look at the cost pressure, in fact, the cost of deposit was increasing almost like 10-11 BPS quarter to quarter. And if you look at the June quarter vis-a-vis March, it is the flat level. So we have a better control on the cost of deposit now, and the outcome is that the margin is maintained. We had a full year NIM of 3.18, and this quarter again the same 3.18 we have. So I think we're in a much better position in terms of looking into giving a stronger growth from the next quarter onwards. Because not only on the margin side we have hold on to the margin, at the same time the dependency on the bulk we have reduced significantly. Third, slightly the fine price asset, which are high quality of course, we have reduced that. And on the capital front also significant jump in the capital also.
Oh, capital. Yes, I'll just come to the capital in a minute. Just on cost of funds, do you have more elbow room to reduce bulk deposits? And secondly, what is the extent to which you have to increase deposits at all? Because I think you are sitting in a comfortable LCR. It's what, 130 or something, right? So
we are at 138, yeah.
Okay, so will you just bring it down to what, 120 and be happy about it?
Yeah, absolutely. These are all management of multiple factors they are in. The moment you look into LCR 138, even if the draft guidelines comes into finality, the impact would be something around 12 to 15% maximum. So we'll be at a comfortable level. The same time, as far as bulk is concerned, if you look at as far as we are concerned, FY23 over FY22, the percentage of bulk as a percentage of total deposit went up by almost 600 BPS. And now in June 24 also we are almost at the same level as far as the percentage deposit concerned. So in the process we have made the deposit profile much more stable at the same point of time, keeping the margin also intact. So from here onwards I can think that I can play around with that margin because the margin guidance we are giving 3.15 plus minus 5 BPS. So depending upon the outlook on the loan side in terms of their pricing, I think we can still increase the bulk, but obviously keeping the margin factor into mind while increasing the advance.
3.15 is for the full year, I would assume.
This is for the full year, plus we have given a guidance of plus minus 5 BPS. That is what we have been telling for multiple quarters now.
Okay, but more generally, cost of funds will go up, you think, because there is a war for deposits?
There are two scenarios panning out. Actually, the cost of deposit not only depend on the rate stance, but also the available liquidity in the market. And what we are seeing for a couple of weeks now, that it's now getting better than the earlier. So my sense is that even if on the rate stance, things may continue as it is, but because of a better availability of liquidity, possibly cost can moderate. But that may not happen immediately, but slightly I may looking at Q3, maybe the cost of deposit would moderate. So in that scenario, it would give further leeway for us to increase on the advances side.
Okay, and not all banks are agreeing. HDFC Bank just raised its deposit rate on several tenors. So many of the banks told us that the pressure continues at least this quarter. Let's see if the government, the RBI cuts CRR or something. Okay, let me come to the slippages part. Your retail loans did show some slippages, I think 1.7%. How is it shaping up? Can it get worse in the current quarter?
No, I don't think so. Reason being because we map out the SMA book on the retail and also the collection efficiency. Both are at this point of time quite strong. So I don't think this retail slippage is some kind of a seasonal one-off kind of a year. And if you compare the slippage ratio vis-a-vis the Q1 of the last year, it is much better. And the credit data also showing much, in terms of the Q1 of the last year and Q1 of this year. So I don't think that going to continue. It's something one-off seasonal, and I think will be like, because we look into these accounts more closely, I think a lot of pullback could happen out of the slippage that happened for this quarter in the Q2. So things are fairly stable in terms of the asset quality.
Okay. Yeah, of course, you'll have done extremely well on recovery and upgrades. And I must admit that a lot of other banks' annualized slippages are higher than yours. Mr. Chand, now to come to the other two small, minor overhangs on the banking system. If the project finance provisioning rules come, how much can your provisioning go up?
See, last time also the same, because it is a draft guidelines as a policy, we normally, because unless and until the final guidelines comes, we can't actually take a call on that. But considering my scenario, see, a couple of scenarios, let me tell you very clearly. One is that my capital adequacy is very strong, and that is out of internal accrual. The second is the margin is also fairly good considering the market, in terms of the market scenario. And thirdly, in terms of my dependency on the bulk on the cost side, not only on the interest cost, but we have also a strong lead on the operating expenses that would have seen. So as against a 25% growth earlier, now the growth is only 14%, 14.5%. So scenario like that, any impact because of the project finance, consequently, I give you a scenario like when the risk weight of the NBFC and this personal loan came, the impact was almost 68 BPS on the CRAR. But currently, if you look at the CRAR is much better because the banks normally do pass on the impact therein. So I think any guidelines coming on the matter on the project finance, I think the bank's balance sheet is well capable of handling that, or that may be a scenario where we can pass on to the customer to recover the impact there.
Okay. You have taken board permission for 7,500 crore of additional capital, right? Are you likely to do that very quickly? Market is at 25,000. It is in the best of spirits. So should we expect, and will it be an offer to the public, or will it be privately placed?
No, it will be privately placed. That is one. Secondly, if you look at my CRAR, there is no urgency for me to raise this capital. That is very clear. And sometimes, particularly long-term capital bond, it also depends upon the market appetite. At the same time, the rate stance. So our own house view with regard to the rate stance is that possibly expecting a Fed cut maybe in the month of September, and consequently a bit of moderation happening on the rate stance. That is what our expectation is. So we'll be timing it in a manner where we get an optimum, interest cost in the issuance side. So it's not immediate, but there would be maybe this quarter or next quarter possibly will be hitting the market.
Okay. Well, finally, if you can give us some idea of where growth will come from, what kind of growth in advances are you penciling in, and from which verticals?
See, if you look at the current year retail we are doing, the growth has been more than 20% for last many quarters now, and this quarter also the retail is more than 20%. And if you, compare the Q1 of the last year and Q1 of this year, the change in retail is almost 250 BPS towards positive. That means we have increased the retail book. And typically in the bank, we talk about retailizing the book, and slightly that is what it has worked. MSME and Agri this quarter slightly below 10%, but there we would like to grow slightly higher. We are targeting something around 14-15% growth in MSME and Agri. Particularly the budget is giving a lot of support for the MSME. I think that would be an achievable one. Corporate side, we have strong pipelines. And as I said, corporate, it's a how do you balance the portfolio, that is important. There are strong demand from the renewable side, on the infra side, even on the cement and some other core side also. So the pipelines are quite strong as on today as far as we are concerned. And I think on the corporate side, we are giving a guidance of 10 to 12% growth for the full year. and I think we'll be in a position to achieve. So the overall loan guidance for the full year is around 12 to 14%. And I think currently, based on the pipeline, our capacity to grow because of a strong CRAR, good margin, I think those are things which can be achieved by the bank for the full year.
Okay, your full year credit cost guidance was?
See, this time the best part of the credit cost is below 0.5, but earlier we had given a guidance that we'll maintain credit cost less than 1, keeping everything, the ECL framework, everything in mind. But this time we have again revised it to less than 0.75. And as far as Q1 is concerned, we're at 0.47. So in that way, fairly balanced and well positioned there.
Okay, below 0.75. That's, well, let's hope it's 0.5. Thank you very much, Mr. Chand, for joining us with all those details. So Bank of Baroda promising good growth and, of course, lower credit cost, which is what the street wants to hear. Wrap up on Bazaar on that note, with the market still cheering 25,000. Chartbusters will take the action forward.
AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Income Tax website and then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services.
Nifty touches new records. The index scales above 25,000 for the first time. The Sensex 2 crosses a record high, crossing 82,000 for the first time.
Maruti zooms more than 3% after reporting an all-round beat in the first quarter. The management says that they maintain the single-digit growth in volumes for FY25. Brokerage firms Morgan Stanley, CLSA, Jefferies, all of them issue bullish calls on the stock.
Coal India climbs nearly 3% after reporting a good set of numbers for the first quarter. Sales rise about 1.5% year-on-year. Lower employee costs, one of the key reasons for the company's EBITDA outperformance.
Crompton surges more than 3% on the back of the Q1 numbers that largely saw an inline growth driven by strong performance in the ECD segment. The management tells CNBC TV 18 that they are sticking to the double-digit growth guidance.
Among all the gaining stocks, one stock which is under pressure is Thomas Cook. After reporting what was a weak set in a seasonally soft quarter, the profit after tax was up 3.1%. That was on account of higher tax liabilities. The key segment of the company did well, so the stock has recovered mildly from the lows.
Hello and welcome to Chartbusters. I'm Nashil D'Souza. Joining me as always is Mangalam Malu. Well, the screen is green. The Fed didn't disappoint overnight, so we're not fed up of them. And our own cues as well were fairly supportive. It explains why the Nifty is holding above the 25,000 odd mark. The Nifty Bank is well up 175 points. And the best news today is that, in fact, we do have more number of stocks advancing than declining. And that's the trend. Only problems in the last few minutes. The mid-cap index has almost moved into the red. So keep an eye out on that front. Well, Mangalam, we're a fourth to that big journey of 1 lakh odd, but 25,000, wow, who would have thought?
Who would have thought, Nigel? 25,000 on the Nifty. Yes, there could be some profit taking, understandable after a big rally that we've had. A couple of things that really stood out in this journey of 25,000, that Nifty is effectively doubled every 6 years. And it's over the longer period of time, irrespective of all the volatility in the market, has tracked just one metric, which is earnings. Earnings over the last many years have grown at 12% compounded, and the Nifty too has grown at 12% compounded. But Nigel, just out of trivia, what was the Nifty when you first started tracking it? Just to see how much do you remember of the Nifty? Because this is one of those I was here when the Nifty was there moment.
When I first started tracking or when I joined?
When you were, I believe, working at the NSE, right? What was the Nifty
right
then?
So at that point in time, Mangalam, I've seen the index fall from 6,300 in 2008. It fell down. I think the index almost halved at that point of time, in that 2008 phase. But I've also seen the market go to an upper circuit at the NSE when, there was post the election verdict. So I've seen the index sitting at around 3,000 and today it's at around 25,000. What about you?
When I started tracking the Nifty, when I first got into the workplace, it was close to around 4,000, 5,000. So from there, it's been a 5 times up move for me. But what I clearly remember is when the Sensex had hit that 10,000 mark, and Sachin Tendulkar also made his 10,000 runs in the same time. So it's been quite a journey, right? We were talking about the Sensex at 10,000. We were talking about the Sensex at 30,000. When we were at CNBC TV 18, remember those infamous 30,000 T-shirts? And now we're looking at Nifty at the 30,000 mark itself. It's rightly said, right? Every 8 years, the Sensex, the Nifty turns into the Sensex.
Well, Mangalam, I'll tell you what, but we are running that marathon. These 100-meter spurts are going to be very, very good. But be in there for the long haul. This market's only going to go up from here on, and some capital allocation to this market is really become very, very important. So keep your SIPs going. That's the only advice that we'd like to give you.
Absolutely. If you're bullish on India, if you want to play the India story, everyone talks about the great Indian consumption space, the great Indian investment opportunity, the great Indian growth opportunity itself. The decade belongs to India. If all of that has to happen, of course, the earnings will come by, and that in turn will reflect on your investments in the frontline indices as well. But let's talk about earnings itself. We have Ugro Capital, one of the companies that we're going to talk to today. The lender's disbursement declined about 35% sequentially. We have Shachindra Nath, who's the Vice Chairman and Managing Director of the company, joining in to discuss the numbers in detail. Thanks a lot, Shachindra, for joining in. I remember very clearly that you said you're looking at 9,000 to 10,000 crores of disbursements in FY24. That was last year. Let's talk about FY25. What is the kind of disbursement target that you have? And a stat that stands out for me is that the disbursal to AUM ratio has fallen to 9.3% versus 24% quarter on quarter. What explains this divergence? And if you could give us targets for this year as well.
So look, first quarter always is little slower for most of the lending institution. This time it has been little more slower than what we would have expected. But our belief is that, last full year, as I've spoken to you earlier as well, we were at the run rate monthly disbursal of around 550 crore per month. We ended the year on the same run rate. We raised capital And we are gearing now, the system is moving towards more higher monthly disbursement. And that is designed through our micro enterprise branches, which is going up from 100 to 150, which is now complete, to 250 location now. We expect that our monthly disbursement by the end, we will end the year, exit the year should be right around 900 crore. We continue to believe that our disbursement this year should be higher than at least by 25 to 30% than the last year.
All right, disbursements 25 to 30% higher. You were giving us a number which we missed. Could you repeat that number for us?
I was saying that if you look at our trend for last whole year, monthly disbursement was in the range of around 550 crore a month. First quarter was little slower for the month of April and May, but we came back very strongly in the month of June. In the month of July, actually, we are back to our full flow. And as we progress in next 2 quarters, we think that we will stabilize at around 750 to 800 crore monthly disbursement targets.
All right, Mr. Nath, good morning and welcome to the show. So we'll keep an eye on that 750 to 800 crores from the normal run rate that you were seeing of around 550 crores. Got that. Could you help us out with what's the outlook on the NIMs? I'm just looking at it. I believe there's a ratings upgrade as well that's come in there. So how does this change things for you in terms of cost of borrowing? And what's the outlook on the NIMs?
Look, this is very good news. For an entity like us, which are not supported by large corporate, we are largely institutional player, which means our rating reflects our own standing. So unlike some of our peers said, when rating is a reflection of who the parent is, our rating reflects our core strength. And we have got 2 upgrades in last 4 months, first by CRISIL and now by India Rating. And on the shorter tenor, we are at the highest rating. Now, fortunately or unfortunately, this rating has come at a point of time wherein the liquidity, especially the RBI narrative of banks not to lend too much to NBFC, doesn't help, and neither the rate cycle seems to be changing early. But we are still hopeful that as we progress in next 2 quarters, our cost of borrowing, we have guided that our total cost of borrowing should come down by at least 50 basis points as we exit the year. But some portion of that should get reflected by 25 basis points in next 2 quarters.
So what does that mean for your NIMs? Because, I remember the last time we spoke, you said that NIMs won't see a much downside from levels where they are right now. And that time it was closer to 9%. Since then, it's come closer to 7%. So what is the rough range that you're working with? And especially with your cost of funds coming down, cost of borrowing coming down, can we expect the NIMs to go back to that 8% vicinity? Or will they be around that 6.5 to 7% this year?
No, I think so. We'll maintain the NIM. This first quarter is not truly reflective of how the whole year would be. Because our portfolio mix is, the product mix is changing, our micro enterprise business, which operates at around 20% of gross yield, which was around 12% of our total AUM, should go to around 24% of total AUM this year, 40% next year. So just because our 150 basis point of yield increase in next 8 quarters we are targeting, our NIMs would go back or improve slightly from where it was at exit quarter 4.
Okay, all right. Mr. Nath, your AUM, last reported numbers around 9,200 crores. How do you see this number wind up, say by the end of this year? Because there'll be some repayments as well, there'll be dispersals as well. Put that together. What should it be? And say in the next 3 years from now, what is the target out there? And help us out with segment-wise. How will it look? As of now, what is it? And say in the next 3 years, how do you see it shape up?
Yeah. So look, our long-term aspiration is to build India's largest small business financing company. We know that in last 3 decades, we have seen emergence of a very large consumer financing business, large gold loan company, large tractor financing company. We continue to believe that in last 7 or 8 years, the MSME economy is now very buoyant. The fundamental shift of digitization has taken place. And that's why if the MSME economy has to contribute roughly around 40% of our GDP, then credit has to go. The gap is very, very huge. And that's why we think we have all the right things going for us to be one of those large players in MSME financing. Now, what mean large? I look at it in a 10-year time horizon. We should be a very, very large company. But we continue to grow at this pace, rate at which we are growing. Our AUM should grow in the range of, we have been doubling our AUM every year. We were 3,000 crore in 22, 6,000 crore in 23, 9,000 crore in 24. and roughly around same range or a little bit higher, we should grow this year and next year.
All right, if that was supposed to be the case, then we'd look at numbers closer to 20,000. But we'll talk about that when we come to that, Mr. Nath. Finally, before letting you go, the rate at which you're growing, you're speaking about yields increasing, the cost of funds reducing. All of that does beg a question towards asset quality as well. Will there be ever an accident out here? So what is your asset quality outlook from here on, both on the GNPA, net NPA front, the provisions that may increase? If you could give us a sense of the credit cost target that you have from here on for the next couple of years.
We have said that, through the cycle, we would target a 2% of total credit cost, and that is a function of the blend of MSME financing we do. We do right from a 5 lakh rupees of secured loan to 3 crore of secured loan. We do multiplicity of product across the nation. We do prime secured business loan, machinery, rooftop solar, micro enterprises loan. And as we grow, we are granularizing our portfolio by going deeper into the India's hinterland. And we believe as we continue to grow in the lower ticket size, little higher yield, more secured businesses, the economy is more resilient, customers are more stronger, and that would maintain the portfolio quality. Last 10 quarters, our login to approval rate have remained static at 30%, which means for every 500 crore monthly disbursement, almost 4 times of that we originate. So we maintain credit quality by controlling the funnel, and we'll continue to do that.
Okay, Mr. Nath, appreciate you joining in. We'll hold you to these numbers, wishing you and your team all the best. The next time around, we look forward to having a chat with you. For the time being, let's shift focus to our special segment. We get a few ideas for profit from Money Control Pro. Anubhav Sahu joins us to fill us in with his pick. Anubhav.
We're talking about fluorochemical major Navin Fluorine, which posted an uninspiring set of results for Q1 fiscal 25. Sequentially, net profit degrew, but the steady show in the high performance product segment provided some relief. Other two segments continued to have a lumpy revenue trajectory. That said, guidance in terms of capability enhancement was positive. So in the next 18 months, company is planning to commission various capacities across segments that would provide a base for multi-year growth. Now the capex outlay is upwards of 1300 CR, and major capex underway are that of doubling of R32 gas capacity, anhydrous hydrofluoric acid plant, and phase 1 of the 4th CGMP facility. In addition, Q2 is expected to see commissioning of 540 CR capex of agro specialty, which should help in better second half for the specialty chemicals, along with improved channel inventory. However, what keeps us constructive is the commentary regarding various sales agreement, which should help new capacities to ramp up. Now, this includes a supply agreement for a patented agrochemical product for the Japanese market, and various CDMO orders secured for the late-stage molecules. Now, while the valuation is at a premium, we believe investors should accumulate the stock on decline and potentially participate in the company's journey towards high value-added business mix.
All right, with that, we'll step into a short break. On the other side, don't go anywhere. We have Puneet Lalbhai, the Vice Chairman of the Anup Engineering Group, to discuss their company's earnings as well. Stay tuned to that.
From consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
Welcome back. Well, let's focus on Anup Engineering then. They delivered their first quarter numbers. To understand what's the way ahead from here on, we have Mr. Puneet Lalbhai, who is the Vice Chairman of Anup Engineering. Hi, Puneet. Good morning and good to see you in. Well, tell us about, how is the order book looking? I'm looking at the absolute number. It's come down to around 810 crores. So a bit of a decline on a sequential basis. What is the order inflow you're factoring in for this year? And also split it up for us between exports as well as domestic business.
Sure. I think the order book is extremely strong. As of now, the order book for the entire year is full. Of course, this being a project business, there will be some lumpiness in the order inflow. As far as the overall market conditions go, the Indian market is a little bit slow at the moment because of the election period and no new projects taking off in this phase. However, the export market is extremely strong, and we believe that the order book to come will look extremely strong. So this year is completely full. Last year we ended at about 50%, close to 50% exports. This year also we are looking at perhaps bettering that number in terms of exports.
50% exports, you're looking to better that number. You said that your order inflows are lumpy because of the nature of your business. So which is why there was not much that came in the first quarter, also impacted by the elections. So let's talk about another way to look at your business going forward, which is your bid pipeline. In both your export and domestic markets, if you could tell us over the next couple of months, next couple of quarters, what are the bids that you are making? And what is your order book right now? What does it stand at? And what are you anticipating to close in this year in terms of inflows?
So I think the way to look at this business is that we are attempting to grow at 25% year on year. So last year we closed at around 550. This year the target will be to cross 700, and next year the target would be to grow 25% from there on. We've also added Naval Engineers as an acquisition, so that should add another 60 crores to the overall entity. So if I were to give a guidance, we should be at that 750 mark by the end of this year and look to grow 25% in that.
All right, we missed that number on the inorganic growth. Mabel, how much will that contribute?
50 to 60 crores this year.
50 to 60 crores this year. So 700 plus the 50 crores, that's how you're accounting for it? Or it's 750 plus the 50 crores?
No, 700 plus the 50 crores. So
plus 50.
We should be ending the year at 7.
And Mabel, can be scaled up from this 50-60 crores of annual revenue, say in the next 3 years? What does it go to?
So we are targeting that entire campus should be able to give us 150 to 200 crores over the next 3 years.
Oh, the next, okay. So from around 50-60 crores, you're saying it goes to 150 to 200 crores. So that's quite interesting. Give us a number on the margin guidance as well. What should the consolidated margins look like? And if you can throw some color on what's Mabel's margins, is it lower? If yes, do you see it scaling up?
So Mabel focuses more on higher metallurgy. It's a facility that does smaller size vessels, but higher metallurgy. So the margin structurally is lower. So the return on capital employed would be very similar. and the overall margins for the group, we always guide as 20% plus, and we look to have a consolidated margin of 20% plus.
All right, you will do 20% plus margins. That's what you've guided for. Mabel ROCE will be similar to what your current business is. I just wanted your view on further capacity enhancement, because you've extended the PS Bay at Kheda. That would be commissioned, I think, sometime right now, anytime in the very near future. How much can that add to your revenues? What's the ramp-up schedule here? And what are the further capex plans that you have post this?
So I think factoring in this year's capex plans, overall, including Kheda, Odav, and Mabel, we have reached about 1,000 crore top line here.
1,000 crore top line by when?
I mean, we will, of course, the growth will be this 25% rate. We also need to manage, the execution of the growth. But the capacity addition is capable of taking us to 1,000 crores now. So that will come over perhaps 2 years if we just add 25% to this year's ended guidance. It will take us 2 years.
Got it. 2.5 years, new capacity, including Mabel, will give you close to 1,000 crores additional revenue. Mabel, you just said that at peak could be about 150, 200 crores in terms of revenue. So one assumes that maybe the PS Bay at Kheda would give you around 750 to 800 crores as well. Thanks a lot. It's been a pleasure speaking with you. We hold you on to those numbers, and we'll keep connecting with you at the end of each quarter to get an update on what business is looking like. That's about Anup Engineering. Take a short break, come back, tell you about the markets and a lot of individual stocks which are buzzing around.
Embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI/ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Welcome back. Tata Consumer saw some profit booking post numbers yesterday, has now moved higher. We have some important news at the bottom of your screen on account of IDBI Bank. We'll try and connect with Ritu maybe shortly to try and understand what exactly is taking place out there. As of what her story is, there have been 3 potential suitors who've been given the fit and proper certificate by the RBI for IDBI Bank. Who those suitors are and what happens of this is something we'll be tracking.
Yeah, I think, and the name should come up for you on the screen. I think Fairfax is one of them. So we should get the names up of the 3 potential suitors. Fairfax, Emirates, NBD, as well as Kotak Mahindra Bank. They're among the likely suitors. Remember, the sheet has been waiting by whether or not this can close out in this year. And as we've been reporting that maybe that process starts from the month of August itself. For the time being, the stock is more or less flattish, so I think it's come off a little bit from the low point of the day, Manglam.
What's interesting is that Kotak Mahindra Bank also, as Ritu has been pointing out, is not very keen on an investment right now. Otherwise, the street would have thought that maybe Kotak Mahindra Bank would have been an important suitor now that it's got the certificate. Kotak Mahindra Bank at the low point of trade, but not to do with this news piece itself. They may not be very keen to pursue this acquisition, so that leaves you with Fairfax and Emirates NBD. But that's not for us to decide. I guess that's for Ritu to find out and tell us, along with the RBI as well. With that, we'll slip into a short break. Take your leave on this edition of Chartbusters. Stay tuned. Trading Hour comes up next.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Till about 6 months to a year ago, BSE didn't have any volumes at all in the F&O segment, and the only reason they came up was introduction of weekly expiries, and putting an expiry on a different day in the market. Now, NSE has had the most successful F&O contracts for the last many years, and these are Bank Nifty and Nifty. And asking NSE to choose between the Nifty and the Bank Nifty, obviously, when they use the word benchmark, it's very, very obvious that it has to be the Nifty and not the Bank Nifty. I think would be a big, big blow to the NSE in choosing. Rather than that, I would have probably gone back to the system of each exchange can choose one expiry day per week so that all the contracts expire on that day in the week. We were opposing this. I think this is a very retrograde move. Rather than asking exchanges to choose a contract, we could have simply said you can have one expiry day for all your weekly contracts, which means that if I have 100 rupees of capital, I can't go on using it for different contracts on different days. I can't rotate it on expiry days every day of the week. If all expiries, let's say assuming it's on Thursday, then I have to decide between if I want to do the Bank Nifty or the Nifty. And that would have at least allowed these indices to be liquid or reasonably liquid and still exist.
Hello and welcome to Trading Hour. I'm Ekta Batra and with me is Sonal Bhutra. Well, we're filling in for the normal anchors for the show, but nonetheless, it is a great day to fill in for it, considering that we have the Nifty sitting at around 25,000 at this point in time. So we've crossed that milestone mark, and we have a lot of statistics coming your way in terms of what you should probably see and which are the stocks which have really led the rally as well. But just want to point out that, you know, Sonal, has been so interesting because we've waded through so many negatives for the market. The election verdict, the capital gains increase, as well as maybe even earnings volatility to a certain extent. And despite all of that, we're sitting at that milestone level of around 25,000. And not to mention that, you know, the DIIs are really pulling their weight at this point in time. Just a small piece of evidence is in just the past 7 trading sessions, we've had the DIIs pump in around 24,000 crores and consecutive buying coming in from there. FIIs have been net sellers in 6 out of 7 of those trading sessions, and they've net sold around 19,000 odd crores in the same period. So net, the inflows have also been positive, and now the weight is obviously towards the DIIs.
Absolutely. And you know, DI is not only directly in the equity markets via mutual funds. We've been talking about the SIP number as well.
SIPs.
So it's been a one-way move there. And you know, right now, mid-caps which have been doing well, they have come under some bit of profit booking. So that index is down 132 points, but so many movers in the broader markets. The biggest news, of course, being Nifty touching that 25,000 mark. It has come off from the highs, but we'll have to see whether that stays above that milestone or not. But as we've been talking about Nifty hitting the milestone of 25,000 and taking 24 sessions to gain the latest 1,000 points. Manglam is tracking the journey to 25,000. Manglam, take it away.
Well, 25,000 is actually just a milestone in what is otherwise a long journey for the Indian equity markets itself. So I just thought it's a good time to look back and track that journey itself. The index started in April 1, 1996 with a base of 1,000. Over the next 11 years, in September 2007, it moved to 5,000. Between 96 and 2007, we of course had the IT boom, the IT bust, the Asian financial crisis, the big bull run as well. And then from there, we had the great financial crisis of 2008. Between that and 2017, the Nifty doubled again to 10,000. Thereafter, in quick succession, it moved to 15,000, 20,000. And now as we speak, we are sitting on Mount 25,000. Between 10,000 and 25,000, we've had GST, we've had demonetization, we've had a couple of elections, we've had a couple of wars, we've had the major pandemic as well. But the cult of the equity market and the market kept moving on. So what it teaches you basically is that over the long term, irrespective of the events that are taking place in the near term, the Nifty has compounded at 12% since inception. What does this mean? It's doubled every 6 years. And what does this coincide with? For the last 23 years, the Nifty EPS itself has compounded at 12%. So whatever happens, if the earnings are moving in a certain direction, the market eventually will catch up. So at 25,000, the index trades at 22 times FY25 price to earnings. This is something that we will monitor going forward as well, irrespective of, again, the events. The last 5,000 points is what we're tracking right now in terms of moves. They've been led by, you know, the PSE index, the public sector enterprises, the realty stocks, oil and gas, as well as some of the auto stocks as well. What hasn't participated as much in the last 5,000 points has been the IT index, the FMCG index, and the Nifty Bank, while they've moved, but not to the extent of the others itself. It's been a broad market rally. So SME IPO index is up 165 points. Small cap and mid cap indexes up anywhere between 40 to 50% itself. The top Nifty gainers, Bajaj Auto, Coal India, M&M, ONGC, basically IT, realty as well. You have PSEs, realty and the others. And if you look at the underperformers there, Bajaj Finance is actually down 8%. Asian Paints, IndusInd Bank, HDFC Bank, the biggest of the banks, down by about 1% over the last 1 year or so. But I've said it's a broader market-led rally. So we have Oil India, NBCC, Trent, all of them nearly trebling in the last 1 year or so. Oracle, Amara Raja up 150% as well. And here too, we've had a couple of notable losers. Z down 50%. We've had Naveen Fluorine down 20%. PVR Inox down about 15% as well. With all things said and done, as we sit atop Mount 25,000, what are the things that we are tracking going forward? One, will FIIs return to buy in cash market? This has been a largely DII-led rally. Second, now with the outperformance of the mid-cap stocks, is it time for large caps to take the baton and move forward? The third thing that we're watching out for is increasing retail participation in domestic SIPs. Does that continue in wake of all the regulations that are coming by as well? And finally, there are a lot of pockets of hefty valuations in the broader markets. Do they go away or not as well? And we obviously cannot discount the impact of geopolitics and global developments more on the market. So those are a bunch of things that we'll be watching out for from Mount 25,000.
Okay, Mount 25,000 it is. Thanks, Mangalam, for that comprehensive take and the compounded rate at which the Nifty has in fact grown, irrespective of all of the events that have taken place, which might be negative. Manish Jain from Centrum now joins in to discuss the market fundamentals and his top sectoral picks. Manish, hi, welcome to the show. Well, it's a milestone event, 25,000 here for the Nifty, but the big question is that should one probably take some profits off the table now, or should one continue investing? Do you think that valuations have now become a little punchy and it might just be prudent to have some cash?
No, I don't think so. I think the markets will continue to rally from here onwards also. So there are three things that continue to play on my mind. See, one is that most of the big events that had to be played out have kind of happened, right? So the elections had to happen, the results are out of the way, the budget has happened, kind of a mixed bag, but it's out of the way again. So there's no overhang which is left in the market. The monsoons have been progressing fairly decently well. The rural growth, the volume growth, especially in the FMCG sector, has now started showing some green shoots of revival over there as well. We saw the quarter from HUL where they reported about 4% volume growth. So that has again been going well. So most of the larger events are kind of out of the way, which is point number one. Point number two is that we are still holding on to the estimate of about 12% sort of earnings growth as far as Nifty is concerned over the course of this year and the next one. So that means that on a 1 year forward basis, Nifty will be somewhere in between 21 to 22 times P multiple, which is not exactly in a very expensive zone. Bubble starts getting formed when it's about 23, 24 times. And then liquidity is just so strong. The domestic liquidity from retail investors, the SIP money, 21,000 crores a month, is just so strong that given the fundamentals of the economy, when you look at the budget, the kind of fiscal deficit numbers, government borrowing program, rate cut is kind of on the horizon. I don't think the markets is going to experience any major correction anytime soon. So I would expect, I would advise people to kind of continue investing over the course of next few months.
Manish, you're talking about more investment opportunities still available. I was looking at some data. The Nifty small cap PE is at around 22. The average PE has been around 15. The Nifty current PE around 20. And the average PE has been around 18, right? So there is still a premium that these indices are trading at. So in a market like this, where do you find opportunities where you can trade? What are some of the sectors you think would still see an upside potential from here?
So the thing is that, see, one is that the data you provided is absolutely right, which is if you look at the long-term average, Nifty is traded at around 18 times versus now where it's trading at close to 21, 22 times or somewhere in that range. But the point is, if you look at the last decade, which was 2010 to 2019, 2020, the average earnings growth from Nifty was about 6%. So we were paying 18x multiple for that, which is roughly about 3x PEG. But today, the same Nifty is delivering double-digit earnings growth. So it's less than 2 times PEG, right? So when systematically the ROEs of a market moves up, when the profitability moves up, when the overall leverage in the system, as far as listed equities are concerned, kind of move down, then the multiples will be at a slight more premium as compared to the last history. So that's not what I'm worried about. And second is that when you look at autos, when you look at banks, even the larger 4 or 5 banks that trade in the market, what you realize is that the rally has not been homogeneous in the last 1 year. Not every stock in every single sector that has done well has kind of participated. It has been a very concentrated rally in some of the sectors, in some of the stocks, So if you do a very strong due diligence and have a bottom-up approach to investing, you'll still find enough investment opportunities. We continue to be very, very constructive on IT. We continue to be very, very constructive on the consumption sector. We continue to be very, very constructive and overweight on the real estate sector at this moment. Banks probably not as much, but NBFC is definitely, again, very, very positive in that sector. And again, pharma will continue to see some bit of a rally again going forward from here.
Okay, just quickly, Manish, I wanted to specifically narrow down on the Nifty PSE index. As Mangalam was pointing out, it's gained around 95% since September of last year. And the big question is, should you be putting more money into such stocks and within that index? What is your sense? Do you think that the run-up has been far too great there and one should probably stay on the sidelines?
Yeah, so it's not just Nifty PSE, but when I look at defense stocks, when I look at some of these stocks in the construction, in the infra side, when I look at some of these manufacturing names as well, the same question kind of comes into my mind is that whether these stocks are kind of running ahead of their fundamentals. And at this moment, these are the sectors where we are kind of sitting on the sidelines. We are not taking fresh bets, but we are not taking money off the table where we had been invested historically. So that's the approach we are kind of taking. So definitely in terms of risk versus reward, these sectors have definitely seen a very significant run up as compared to what the near term or even the medium term earnings growth are over there. So any kind of correction over there, time correction also, I'll probably start looking at it. But at this moment, kind of sitting on the sidelines, definitely.
Okay, all right. Manish would have liked to chat a little bit more, but out of time, a lot of moving parts in the markets today. But thank you so much for joining us with your take. That's the market advice. But let's get you a CNBC TV 18 exclusive now. We learned from sources that KC International is the likely front runner to acquire promoter stake in ITD Cementation. Yash is joining in with all the details. Yash, what are you picking up?
Well, Sonal, it was just last month when the promoter entity at ITD Cementation, that is Italian Thai Development Company, had informed the exchanges that the promoter's intention is to divest their investments in the company. What I'm given to understand is that the process to do that started right after that. There were certain players which, of course, the promoter entity and the entity itself, ITD Cementation, was in talks with, and sources have told CNBC TV 18 that the company started its conversations with a single player here, and that is KEC International. Of course, as I said, the input is also there that there were a couple of other players. One was domestic. There was a foreign player as well in the race to acquire this particular stake. But at this point of time, the input that we have is that the company's started its conversations with one player, that is KEC International. The promoter, that is Italian Thai Development Company, owns about 46.64% stake in ITD Cementation. As far as that particular valuation for this particular transaction is concerned, that is expected to happen at the current levels itself, that is at a market cap of about 9,000 crore rupees, which means that the 46% or 47% stake which the promoter holds and is willing to sell, the value for that stake, which KEC, if the deal itself fructifies, KEC will have to pay about 4,000 to 4,500 crore rupees for that promoter stake acquisition. As far as order book is concerned, KEC International holds an order book at the end of FY24 at about 37,000 crore rupees. ITD Cementation has an order book of about 20,000 crore rupees at the end of FY24. And since the conversations between the two players have started, what we've been given to understand from our sources is that there is a possibility that the deal could be announced at the end of September or the start of October itself. We've written to both companies on this particular query. KEC has said that they do not comment on market rumors, and the company continuously evaluates various inorganic and organic growth opportunities. They will make the necessary disclosures whenever the right time comes, and ITD Cementation has declined to comment on this query.
Okay, all right. But the stock is definitely very active on the back of this news. Thanks, Yash, for getting us that update. ITD Cementation, as you can see, that stock is up around 3%. We'll take a short break, but up next, we'll talk to the first company on the show, Saurabh Agarwal, the Executive Director of Action Construction Equipment, or ACE, to discuss the quarter gone by. Stay tuned.
On the Map My India notice, see, we have put out a public statement that we will definitely respond to it publicly, and we think it is very opportunistic of them, and Ola Electric is not even in the maps business. We are a group. We have 3 different entities in the group: Ola Cabs, Ola Electric, and Ola Kritrim. And Ola Electric is not in the maps business. But there are opportunistic players across, so we will definitely respond to them at the right time.
Welcome back. You're still tuned into Trading Hour. Let's talk about some earnings now. Action Construction Equipment saw its revenue surge 13% on a YOY basis. Margin expansion continued, and this was driven by operating leverage and favorable commodity prices. To discuss this and more, we are joined by Saurabh Agrawal, the Executive Director at the company. Mr. Agrawal, good morning. Thank you so much for joining us. Well, it's been a good quarter for you, this despite the fact that there were elections. But tell us what the outlook is going forward, and what was the breakup in Q1 in different segments? How much was the value growth? What kind of volume growth did you see in each product offering?
Yes, good morning. Last quarter was definitely a little less than our expectation because of the elections, but obviously we had planned for that. And I think we were able to do fairly good enough with a 13% growth on a year-on-year basis. And for our cranes, construction equipment, and metal handling sector put together, I think we saw a decent revenue growth there, about 20%. And there was a degrowth in the tractor segment, but obviously that we've taken care of. There was some really good export orders which were getting executed last year, same time, for tractors. So that's why you see the deficit.
Oh, okay. So your agri equipment was under pressure because of a high base?
High base because of a special export order on tractors which we executed same time last year. I mean, but I'm sure that will catch up in Q2, Q3 coming up.
So what was the normalized growth within that segment, and what are you guiding for?
I think for both the segments put together, I think if I talk of cranes, construction equipment, we should ideally be looking at least a 15-20% growth in this year. And on the tractor segment, about a 15%.
Okay, 15 to 20% overall and 15% in the agri segment. And how much would exports be? You said it was taken care of by exports to some extent. How much it is as a percentage of your order book right now, revenues as well? And what kind of growth are you looking at just the export segment?
Last year we did close to about 8%. So hopefully in this current year, on a company basis, we should be able to better it. And we are looking at executing further export orders in. It's going to start primarily from end of Q2 and going into Q3, Q4. So hopefully it should be above 8% this year as well.
And how much is export as a percentage of your revenues?
Last year it was around 8%.
Okay, no, I thought that was the growth number. So what is the growth that you're expecting then?
See, again, about a 15-20% because the company is going to go 15-20% and we're able to maintain 8%. So the growth will be around 15-20%.
Okay. All right. So you're quite bullish in terms of growth going into FY25 for the remaining part of the fiscal. But if you want to talk about a maybe longer term journey, you had mentioned that, 3x growth from a base of around 2,500 crores is possible in the next 5 odd years. Does that still stand? Are you on track for that? Or do you think that you could probably, exceed it or undershoot it based on the demand factors that you're seeing right now?
Yeah, I think everything seems to be going on well. And in the long term and even in the short term, the government is very much focused on the infrastructure development as well as the manufacturing sector. So I see no reason that over the next 5 years, we should not be able to, do a 3x with respect to our revenue and profits at least. So things seem to be proceeding as per our plan, and I think everything seems to be going on fine.
Okay, you're sticking to that guidance. Just wanted to ask you, you do have, some plans with regards to a joint venture in India as well with K2 Works. Can you just tell us about where that is currently and what would that JV consist of?
K2 Works is a very prominent manufacturer out of Japan for bigger cranes, truck cranes, crawler cranes, and rough terrain cranes. And this is what we intend to do in India with them. Make machines for the Indian market and as well as for the export market. So we principally agreed to form this joint venture. Hopefully this work should get completed in this year. And we should be able to kick off the joint venture and productionize it in the next year.
What are the terms of the joint venture? What is the holding structure? What would the revenue share for you be? Will you have to make some investments in this particular JV?
Yeah, the percentage holding both of us will be about 50-50%. And the overall investment which are envisaged is close to about 150 crores.
I'm sorry, can you repeat that?
The overall investments envisaged are close to about 150 crores.
Okay, all right. Okay. Well, while we spoke about, what you're expecting in terms of growth on revenue, wanted to understand what you're envisaging in terms of margins as well. For the entire fiscal, what do you think the exit rate would be, and specific segments as well? Your cranes, material construction, as well as your agri, what would the respective margins be?
Yeah, I think we should be closing somewhere between 16 to 17% on a company basis, more towards 17%, I would believe. And out of this, the cranes, construction, equipment handling segment should be around close to 17%. At agri, we should be close to about 4-5% by the end of this.
Okay. So you're expecting a margin improvement across the board?
Yeah, definitely.
Okay. That is about the present segments that you operate in. You had also forayed into defense sector. What has the demand been like there? Wanted to understand how much will that contribute as a percentage of revenues this year? Is the margin higher here? We are seeing a lot of order intake.
Last year, we did 2.5% of our revenue actually in defense. And with the current order pipeline in place, it should exceed at least about 3.5% in the current year as revenue share. But in saying this, I would also like to add that we are expecting one of our biggest orders from defense, hopefully within Q2, if it does not trickle into Q3. So that can help us even exceed 3.5% by a reasonable margin within the current year.
How big would this order be?
See, this will be somewhere between 300 to 400 crores.
Okay, 300 to 400 crores, and we could probably hear about it in Q2 or Q3.
Yeah, by end of Q2, but definitely by Q3.
Okay, and just quickly, you had also indicated that, you would probably look at inorganic plans in Q2, Q3, which will be outside of the country. Anything you can update us on that?
See, we did have some plans. We still have some plans on, as a matter of fact, but I think they've been deferred. There's certain other developments which are taking place, which I really can't discuss right now. Maybe in due course over the next 1 or 2 quarters, so that it will become more evident.
Okay, all right, Mr. Agrawal. So as and when there are more updates on this one, we'll chat with you again. But thank you so much for joining us today and giving us a sense of what the business is looking like and the outlook going forward. That's Action Construction Equipment. The stock, though, is down around 1.5% right now. We'll do one thing. We'll slip into a short break. As we do that, we are thrilled to announce the College Connect program under our ongoing season of HSBC Presents CNBC TV 18 Future Female Forward, the Women's Collective, recognizing college students as the leaders, opinion makers and change makers of tomorrow. The unique initiative encourages the youth to foster inclusive and diverse workplaces, drive gender parity and tackle societal and business challenges when they join the workforce. We are kicking off at IIT Delhi on August 3rd from 3 p.m. onwards with some of the biggest leaders and voices joining us. Stay tuned for that.
I would like to humbly state this. I'm sure all the members know that in a budget speech, if a state is not named, it doesn't mean that no money goes to them. And therefore, that was a misleading campaign, which, being in the opposition, unfortunately, a lot of members did speak about. It pains me to know. It pains me to know that they could say that if you're not mentioned in the budget speech, your state gets nothing at all. I'm picking up on the budget speeches since 2004-5, 5-6, 6-7, 2007-8, and so on, sir. 2004-5 budget did not take the name of 17 states. I like to ask the UPA government members at that time, did money not go to those 17 states? Did they stop it? Then if they stopped it, they have every business to ask this question. I presume they didn't stop money going to those 17 states because they didn't name it. So when it is one thing for them, it's all right. When the same thing happens somewhere else, no, it's not all right, you've deceived. 17 states were not named in 2004-5. 18 states were not named in 2005-6. 13 states were not named in 2006-7.
Welcome back. Well, stable for the market, so no problems coming in there. But let's discuss one of the big stocks of the day, Infosys. It's faced a demand notice from the DCGI and the Karnataka State GST authorities for tax evasion for a period from July 2017 to 2021-2022. Surbhi is here with the details on this.
Well, thanks for that. Indeed, Infosys has received 2 pre-show cause notices, and the demand in question, or the amount in question in the notice that it has been served by the Karnataka State GST authority is 32,403 crore rupees. There's also a notice by the DGGI, which is the Director General of GST Intelligence, which is a central level body. Now, what is in question? The issue in question really is the expenses which have been incurred by Infosys's overseas branches, whether there is any GST non-payment for the years concerned by these overseas branches. Infosys has responded. In fact, they've given a statement to the exchanges saying that they don't think that they're liable for any of these demands that have been raised, saying the service provided by the overseas branch is not subject to GST. Infosys is citing a circular that was issued in June of this year by CBIC. Therefore, it's saying that these expenses are not subject to GST at all. It's also saying that GST payments are eligible for credit against the export of IT services. Infosys says it's fully compliant, it has paid all dues, and there is sort of no issue at hand. That's what we know right now, but we need to see if this matter will be appealed further.
All right, so that's the update on Infosys. Thank you so much, Surbhi, for joining us with all those details. Let's take a short break now. Up next, Samir Dhir, the MD and CEO of Sonata Software, will join us to discuss the company's quarterly numbers. Stay tuned for that.
Were not named in 2007-8. Money didn't go to them. 2008-9, 13 states were not named. 2009-10, 26 states were not named. 26, which means only 2. Sir, oh yes, sir, if we are being blamed that only 2 states were named and the other states are not getting anything, 2009-10 budget had only 2 states, Bihar and Uttar Pradesh, and no other state. What does that mean then? It's all right when you do it. You didn't give money to those states which you didn't name. So, sir, you can't have it both the ways. You do one thing and then you blame the same thing on somebody else. What happens to the states which were not named? I'm asking now, 2009-10, 26 states of India did not have a mention. 2009-10, the full budget, 20 states. Interim budget did not have 26. The full regular budget, 20 states did not have it. So what does that mean, sir? They continue to ignore states. 2010-11, 19 states were ignored. 2011-12, 15 states were ignored, they didn't mention. 12-13, 16 states were ignored. 13-14, 10 states were ignored. So, sir, for that matter, the interim budget of 2014-15 ignored 26 states. Was there a noise? Did people say you ignored those states, you didn't give money?
We are very close to the due date of filing income tax returns, and if you're not done with it yet, let's tell you all that you need to know at the last minute for filing your return. Income tax return documents differ as per the earning sources of the tax filer, but certain documents are mandatory for every taxpayer irrespective of the income source. So let's talk about them first. PAN and Aadhaar number are the basics, of course, that is something you can't do without. But the other ones, Form 26AS, this gives you details of all the details of the taxes paid during a financial year on any transaction. This would include both TDS and TCS deducted. Second is the Annual Information Statement, or the AIS. This is more detailed version of 26AS and gives you transaction-wise details and also includes details of interest from fixed deposits and savings bank account as well. Also details of any shares sold. How do you get these two documents? Log into your account on Welcome back. Let's talk about more earnings now. Sonata Software saw its revenue and EBITDA margin surge in Q1 FY25. Profit after tax and other income, however, came under pressure. To discuss this and more, we have Sameer Dheer, the MD and CEO of the company, joining us now. Mr. Dheer, good morning. Thank you so much for joining us. Before we talk about the overall numbers, I specifically wanted to talk to you about international IT services, because this is where margins have fallen on a quarter-on-quarter basis by 300 basis points. This is when the wage hikes are expected in Q2. Can you give us a sense of what happened here and what is the outlook on margins going forward, considering that wage hike is still pending?
Yeah, good morning, first of all. And I think the results are much in line with our expectation that we guided for last quarter. We have come in at around 1.3% on the growth side. And on the margin side, our EBITDA for the international business that you alluded to is up by about 1.4% sequentially. So our EBITDA went up from about 17.3% to about 18.7%. So actually the margin has increased on the international business side. On the profit after tax, because we had Forex impact in the quarter, that's why the PAT has shrunk largely because of the Forex impact that we had. But the base health of the business has definitely been very robust and it improved quarter on quarter.
Okay, no, I just wanted to confirm the margin number in the international business. As per the calculations, it's at 18.7%, which compares with 21.1% on a quarter-on-quarter basis?
Yes, last quarter it was 17.3. It is now 18.7. So quarter-on-quarter it is up.
Okay. All right. So you're saying there's a margin improvement which has taken place in the international IT services segment on a Q-on-Q basis. But, you know, sir, it doesn't take away from the fact that it's been a weak quarter in terms of revenue. The reason I ask is that the last quarter you had indicated that, you know, growth would be between 1 to 3%. You've come in at 1.4% on a Q-on-Q basis, but that is lower than what was anticipated by the company at the lower end of the range. So if you could just take us through what took place in terms of the demand factors, what resulted in maybe the pressure that you probably saw this quarter.
Yeah, no, I think that's exactly what we anticipated as we were guiding for the first half of the year. If you recall, we had talked about that we are seeing some deal decisioning delay, especially on the large deals. And that factor was going to impact us for the first half of the year. We had guided that second half of the year will be stronger. And in Q1 specifically, the deals, we closed 3 large deals. And one of them is a fairly large contract for over 7 years as well. I think as we ramp up those deals, we'll see an uptick coming through in Q2, but largely in Q3 timeframe. So I think in Q1, Q2, we will still be between 1 to 3%, but we'll see the second half of the year much stronger than on revenue terms compared to the first half of the year.
So Q2, you're still going to be 1 to 3% in terms of growth.
That's right. We'll still expect Q2 to be into 1 to 3%, but we'll pick back in the second half of the year.
And the second half would be what then in terms of growth, considering that these 3 large deals that you've signed will probably start reflecting then?
Yeah, it's hard to put a number, but like you said, for the whole year, we'll be ahead of the industry average. We'll be significantly above the industry average, which we are still very confident that we close the whole fiscal year will be above the industry average overall. And the second half will be better than the first half from a growth perspective. That was our guidance, and we still sustain that guidance. Clearly, within the numbers, we have seen some significant movement in some of the industries. We've seen the high-tech industry come up. We've seen the healthcare industry come up. Of course, there are pressure in the retail side, but these two industries definitely come up, and banking has seen definitely some green shoots in the quarter. So we expect in the whole, the second half of the year still is very strong, which is what we had thought about a quarter back.
Okay. So in this pipeline that you spoke about, that retail is not doing so well, but the other spends have been going higher. What is the percentage of AI pipeline coming in here? And in that case, going forward, will you be looking at some acquisitions which would improve your AI pipeline? Anything that is planned in the rest of the year?
Yeah, so we're pretty confident about our AI positioning. As you know, we had launched Harmony.ai platform about a year back, and that continues to resonate well with our clients. And our overall AI pipeline is close to about 60 million. I may not have the exact number right now with me, but it's close to about 60 million or so. And within the quarter, we saw some significant wins. We saw about 9 mid-sized deals that we closed out on the AI side, which is very, very promising. So the POCs have now definitely moved to some early projects. And AI is also becoming an integral part of some of the large deals. The last 3 contracts that we closed in Q1, one of them has an AI platform we built in the first 2 years for the customer. It's a healthcare customer. It's a 7-year contract. So the first 2 years we'll build the healthcare platform out, and then the benefits from that platform will accrue to the customer in the following 5 years. So AI is definitely an integral part, but the standalone AI, we have closed about 9 mid-sized deals in the course of the quarter as well.
Okay, and what is the pipeline of closing further deals in the AI segment? And also wanted to ask you, you mentioned decision delays. Has that now evened out, and which sectors were you probably seeing that in? What's the status now?
Yeah, so I guess the overall AI pipeline is about 60 million or so for the company, which is still holding up. I think it's gone up from about 50 million last quarter. So quarter on quarter, not only we've closed 9 mid-sized deals, but we've also added the new pipeline, which is, I think, very promising and expected based on the investment that we made on the AI side. As far as the deal decisioning is concerned, I think you have to parse it into two categories, candidly. The large deals, I would say more than $10 million type deals are still taking about anywhere around 2.5 to 3 quarters to close out, which was about two quarters or so, maybe a year back. But the mid-sized deal velocity has increased. We're seeing the mid-sized deals close out slightly sooner now in some segments of the market, which is definitely a positive sign overall.
Okay. All right, Mr. Dheer, it was a pleasure speaking with you. Thank you so much for joining us today and giving us all those details. That's the word coming in from Sonata Software. They expect second half to be better than first half. It's time to get you an update on the IDBI privatization. We learned from sources that 3 potential suitors have been given fit and proper certificate by RBI for IDBI Bank. Ritu Singh is joining in with all those details. Ritu?
That's right, Sonal. We understand from sources that there are 3 potential suitors that have received this fit and proper certificate from the RBI for the acquisition of IDBI Bank, and those names include Fairfax Financial Holdings, Emirates NBD and Kotak Mahindra Bank, which have now been given the all clear from the Reserve Bank of India to proceed to the next step. However, our sources do indicate that Kotak Mahindra Bank may not pursue the acquisition of IDBI Bank at this time, given that it itself is undergoing, a transition phase. There's new leadership. It's also in the middle of that tech ban, which has been imposed by the Reserve Bank of India. So IDBI Bank acquisition may not be the top priority as of now. Now, my colleague Sapna Das had reported earlier that the due diligence process for the bidders will start in early August, and that the government is expected to call for financial bids for IDBI Bank before the close of the current financial year. Now, keep in mind the government is looking to sell about 60.7% combined stake in IDBI Bank, and that includes about 30.48% held by the government and 30.24% held by LIC.
Now, Fairfax Financial Holdings, as we know, has a 40% stake in CSB Bank, and if it does pursue this acquisition and emerges as the winning bidder, then as the promoter of CSB, it may potentially explore a merger with IDBI Bank. In the case of Emirates NBD, however, it will be a strategic acquisition. Now, we have reached out to all of the three entities for their comments, which are still awaited. Keep in mind, Fairfax India's public investments include significant stakes in CSB Bank, in IIFL Finance, IIFL Securities, 5 Paise, among others. And Emirates NBD, on the other hand, operates in India via 3 branches and serves retail, private, wholesale and NRI clients, and has total consolidated assets of a little over 6,300 crores and profits of 60.7 crores as of FY23.
Okay, a big story coming in there, Ritu. Thanks very much for that. But on that note, we need to take a short break. Once we come back, we'll be talking to the management of Saskin Technologies to discuss the quarter gone by. Stay tuned.
Then go to the e-file tab to view Form 26AS and Services tab to get your AIS. Now for the other income, that is capital gains, you will need to pay taxes. You can get the details of the capital gains that you have earned on sale of mutual funds or shares from your fund house or your stockbroker. This will be available online in your stockbroking account. This will give you details of all the share transactions you've done in the financial year with the amount of capital gains. Similarly, details of dividend income is also important to be considered while filing ITR, and this can be taken from the broker or demat account summary. Also, while AIS gives details of all the interest income that you have earned, always best to check it with the interest certificate you receive from banks. Again, these can be found in your net banking. This would have details of interest paid on home loans as well. Important if you have one, because that can be used to claim deduction in the ITR. This would also mean it's important to keep your home loan statement with you as well at the time of filing a tax return if you have one. Of course, for salaried individuals, Form 16 is another very important document to keep. It is for salaried individuals with details of all TDS deductions done by the employer. Disclosure of all active bank accounts are mandatory in the ITR. Bank account details like your bank name, account number, IFSC and number of accounts you hold must be quoted in the income tax return. Also, one account shall be selected as primary to assist the income tax department in refunding your tax refund by electronic transfer to such account. Also, some of the donations you have made to notified organizations, relief funds, charitable organizations that will be eligible for deduction under ATG. So keep that handy as well. Always good to file your return in time, but if you're late, this basic checklist could help you.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Welcome back. Well, for the markets just about holding 25,000, we've come off the levels now, but nonetheless, the milestone has been crossed in today's trading session. We're just about higher by around 0.2%. Remember, it's another record high for the markets. We did close at record highs in yesterday's trading session, so we've continued to build on gains despite that 25,000 milestone mark being met. But before we kick off the rest of the show, let me start with some good news. The numbers are out and it is final. India watched Budget 2024 with CNBC TV 18. CNBC TV 18's dominance continues as it knocks out the competition on Budget Day. CNBC TV 18 is the clear number one with 91.2% viewership during the budget speech. Yes, in fact, continuing its 25 years of leadership, CNBC TV 18 wins another gold on Budget Day. Thank you, viewers, for your consistent patronage, trust, and continued support.
Few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
All right. So these are
no
some of the
surprises
visuals.
there.
Yeah, some visuals from the budget day, of course, from the political setup to the big budget numbers to fiscal consolidation, some of the stocks that will be in the focus as well. We got you covered. So thank you so much for joining in for all the expert advices and quick and relevant and accurate analysis as well.
And you always want to stick with the leader on big days, 25 years of leadership. This is where people go when they want to watch that budget speech, want to watch the analysis of the budget, want to watch which stocks are actually impacted. And that's clearly visible in terms of the ratings. So 91% viewership during the budget speech. Those
Sound
are
of victory, right? That is what we would call it. 25 years of CNBC TV 18 and talking about this big number, 91.2% All India viewership during the finance minister's speech. So you know where to go on big days and on regular days as well, because we consider every day as very important for our viewers. Every minute, every hour of when you tune into CNBC TV 18 is when we want to make it very relevant and very value additive for you as well. So that's what that day looked like. A lot that happened and a lot that will continue to happen. But that's, of course, the big number that we are talking about.
Yes, absolutely. Our leadership continues through all the big events which have taken place this year, from the elections onto the budget now. But let's move on now. Technology is in focus after reporting, Saskin Technology rather is in focus after reporting its Q1 numbers. While revenue and EBITDA margins surged sequentially, total order wins declined. We have with us Mr. Modi, who is the CMD and CEO of Saskin Technology, who joins in to discuss the numbers, the way forward for the company. Mr. Modi, thank you very much for taking the time out. Well, just wanted to start with the new order wins, actually. They've come off compared to the run rate of the prior quarter. Any challenges in closing deals? And also just wanted to touch base on any kind of delays in terms of decision making, considering that one of the IT companies that we spoke to just before this, Sonata Software, said that there is some amount of delay in decision making, especially for mid-sized deals, which did impact them. So just wanted to get an idea in terms of, these new order wins and what the color is there.
Yeah, so morning, everyone. Thank you so much for having us with the channel today. Congratulations on you being rated #1 for the budget sessions that most of us watch. On the order book side, I don't think there's any worry whatsoever. It's in line with the plan we have been tracking and executing on. So we had the plan. Typically what happens in this quarter is the new orders are largely booked, but the renewals happen primarily in the third and the fourth quarter. So in our business, we see that as a trend. So no, to answer your question, while order book is 11.4 million, I think we have seen good momentum of order booking happening in our Saskin Silicon, which is the silicon arm that we recently have invested and created in. Similarly, we are seeing a good momentum across the verticals we are serving, largely in semiconductors, in automotive, in silicon design. In Japan, we're starting to see the momentum kind of pick up. So obviously, I think we are bullish in terms of the pace at which the order booking will continue.
Okay, so in that case, Mr. Modi, what would revenue growth and margin outlook be this time around? Just wanted to understand from a pricing perspective these new order wins that are coming in at, and what does that do to your revenue growth in FY25?
I think we have shown a growth of about 13% in Q1 over Q4. So we have seen a good momentum. And we continue to see a momentum around that. While we don't give guidance, I'm quite optimistic in terms of the growth trajectory that we are on, and to sustain the momentum. While it may not be possible for us to sustain 13% growth, but we definitely continue to see that we'll grow at higher single digits in the coming quarters.
Yeah. Yes, that's what I wanted to understand from you qualitatively, if you can give us an idea, because in the last year it was a decline. Before that it was a 3% growth. So it's high single digits that you're looking at in terms of growth in FY25. What about margins? What's the kind of band that you're looking at?
I think the margins primarily, like we said last time also, that once we reach a revenue of about $18-19 million per quarter, we should see about 13-14% EBIT. We continue to recruit. For example, we're going to add 150 new recruits, new freshers in this quarter. We also given salary hikes in this quarter. So we may see some decline in the margins, but we are on the right path in our execution on 60x4x3, and we are seeing good results around that. We continue to march on that momentum, and we are quite optimistic in the sectors that we are serving, the engagements we have with our customers, and building the growth trajectory, growth momentum.
So how much can the margins probably decline to? You did around 4.2% in Q1 FY25. That was an improvement from 1.9% in the previous quarter. So give us a sense in terms of where the margins would probably be if you are expecting lower margins.
I think I may not be able to give a guidance on that in this, but we may see a decline of maybe a couple of percentage points in terms of the margin in the coming quarter.
Would it be as low as Q4 of FY24, where you did 1.9%?
Because we are investing in growth, and we are very conscious of the fact that we are signing deals that are accretive, as well as in the long run, it's going to help us. So focus is singularly on growth, ensuring that we are not signing any stupid deals, and we are confident of that, so that we are spending monies below the line on the bench, as well as capability building, and also investing in newer areas, particularly the ones that are impacting or expected to impact the vector of technology innovation. So we're investing in 5G, 6G, we're investing in AI/ML that are specific to, say, instrument clusters inside automotive, and in the telematics, and those areas which I think are going to be the vectors of growth going forward for us.
Okay. All right, Mr. Modi, thank you so much for joining us today and giving us all those details. That's the word coming in from Sasken Tech. They expect high single-digit growth in revenue going forward. Margins might see a decline in Q2, but that's largely because of these investments and wage hike as well. Well, with that, we'll do one thing. We'll wrap on this edition of Trading Hour, but stay tuned. Halftime report is up next. A lot of action in the markets. You don't want to go anywhere. Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year. with new milestones being achieved on the Lad Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18, weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16%.
The benchmark Nifty finally tops the 25,000 mark. Utilities, energy, metals are the key gainers, even as realty and auto drag. It's the mid-caps which underperformed today.
Infosys receives a show cause notice for a hefty 32,400 crore rupees, which it counters, saying it is fully compliant with regulation and eligible for refund against exports. The company is in the process of responding to the notice. The street shrugs off the claim.
Maruti pips street estimates and points to a pickup in rural demand, as well as a shift to SUVs from small cars. Also sees exports picking up and draws plans to launch 10 new models by 2030. Analysts give the stock a thumbs up.
M&M CEO Anish Shah argues there should be a conglomerate premium vis-a-vis a holding company discount for an entity like the Mahindra & Mahindra Group. He adds that there's more scale left in the combined tractors and SUV businesses with synergies in technology and talent.
India's Q1 tax collections are up 26%, while income tax is up 50% year-on-year. However, the government capex is down 35%, while core sector for June also flags to 4% versus 6.4% in May. You're watching us here on Halftime Report, and at halftime we have the Nifty at 25,000, holds on to 25,000. I'm Mangla Malu, with me Surbhi Upadhyay, and as we speak about Nifty at 25,000, let's give you some good news as well. The numbers are out, and it's the budget numbers that we're talking about. It is final that India watched Budget 2024 with CNBC TV 18 on CNBC TV 18. In fact, CNBC TV 18's dominance continues, and it knocks out the competition on Budget Day. CNBC TV 18, the clear number one, with 91.2% viewership during the budget speech.
Yes, in fact, continuing its 25 years of leadership, CNBC TV 18 wins another gold on Budget Day. Thank you, viewers, for your consistent patronage, trust, and your continued support. So some good news to share as we kick off the show. And some good news when it comes to Maruti, because Maruti's numbers have been very well received by the market. The company has posted a strong performance in the first quarter, beating street estimates. Maruti points to a pickup in rural demand as well as a shift to SUVs from smaller cars. Our colleague Vivek caught up with Rahul Bharti, Executive Director, Maruti Suzuki, to discuss the company's first quarter performance and began off by asking him about the moderation in the demand environment. Listen in.
The demand has been slightly muted this year right from the beginning, and that was fairly known, and we had announced it also. The industry body, SIAM, had given out a forecast of a low single-digit growth for the year. But that's perfectly all right. I mean, it's not a cause for worry because India is at a high level of about 4.2 million cars, the domestic market size last year. And with such high levels, once a while, the market does take a breather. And India has a long-term potential, so a few quarters here and there don't matter much.
Okay, so going forward, even though there could be a little bit of demand moderation, you continue to remain quite positive. Now, next up, give us a sense of the breakup. Number one, in terms of the various segments that you're present in, how is it that the SUV segment is doing? We understand it's potentially giving a much higher contribution to the revenue mix. And number two, yesterday in the conference call, you've also indicated that the rural segment demand has been higher than urban. So give us a sense of the demand trend.
Okay. So, see, it is true that for a long time, for us, the rural has been performing better than urban. And I hear recently that two-wheelers and FMCG sector has recently picked up for rural. But for us, rural has been doing good for quite some time. In terms of the domestic market segmentation, the SUVs have gone up from about 50% to 52% of the market. Vans are at about 8 to 10%, sedans at about 7 to 8%. Hatches are also slightly degrowing. They have gone down by about 2%. So that trend towards SUVs is continuing.
What clearly stood out in Q1 has been the very strong expansion as far as EBITDA margins are concerned. So both the ASP as well as margins were a positive surprise. Now going forward, car makers like yourself have started giving discounts. So will we expect some demand moderation? After that, also some margin contraction that could come in on the back of these discounts that car makers like yourself are giving?
See, in this Q1, at least as far as margins is concerned, there was no one-off. There was an expansion sequentially from Q4 to Q1 by about 30 basis points, which was, of course, the resultant of several factors, raw material, of operating income, of manufacturing and admin efficiencies, etc., and some negatives also, like operating deleverage because of volume shortfall in advertising costs, etc. So there was a sequential 30 basis points expansion. As of now, we don't see any major challenge going forward. Of course, the uncertainty is always there going forward into Q2 and Q3. And on discounts, it will depend on the market conditions so far. Q1 itself, the discounts were up with respect to last year and last quarter. the previous quarter, which is Q4, the discounts were slightly higher because last quarter there were some supply bottlenecks which have now been removed. So on discounts, we'll see as the market goes.
Understood, sir. Give us a sense of the competitive environment too. What kind of market share do you think you can sustain at the end of FY25? And going forward, next couple of years, what is the kind of market share trajectory you envisage?
See, we used to be at 50%. So our long-term goal, let's say by the end of the decade, is to get back to that figure. And if we have the right set of products, the right set of technologies with all the benefits that we have in our service network, it should be we should be getting back there. Of course, it's difficult to predict in the short term. But at least we would like to improve from here on.
So you've guided the street that from calendar year 2025, we will see one new electric vehicle launch till 2031, and also yes, and also a couple of new ICE launches as well. So given the strong launch pipeline, what kind of growth targets are you setting for yourself, at least in the near term, in terms of revenues?
So we have mentioned that by 2030, we'll have about 28 models in all, 2030-31, and about 6 of them will be EVs. And if from now, let's say from next 25 to 31, we have 6 EV launches, so that's practically on an average 1 EV launch every year, practically. So, and other than these EV launches, there will be other technologies also in hybrids, in ethanol, in flex fuel vehicles, in CNG, CBG, etc. All clean technologies we would like to be present in and increase our presence.
So one last question from our end. Do leave us with a comment as far as the tax policy on hybrid vehicles are concerned. What is the latest that you're hearing from policymakers on this? And if you could also quantify the kind of benefits that someone like you could see in case we do see an extension of these kind of developments.
Policymakers look at national objectives. They do not look at specific companies or individual business interests. There are 2 national objectives that are important at the moment. One is oil import reduction, and the second is CO2 reduction. Now, as far as hybrids are concerned, they generate about a 35 to 45% improvement in fuel efficiency. And they generate about a 25 to 30% reduction in CO2 over pure petrol or diesel engines. So that's a huge jump. And the benefit of this is the strong hybrid technology does it without the need of external charging infrastructure. So customer adoption can be really fast. Many policymakers are realizing it across central government and state governments. And we hope whenever they translate it into actual policies, that will have a very positive impact on this particular technology that was slightly at a backseat till now as far as policy was concerned.
All right, that was Maruti speaking about discounts in the first quarter, but no real challenges to the margins. Going forward, it will be important to track the new launches and what the SUV trend does as well. More importantly, from a stock market standpoint, we'll also look at the Hyundai IPO, which happens in the second half of this year, whether there would be any capital allocated towards that as well or not. The stock opened very well after an up move in yesterday's trading session. Now off the highs, still holding up in the green as we await monthly numbers coming in too. Take a short break, come back, we focus on the primary markets. The management of Seagal India joins in as the IPO opens today. Stay tuned.
Global GDP. Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage. Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
On the Map My India notice, see, we have put out a public statement that we will definitely respond to it publicly, and we think it is very opportunistic of them, and Ola Electric is not even in the maps business. You know, we are a group, we have 3 different entities in the group: Ola Cabs, Ola Electric and Ola Kritrim, and Ola Electric is not in the maps business. You know, there are opportunistic players across, so we will definitely respond to them at the right time.
Welcome back. Let's get chatting about the primary market. Segal's IPO opens up for bidding today. Segal is a Ludhiana-based EPC contractor. The infra player is offering shares in the range of 380 to 401 rupees a piece. Fresh issue is closer to around 650 crores. Majority of that used to repay debt and some to buy equipment as well. The MD, Ramneek Sehgal, and Group CFO, Bhagat Singh, joining us shortly. But we have Ms. Sehgal with us. Mr. Sehgal, you know, just a couple of questions first up. If you could tell us, you know, as of date, what exactly is the order book that you're sitting on? What is your execution pipeline over the next 12 to 18 months? And with the money that you will use to repay debt, what remains the debt on your books?
Hi, first of all, thank you so much for having me over. And our order book value is close to 9,400 crores. And if you talk about company is present in more than 10 states. We have a lot of verticals. If you talk about Segal, what Segal does everything what comes on the road. So starting from highway, expressways, elevated roads, then railway overbridges, railway lines, runway, metros. Above all, we do tunneling business also. So talking about the proceeds, 684 crores will be utilized to reduce the debt. About 99 crores would be used for machinery, and rest is general purpose.
Mr. Sehgal, so okay, since you mentioned the proceeds of the issue, let's go there first. After you pay off these borrowings, how much debt will still remain on the books? What is your current debt equity ratio, and where do you target it to be, and where do you want to bring it down to?
So, you know, the debt would be negligible. At the company level, it's around 600, and 414 crores will be reduced. So, I mean, it will be negligible. And other is a non-fund base, which we require it for all our bank guarantees, which we have to give it for performance bank guarantees or surety bonds at the time of the bidding.
Right. You know, your order book, you said, was close to 9,400 crores. If I look at the way your revenue has been, it's increased from closer to 900 crores in March 2021 to close to 3,000 crores now. What is your execution pipeline now? This 9,000 crores, over how many years does this get executed?
So the timeline for the execution of these order book is close to 2.5 to 3 years. So little background I'll give you. So last year we have done about 33% ROE and about 50% CAGR. And as a company, a 60% order book value is from structure work. So we have just completed more than 95% Delhi Saharanpur, which comprise of 11.24 kilometer of the elevated structure. It is one of the longest 6-lane elevated structure. Companies engaged in executing one of the longest 4-lane elevated, which is in Bihar, which is about 19 kilometers. The project is worth 1969 crores. And the project which we have already completed more than 95% is 1,500 crores. We are doing a bridge over a Kosi bridge, which is close to 781 crores, which is funded by ADB. And we're doing 2 metros, which is Kanpur and Agra, close to 815 crores. And we have quoted for one of the longest metro of the country, which is in Agra again for 1528 crores. And the competitors in that bid is L&T, Afcons, NCC. So you can understand we are not in any rat race. We don't want to do what a typical road contractor does. So we are going in a specialized league, specialized structure business where we want to do specialized structures, longest elevated metros, freight corridors, railway lines, tunneling, or any specialized job available in the country. Thank you. And I will add one more thing. Last year, turnover, our single tender eligibility has gone to 57 crores and EPC and NHI, and HAM projects is about 5,500 crores.
Coming to that, we need some more granular details. Shareholders want to understand, I mean, your future shareholders want to understand the model and the strategy. Now, your order book currently is 9,500 crores. Just small answer so we can get in more questions. You mentioned a couple of the recent bids as well, because I believe after elections, now the activity is starting to pick up again on the bidding side. What is your L1 book currently? How many orders are you L1 in?
9,000, So 9,400 crore is the present order book value available with the company. Our 80% of the order book value is from NHI. Rest is divided with the metro, Bihar State and Road Bridges Development, which is under ADB. And we are doing one runway also. So we have quoted for another 16,000 crore project, which is throughout the country, which has this metro project also. And so elections are just got over and bidding spree is again started. So we have availability of about 800 crores of spare BG and bid security, so we can bid up to about $10 billion.
Okay, so let me bring in Mr. Bhagat Singh as well. Mr. Singh, same question to you. We're looking for 2 numbers. I believe 9,500 crores is the contracts you've already won. That's in the bag already. What is the total value of orders which are in the pipeline where you might be L1? That's the number we're looking for.
So you know what? Answer this story. So it's very difficult to predict anything. We quote as per our EBITDA levels, the 2-digit EBITDA level. So I mean, we can bid more. For us, we can bid in more verticals, we can bid in more states.
Right,
but
we get that point.
At EBITDA level, that's more important. And order book
we take that point. We take that point completely. We take that point. Your business has grown. You can bid higher. You have orders worth 9,500 crore in the bag already. You want to bid for specialized projects, move away from the road projects, etc., regulation projects. Here's a question from future equity shareholders of the company. Over the last few years, your revenues have grown, your margins have improved as well, but all of that has not translated into cash. I'm looking at your cash from operating activity. March 2021, you had CFO of 103 crores. In March 2022, it was a negative 135 crores. March 2023 was a negative 73 crores. In March 2024, it was a negative 211 crores. So all your orders, all your revenues, all your EBITDA margin, unfortunately not reflecting in the cash flow from operations. What is the plan for that?
Great. Bhagat will answer this question. Since he's the CFO.
Good morning. Good morning, everyone. Thanks for arranging this interview. So before I reply to your query, what is important is we need to understand the business model of the company. The first business model is EPC, wherein whatever we bill to the authority, that is NHAI, we get the collection on a monthly basis. So there is no receivable in the books. But as far as the cash flow from operations is concerned, which you are discussing, so these cash flow from operations are negative on the console level. So console level means it includes the cash flow from the parent company as well as the cash flow from the SPV company. The SPV means HAM project. In the HAM project, whenever we execute a project, 40% of the amount is received during the execution period, and remaining 60% of the amount is received over a period of 15 years in the form of annuity. So slowly and slowly, when we progress, when we execute the HAM project, the receivable in the HAM project increases, and when you calculate the cash flow from operation of the SPV, it turns out to be negative. That negative is in the form of accounting treatment. It doesn't mean that the cash flow of the company is negative. I elaborate it further. Standalone cash flow from operation of the Seagull India Limited, they are positive from the last few years, post working capital changes. The HAM project which we are executing, on account of the model of the project, if we execute a 1,000 crore of a project, we are going to receive the 40% of the amount of the work done during the 2 years. Remaining, the authority pay us in the form of annuity in the next 15 years, along with the prescribed rate of interest. So slowly and slowly, as and when the work completed, the HAM receivable increases, and ultimately the cash flow from operations also turns out to be negative. But this is just an accounting treatment. It doesn't mean that the executed work cash flow is negative. The work executed cash flows are positive. And just to give you a further strength line, apart from the cash flow from operations which are positive in Seagull from the last few years, the Seagull cash flow got a further support from the SPV because the HAM project which we have already executed and completed, we are getting an annualized annuity of 80 crores for the first HAM project, and in future, as and when the HAM projects will be completed, it will further strengthen the cash flow of the entire group in the form of annuities. Thank you.
Which is Mr. Singh, which is exactly what I was coming to, because over the years we've seen that most infrastructure players, they are preferring to go via the HAM route because you have that 40% inflow coming in straight up front, right? Now your mix between EPC and HAM, from what we see right now, is still more skewed towards EPC. 61% of your book is EPC, it's lesser HAM. So just tell us, I mean, in the future, are you planning to bid for more HAM projects? And if yes, how does this mix change? And more importantly, we are bothered with margins. Now, at the EBITDA margin level, your margin profile has improved to about 17%. What is a run rate that you're targeting, sustainable run rate, say over the next 1 to 2 years?
Well, two things I would like to elaborate. Number one is, for us, what is important is we are not into any order race. We bid for a contract on the basis of the targeted EBITDA margins, which is prescribed by the management, both for EPC, which is a double digit, and also for the HAM project. So our motto is, whenever we bid for a project, this prescribed targeted EBITDA margin has to be taken into consideration while bidding. This is the first part. Number two, ma'am, we are more keen to work on pan-India basis wherever the profitable contracts are available for execution. Since the Seagull pre-bidding qualification is 3,700 crores for the EPC and 5,500 crores for a HAM project, which is one of the most highest bidding qualifications. We believe that the competition would be quite less and Seagull will not face any issues while tendering. Further, number 2 point, ma'am, as you asked me, what will be the trend of the future margin? So since my company is into IPO, we can't talk about the future profitability, but yes, we believe that the company, since we are following a uniform philosophy since inception, so we believe that the work executed in future we may be able to turn out the profitability which we already achieved in the past.
Wonderful. Mr. Sehgal, Mr. Singh, thank you so much for joining in, explaining your business to us, talking about what your plans are going forward as well. But, we wish you good luck. Once you list, we'll invite both of you all to join in, and that time we'll press you for a lot more numbers around, your earnings, etc. as well. Wish you good luck. With that, we take a short break, and as we do that, we're thrilled to announce that the College Connect program under our ongoing season of HSBC presents CNBC TV 18 Future Female Forward, the Women's Collective, recognizing college students as the leaders, opinion makers and change makers of tomorrow. This unique initiative encourages the youth to foster inclusive and diverse workplaces, drive gender parity and tackle societal and business challenges as well when they join the workforce. We're catching them young in the colleges itself. We're kicking this off with IIT Delhi on August 3rd from 3 p.m. onwards with some of the biggest leaders and voices joining us. Stay tuned.
markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV.
You're watching us on Halftime Report here, halfway through the trading session. Perfect time to get you a peek into what the market looks like right now, especially from an F&O standpoint. The Nifty hit the 25,000 mark earlier and now has fallen below that 25,000 mark. And that's largely because of the Nifty, seeing some bit of profit taking. The Nifty Bank also falling off highs. In the mid-cap index, that's been a bit of a problem pocket, down about 0.75%. And that's, exacerbated if you look at the way the advanced decline ratio has been. We had more stocks advancing at the start of the day, then at some point we had an intersection, and now the decliners are a lot more than the number of stocks which are advancing, and that makes us look at how the market would be in the second half of trade, especially because it's weekly options expiry on the Nifty as well. And the jostle for 25,000 continues. 25,000 put writers are pretty active now. They're covering some of their positions at a premium of 30 rupees, so we may see some further sell-off. And at the same time, the 25,000 call writers, they've come back, and we've seen some action at the 25,000 call as well for a premium of 25 rupees, telling you that those who are writing both 25,000 call and put are looking at a range between 24,950 to 25,050 itself. Were the range to break in or break out, we would see further moves on either sides as well. The stocks that are on my radar today, India Mart and Birlasoft, both of them have seen huge open interests beyond the market-wide position limit. So these are the stocks which may go into F&O ban today. I'll keep an eye out on them.
All right, Mangalam, thanks for that quick run through. Let's now go across to Aditya Agarwal. Aditya, what are your trades for today? Stock ideas?
Hi, good afternoon. Thanks so much. So, markets are a little wobbly, as Mangalam also pointed out. So I'll go with a long and a short trade because clearly there's a tug of war between the bulls and the bears at the moment. 24,950 is a make or break level for me. If that is held, maybe in the second of the trading session, we can see a short covering rally And within all this, I think Bank Nifty could be the joker in the pack. If Bank Nifty starts to hold on ground and starts to outperform from here on, we can actually see some kind of a short covering rally towards the end of the trading session. So considering that, I've got two trading ideas. One is from the banking space. It's a long trade in the Axis Bank. Because stock has seen a decent correction of late, and I believe offers a good risk to reward at current levels, has come to support levels. At current levels, one can initiate a fresh long position for a target of 1250 on the upside, with the stop loss at 1125 on the downside. The second stock is the sell in HAL, Hindustan Aeronautics. And now this is one space which has seen massive outperformance, and off late we're seeing some kind of a cool off and maybe a distribution pattern, I can say, on chart structure. So I believe there is more downside in HAL, so one can go ahead and short the futures as well at current levels for a target of 4,500 on the downside, with the stop loss at 5,000 on the upside.
Okay, all right, got that. Thanks very much, Aditya, for the trades for today. We'll take a break on that note, come back on the other side, and we'll get you more on the markets as well as a special conversation lined up. We'll have K. Ramakrishnan of Kantar to focus on demand trends in the FMCG sector. Stay tuned for that chat.
On a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18, weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
It's a volatile, wobbly market. The Nifty is all but in the red right now. But one spot of green in this market is FMCG. In fact, it's been holding up one end for the last 10-15 trading sessions, and that's largely on account of good outlook coming in from the rural part of consumption. The FMCG index at the high point, even as the Nifty is at the low point of today's trading session. What's doing well in the FMCG segment? We're talking about three themes here. One, the rural challenge. Are we coming out of the rural challenge? 65% of households and 52% of volumes come in from rural India. The second part is premiumization and urban premiumization in particular. Urban consumption has been holding up FMCG for the last couple of years. Has that hit a growth wall or not? And the third one, of course, we're looking at these big, specialized changes coming in, specialized ingredients, convenience channels like quick commerce, a lot of local brands, etc. doing well. So with all these three as a troika, let's get discussing with Ramki of Kantar World Panel Division in Asia. Joins in. He's been an expert tracking the space for a while. We're happy to have you in the studio.
My pleasure.
The first question obviously is rural. Every company so far has been talking about there have been green shoots of rural recovery, and they expect it to be a full-blown harvest towards the end of this year.
Yeah.
What have your data points on the ground level indicated?
Absolutely. So always rural has had a lag against urban. I mean, if you see COVID, urban saw COVID in 2020, rural was 2021. Inflation was earlier, rural was later. Similarly, the recovery of rural from inflation also has been later, and which is why we are beginning to see some green shoots in rural. And that has resulted in the last 2 quarters, the growth rate in rural overtaking the urban growth rate. That's one. Second is all the macroeconomic factors, which is typically what would you look at in rural? You look at monsoon, harvest, non-farm employment, and you look at support pricing. All of them are at the moment seemingly very positive. So given all of these and the fact that there is a line which is pointing that we tend to believe that rural is poised for a little more growth than where it is right now.
Some numbers, growth would be what?
So at the moment, it's rural is at 4.2% and urban is at 3.9%. We expect rural to go up to 6 by the end of this financial year. So that is the big hope for a lot of.
And how would that compare to, say, pre-COVID, the normal before COVID?
No, before COVID, if you go back to 18 and 19, rural has touched double digits, right? It was in 11, 12. One is not able to see at the moment immediately whether there is any time frame by which we can look at those kind of growth rates, but definitely 6 is looking feasible in the next 7 months.
6 is looking feasible, and you've also attributed stability in macros bringing seismic shifts in rural demand. So 4.2 turning into 6 on that base, not particularly bad. Let's talk about the other part then, urban, because urban has been leading growth for the last 2 years, if not more than that, and urban premium in particular. Now everyone's talking about consumption fatigue, middle class pockets being pinched, etc. What happens to urban consumption? I mean, premiumization as a theme, is it still on the cards or is it hitting a bit of a roadblock?
Right. So we earlier spoke about rural and how that's the hope. Rural is always a penetration-led growth, right?
Yes.
Getting into more households with a new brand or a new category. Urban, yes, there is room for penetration growth, but more than that, it's going to be consumption growth or price growth. Those are the waves that one sees in urban. In urban, there are some positives to look at. I mean, it is flattish at around 3.8 to 3.9 kind of numbers. But the good parts in this are that the premium end is seeming solid. And so therefore, every brand, every company has a portfolio. And the numbers are going to come from the volume, the spends towards which on driving penetration is getting more and more. And that has to be compensated by something at the top, which is definitely kicking in quite well. And that's why the premium end we are talking about. Where are the premiumized categories working better? Categories which make the life of the consumer better or which make convenience-oriented categories are doing well, and to some extent health-oriented categories towards this spend. Yeah.
Okay, and categories which make you feel better or look better or become prettier, right? So beauty and personal care, I'm sure. So just to sort of map this to the listed universe, and I think over the last 1.5 years, the problem is that these are great companies with great cash, but no growth or very low growth, right? 2-3% growth at rich valuations. Do you see that changing? I'm not asking you a buy-sell question, but the question is there another kicker somewhere around the corner for the listed FMCG universe?
Right. So the FMCG world is like, I mean, if you take a 20-year universe, I mean, we've all been seeing that it's always lagged the growth in GDP, right? GDP growth versus FMCG growth, always there's a lag. So therefore, what is happening in the FMCG world is that the money, there is a basket of money available with the consumer, but it's going towards a lot of things. It's going towards telecom, it's going towards healthcare, it's going towards, so that money is not getting, the consumer is not getting attracted enough by FMCG to spend that money.
Which is a point even for rural, and that's one part of the debate, that when there is more money in rural India, whether that money will be spent on buying maybe jewelry from the nearest Tanishq, or maybe a premium car, rather than more spends on toothpaste or a better soap. So I think that's a real debate.
So when there's more money available, one end is the premium car. I'm saying there's the other is to build some mobility. Two-wheeler, tractor,
aspirational
or
rural India.
all of those. And even healthcare. I mean, the increased awareness of healthcare, and so therefore spending on healthcare, etc. That takes away money that comes into FMCG.
Absolutely.
So I think a task for FMCG companies is cut out in terms of how to make it more interesting and exciting for the consumer to part with that little bit of more money. That's where it is.
I would assume a lot of the money is also taken away by, cell phones and the internet data costs on a month, 400, 500 rupees taken out. That's taking away from the consumption of FMCG products or better consumption out there as well. Final question then before we let you go. What are the categories and companies of the future according to you? This is again not a buy-sell recommendation. And is the wave of D2C on the wane after funding winter coming in? We've seen a couple of successes out there, a couple of good listings too. But by and large, what are your thoughts on D2C and categories and companies of the future?
Yeah, so in terms of categories, I would say that the wave that we saw with Swachh Bharat for home care, which is for toilet bathroom cleaners and insecticides, that wave to some extent is continuing for sure. In personal care, definitely the premium end is something that one needs to watch out for. And in food, the convenience foods, biscuits are definitely categories to watch for. That growth is definitely continuing. Snacks are a little bit of stress. I mean, after a lovely 5-year ride, snacks are in a little bit of a slowdown at the moment. Companies, I won't be able to name them in terms of what.
All right, you spoke about biscuits doing well. Incidentally, Britannia reports its numbers tomorrow. The street expects them to have about 7 to 8% sort of volume growth. So, Ramki, thank you so much for joining in, giving us a lowdown on what the FMCG sector looks like. The headline from here is that rural may actually grow at 6% by the end of this year itself. We take a short break, come back, talk about markets and more stock-specific action on the other side.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage. And what a great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Welcome back here with us on Halftime Report. Well, let's talk more about some primary market action. FirstCry's parent Brainbee Solutions will be launching its IPO on the 6th of August. FirstCry, a brand synonymous with new mothers and baby products in India, has a gross revenue of 25,000 crore rupees and more than 9 million unique transacting customers. Our colleague Reema Tendulkar caught up with Supam Maheshwari, CEO of FirstCry, to discuss their growth outlook, their plans, and she started off by asking him about when the company will turn profitable. Take a look.
This is a very large industry in the first place. We are addressing $34 billion. India creates 26 million babies a year. And we will be $68 billion of the size of the market by CY28. And with such a large market which is growing at a 20% CAGR, it is bound that we will have a journey of our own. If you look at our India multi-channel, it's actually already profitable. We have been profitable for last 4 years in adjusted EBITDA basis. Our last year adjusted EBITDA was around close to 8.8% for FY24 for an India multi-channel business.
Let's talk about your gross margins. Your gross margins have ranged between 30 to 35%, which is lower than the direct retailers. Any of the listed retailers, they all have minimum gross margins of 40%. Why is yours lower? And you spoke about improving gross margins.
So we have been, obviously, all these years we have been improving gross margin. If you look at our gross margins for last 2 to 3 years, they've been improving year-on-year basis without having any year that we have not improved our gross margin. And this will be a factor that we will be able to improve our assortment mix, our curation, our investment in brands, our investment in our home brand strategies, which essentially will mean that we will be able to continue to compound our gross margins over a longer period of time. Our journey has just begun, although we may look like 13 years.
So 40% plus gross margins is possible, right?
Look, others have done it. We should be able to do it, but we will get there in our journey as we go along. I can't say for the future, but we will definitely strive to get there. It's not something impossible.
Okay. Let's break up your business into India, which is about 70% of your revenues. You have international presence in UAE and Kingdom of Saudi Arabia. And then you have a house of brands, D2C investments in 21 entities, which you house under Global B's. Now, India revenues in particular. Now, FY24 appear to be a bit of a slower growth for you. Reported revenues have gone up by just 7%. Your EBITDA margins are between 8.5% to 9%. Again, lower than the listed peers. What can you guide on the India business?
So look, we are not at a steady state. We are a new age, ecosystem modeled retail organization today. We believe that we will be able to, continue to grow in India as well as international and as well as in global B's, because some of the other adjacencies that we have done are very recent, very young. From a profitability standpoint, obviously we have grown meaningfully in India from, as I said, from 5.9 to 6.2 in FY23 and 8.8 in FY25.
That's
if you
the
look
margin.
at our that's adjusted EBITDA margin.
EBITDA margins, yeah.
Because that's how you should look at the company, because that's the operating adjusted EBITDA margins, and this will continue, and we are not at a steady state. I can only say,
so what are
when you
steady
compare
state
with
margins
listed,
for the India business?
Other listed players are at a very tall EBITDA margins, and we aim to get there. We are in our growth. We will be investing out of the use of proceeds that we will raise from the public markets. We will invest behind our brand, our technology, our supply chain, getting more customers, and with that we believe that we will be able to continue to expand our gross margins, our operating leverage, and through our marketing cost and so on and so forth, and essentially driving up the operating. Absolutely.
So what are tall EBITDA margins that you're comparing?
Look, they are in high teens. I mean, the good companies, we always, sort of benchmark ourselves to leaders who have done there and have become, So
aspirationally, which is that company?
Well, there are good companies. There are all good companies where...
Name two.
I like in person, companies like Page Industries.
Okay.
Yeah, I mean, that's one company I believe they've done very well in terms of EBITDA margins. Even for that matter, Trend.
UAE and Saudi Arabia, because that is bleeding for you. That's the biggest drag for you at the bottom line. EBITDA losses in the international business was 140 crore in FY24, 120 crore in FY20. How long will it be loss-making? Is there a turnaround plan? What is your turnaround plan?
We started in UAE in October 19 and in Saudi Arabia and Kingdom of Saudi Arabia in August 22. And we have not even finished 2 years. This month we will finish.
So how long does it take to turn around?
So it will be a couple of years, as the journey has been in India.
So India took how long for you to turn around?
Well,
if you
India
want to
took-
copy the same playbook.
Well, India took a little longer because we started from scratch,
Okay.
right? And in international markets, it won't take that kind of long time because we took all our strengths at a platter, right? And then actually we have done all, the hard work of building our supply chain, our tech
So 5
platform,
years,
brand.
10 years from now?
No. I don't think that's too long.
It's too long.
It's
Not
too long.
even 5 years. It should turn around before that.
Well, much earlier than that.
Next year?
No, I won't say that.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
On the Map My India notice, we have put out a public statement that we will definitely respond to it publicly. And we think it is very opportunistic of them. And Ola Electric is not even in the maps business. We are a group. We have 3 different entities in the group: Ola Cabs, Ola Electric, and Ola Kritrim. And Ola Electric is not in the maps business. There are opportunistic players across, so we will definitely respond to them at the right time.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain.
Welcome back. We're talking about big earnings today. Adani Ports, as we speak, at the bottom of your screen, 47% jump in the net profit. Of course, we had a quarterly volume update coming by, so we'll get in some more details. As of now, the stock mildly in the green. Another earning that we're looking at is ITC. Stock up 16% in the month of July. No tax hike in budget. Improvement in outlook and valuation aids move. Stock at around 28 times. What is it that the street is expecting? 2 to 3% growth in cigarette volumes, 7 to 8% growth in FMCG revenue, 8 to 9% increase in hotel revenue, and 0 to 2% growth in agri revenues, whereas there will be a decline in paper business on account of macro weakness. Put all of that together, overall you're looking at a revenue growth of about 5.5%, 16,700 crores on the top line, 6,400 crores on the EBITDA, and the net profit at around 5,100 crores. We'll keep an eye out on all of this as we look at numbers at the bottom of your screen and look at numbers that will be reported as well. That's about ITC, and that's all the time that we have on this edition of Halftime Report. Thank you for watching.
India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18, weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to
The benchmark Nifty index finally tops the 25,000 mark for the first time. Utilities, energy and metals are the key gainers, even as real estate and auto drag. Mid-caps underperformed today.
Infosys receives a pre-show cause notices for a hefty 32,400 crore rupees, which it counters by saying that it is fully compliant and eligible for a refund against exports. The company is in the process of responding to the notice. The street shrugs off the claim.
Maruti Pip Street estimates and points to a pickup in the rural demand as well as shift to SUVs from small cars. It also sees exports picking up and draws up plans to launch 10 new models by 2030. Analysts give the stock a thumbs up.
M&M CEO Anish Shah argues that there should be a conglomerate premium vis-a-vis a holding company discount. He adds that there is more scale left in the combined tractors and SUV business with synergies in technology and talent.
India's Q1 tax collections are up 26%, while income tax is up 50% year-on-year. However, government capex is down 35% YOY, while the core sector for June also flags to 4% versus 6.4% in May. Hello there and welcome to Business Lunch. I'm Nisha Podar. With me as always is Hormaz Patakia. So Hormaz, finally 25,000 mark has been mounted by Nifty 50, and that is some relief coming in from the market. Spot watchers who have been looking for the key indices with key target points. But at the current moment, let's take stock of the market. Nifty 50 just at a kissing distance to the levels it achieved, but closer, remember, to the low point of the trading session. So there's fair bit of profit booking that has been seen. Bank Nifty is outperforming the key indices today, revved up also by the heavyweight, which is HDFC Bank. Reliance Industries is also gaining with 0.25% gains. That is also impacting and is contributing to Nifty 50 staying in the green, while mid-cap universe, that is taking a beating today. Of course, profit booking at this point, 0.7% down. PSUs are having a good day.
Dera hai, durust hai, better late than never, whichever you'd want to use is. That's for the Nifty, 25,000 finally, but the index is holding up in the green. But as Nisha was mentioning, the broader market's not having a very good day. Pressure coming in from the real estate stocks. The Nifty Realty Index now down almost 2% as we speak. That is at the low point of the day. The losses also coming in from the metal space, and select PSUs are seeing some bit of profit booking as well from higher levels. Be it the like of HAL, BEL, all of them seeing losses of close to around 2% in today's trading session. But a milestone is a milestone, and we'll begin the show by focusing on that. The Nifty topping 25,000 today, 24 sessions to the last 1,000 point rally. Mangalam is here to track that journey to 25,000.
Well, 25,000 is actually just a milestone in what is otherwise a long journey for the Indian equity markets itself. So I just thought it's a good time to look back and track that journey itself. The index started in April 1, 1996 with a base of 1,000. Over the next 11 years, in September 2007, it moved to 5,000. Between 96 and 2007, we of course had the IT boom, the IT bust, the Asian financial crisis, the big bull run as well. And then from there, we had the great financial crisis of 2008. Between that and 2017, the Nifty doubled again to 10,000. Thereafter, in quick succession, it moved to 15,000, 20,000. And now as we speak, we are sitting on Mount 25,000. Between 10,000 and 25,000, we've had GST, we've had demonetization, we've had a couple of elections, we've had a couple of wars, we've had the major pandemic as well. But the cult of the equity market and the market kept moving on. So what it teaches you basically is that over the long term, irrespective of the events that are taking place in the near term, the Nifty has compounded at 12% since inception. What does this mean? It's doubled every 6 years. And what does this coincide with? For the last 23 years, the Nifty EPS itself has compounded at 12%. So whatever happens, if the earnings are moving in a certain direction, the market eventually will catch up. So at 25,000, the index trades at 22 times FY25 price to earnings. This is something that we will monitor going forward as well, irrespective of, again, the events. The last 5,000 points is what we're tracking right now in terms of moves. They've been led by, the PSE index, the public sector enterprises, the realty stocks, oil and and gas, as well as some of the auto stocks as well. What hasn't participated as much in the last 5,000 points has been the IT index, the FMCG index, and the Nifty Bank, while they've moved, but not to the extent of the others itself. It's been a broad market rally. So SME IPO index is up 165 points. Small cap and mid cap indexes up anywhere between 40 to 50% itself. The top Nifty gainers, Bajaj Auto, Coal India, M&M, ONGC, basically IT, realty as well. You have PSEs, realty and the others. And if you look at the underperformers there, Bajaj Finance is actually down 8%. Asian Paints, IndusInd Bank, HDFC Bank, the biggest of the banks, down by about 1% over the last 1 year or so. But I've said it's a broader market-led rally. So we have Oil India, NBCC, Trent, all of them nearly trebling in the last 1 year or so. Oracle, Amara Raja up 150% as well. And here too, we've had a couple of notable losers. Z down 50%. We've had Navin Fluorine down 20%. PVR Inox down about 15% as well. With all things said and done, as we sit atop Mount 25,000, what are the things that we are tracking going forward? One, will FIIs return to buy in cash market? This has been a largely DII-led rally. Second, now with the outperformance of the mid-cap stocks, is it time for large caps to take the baton and move forward? The third thing that we're watching out for is increasing retail participation in domestic SIPs. Does that continue in wake of all the regulations that are coming by as well? And finally, there are a lot of pockets of hefty valuations in the broader markets. Do they go away or not as well? And we obviously cannot discount the impact of geopolitics and global developments more on the market. So those are a bunch of things that we'll be watching out for from Mount 25,000.
All right, Mangalam, thanks so much for getting us all the details on what really led the market to that 25,000 level today. Moving on then to some important stock developments and company developments. We're talking about Infosys here, which faces a demand notice from the DGGI and Karnataka state GST authorities for tax evasion for a period from 2017 July to 2021-22. Timsi Jaipuria, our colleague, gets us all the details on the tax demand and where Infosys counter lies. Timsi.
Well, as you rightly mentioned, what we are picking up from sources is that the DG of GST Intelligence, that is the central agency which is monitoring a lot of these tax evasion cases, they have claimed Infosys for tax evasion of 32,403 crores for the period between July 2017 till FY 2022. Now, what we are picking up is that the DGGI's Bengaluru zone has issued incident report to Infosys on 30th July, and a copy of this incident report has been reviewed by CNBC TV 18. And according to that report, DGGI claims that the company has received services from overseas branches and has not paid IGST under the reverse charge mechanism on import of services. It further says, and I quote, overseas branches have supplied services to the company and same shall be treated as import of services by the company as per Section 211 of IGST Act. Also, to implement on-site project-related work, the company has set up branch offices outside India for the purpose of carrying out business. In view of explanation of 1 and Section 8 of IGST Act, branch offices shall be treated as an establishment in such foreign countries. Hence, the company and overseas branches would be treated as distinct person. So treating them as distinct person is when they feel this is happening. And in lieu of the receipt of these supplies from overseas branch offices, the company has paid consideration to the branch offices, and thus this demand has now accrued. Meanwhile, Infosys says in response to these claims that the company would like to clarify on this matter. Karnataka state GST authorities have issued a pre-show cause notice for the payment of GST of 32,403 crores for the period of July 17 till March 2022. towards the expenses incurred by overseas branch offices of Infosys. And subsequent to the publication of news, DGGI also issued a pre-show cause notice. The company is currently looking how best they can reply to this particular now claim, or to be precise, this new pre-show cause notice that has been issued by the center. So they are in process of responding to the same. Back to you.
Timsy, thanks a lot for that update there. No significant moves there in the stock of Infosys, 0.7% lower today. Time for a short break here on Business Lunch. Up next, we get to the takeaways from the Fed's latest meeting. Stay tuned, back on the other side.
India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
On the Map My India notice, we have put out a public statement that we will definitely respond to it publicly, and we think it is very opportunistic of them, and Ola Electric is not even in the maps business. You know, we are a group, we have 3 different entities in the group: Ola Cabs, Ola Electric and Ola Kritrim, and Ola Electric is not in the maps business. There are opportunistic.
Back with us here on Business Lunch. Moving on to some macro data now. In some widely expected move, the US Federal Reserve kept interest rates unchanged last night. Fed Chair Jerome Powell said that the central bank would be ready to cut interest rates in September if the data continued to show that inflation is coming down.
If we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision. The thing we're trying to do is, that we have we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate.
Right, so expectation building of a September rate cut in the US and lots of macro data to come together in that decision making is what Fed Chair said. All right, keeping it with the macro news, well, the first quarter data on India's fiscal numbers and core sector are out, and the April to June data shows that the tax collections remain excellent. However, the economy doesn't seem to have done as well, with the core sector slowing, especially in the month of June. Lata Venkatesh is right here with all the details. Lata.
Excellent tax buoyancy. We saw that last year as well, and that's continued in the first quarter. The central government April-June gross taxes are up 23.7%. What it comprises, of course, is direct and indirect taxes. Direct tax are up 40%. Within that, income tax is up 50%. Mind you, that includes, of course, capital gains, STT, everything. Corporate tax is up 26.2%. But capex has been down 35% compared to the April-June of the previous year. That's not very surprising because government sign-off is required and there was no real government till the 4th of June. But the fact that June itself was lower is a disappointment. As a result, the positive, of course, is that fiscal deficit is also down because revenues are good and expenditure is low. The disappointment on the economy really comes not just from the low capex spend, but also the core sector data. The June core sector itself, only for the month of June, it's actually downright disappointing at just 4%. In May, we had managed to grow by 6.4% May over May. But if you took April, May, June together, then the disappointment is there, but it's not so stark. Versus 6% last year, this year we have managed 5.7%. The best performing sectors, both April, May, June and June, have been coal and power. Excellent double-digit numbers, not just for June, where they have grown by about 16%, but even for April, May, June. The other sectors have not done very well in June itself. Cement is particularly bad. April, May, June, coal and power have done, of course, 10%, like I told you. Steel and gas also have done well, about 6%. But the other sectors, particularly cement, has grown at less than 1% in June and about a little over 1% for the 3 months. So perhaps that ties in with the poor capex spend as well.
Lata, thanks a lot for taking us through that core sector update. Time for a short break. Up next, we get you the latest on the Wayanad landslide tragedy. Stay tuned. Back on the other side.
We will definitely respond to them at the right time.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain.
Welcome back. You're watching Business Lunch, and Nifty 50 back at 25,000 levels. Now, moving on to some of the important national updates, the devastating landslides in Wayanad has now claimed over 200 lives, with countless still missing. Kerala's Chief Minister has reached Wayanad to review the situation at the disaster site and chairs up a high-level meeting with the authorities. CNN News 18's Harish joins us with more updates on the landslide-stricken district.
It's day 3 of the rescue operation here at the landslide hit Wayanad, where more than 256 autopsies have been carried out so far. This even as the government fears that there could be more bodies underneath the debris trapped, especially in the Mundakai region. That is where the rescue work has gone at a slower pace because there was no bridge. The existing bridge was washed away. The Bailey Bridge is being built by the Indian Army. They're hoping by the end of the day they can ensure that that Bailey Bridge is up and working so that more men and heavy equipment can be moved to Mundakai region. In the meanwhile, the government is also worried about the tribal population that's up near the forest area in Mundakai. Health officials who reached out to them are saying that as soon as they saw the health officials, they got scared and they left the place. So the focus is also ensuring that help reaches the tribal population and tribal hamlets within the forest area. That's another cause of concern for the health department. Even as the rescue effort is going on, the government is also refuting allegations by Union Home Minister Amit Shah, who said that there were specific warnings that was given by the union government. The state government is saying there was no specific warning. It was generic in nature. There was an orange alert, and the state government had moved people who were in low-lying areas. Well, now the Army, the Indian Coast Guard, the NDRF, all of them are hoping that they can reach out to people who are still trapped under the debris, and they're hoping there's a miracle and they can retrieve people, they can save people who are still alive.
Tragic updates there coming in from Wayanad, and some more weather-related updates, this time from up north. And at least one person has been killed and nearly 30 others are reported missing after several cloudburst incidents in Himachal Pradesh. Search and rescue operations are underway in the affected areas. Now, drones are being used to locate the missing people. Home Minister Amit Shah has also assured the Chief Minister of assistance from the central government.
All right, let's take it to sports update then. Day 5 of Olympics was a good run for Team India, with shuttlers Lakshya Sen, HS Pranoy and PV Sindhu moving to the next round of the pre-quarters, while boxer Lovlina Borgohain grabbed a win on her debut bout. Now, the 6th day of Olympics will be a mixed bag of events. Today's the men's hockey team will go up against Belgium, and in badminton, HS Pranoy and Lakshya Sen will be against each other in the men's singles badminton, while PV Sindhu will have her round 16 clash today.
And let me end the show with some good news. The numbers are out and it is final. India watched Budget 2024 with CNBC TV 18. Now, CNBC TV 18's dominance continues as it knocks out the competition on Budget Day. CNBC TV 18 is the clear number 1 with 91.2% viewership during the Budget Day.
Yes, in fact, continuing its 25 years of leadership, CNBC TV 18 wins another gold on Budget Day. It's Olympic season, so we have that gold. Thank you, viewers, for your consistent patronage, trust, and continued support. With that, let's also get you a peek into what went behind the scenes in the making of the big day.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters. Our effort was to do something innovative, out of the box, yet comprehensive and substantive, and I think we delivered on the promise. Right from the morning when we rang the budget opening bell live from the National Stock Exchange to decoding the fine print with over 100 plus guests live on CNBC TV 18 with the budget makers, with captains of industry, and in an all-new format with AR and BR driving our budget coverage. We continue to be India's budget headquarters.
नहीं अभी रुक जाए यार अभी गेस्ट को बैठाने के लिए टाइम नहीं मिलेगा गेस्ट को बैठाने के लिए 6 5 4 3 3 वाले माइक अप करा दो 1
Are you sure she's talking about all this? And इतने 35 seconds में सारे graphics fire हो जाएंगे?
हाँ वो मैंने ले लिया that I have taken
करेगा बस कर ले
So what's the secret behind your energy right now?
Energy? I can actually show you here.
There is no energy and all that. There is just pure mastro.
No food. We're just about work now.
Tea. Tea is our energy.
This is our morning snack in anticipation for the budget.
I think a cup of chai.
We have coffee and buttermilk ready, so join us for all the analysis.
Expect a very good lunchbox.
It's budget day. It is expected to be crazy.
It is very, very chaotic.
I don't think one gets to sleep the night before.
It has been an extremely hectic day.
दीवान का भी है अरे मैंने मशीन ली हुई थी
All set, geared up for the big day.
Every single day when you walk into the newsroom, well, you get pumped up.
Standard deduction for salary employed 75,000 75,000 from 50,000 सारे स्टॉक नीचे है ओके तो 3 लाख कर दिया ना हाँ ओके so 3 to 5 lakhs न्यू टैक्स है जिसमें हाँ न्यू टैक्सेस जिन बता रही है
To save up to 17,500 rupees in income tax.
बता दे जल्दी अब पहले का ही बता रहा हूँ मैं
I agree with you because this is what keeps the real estate wheels going.
Office is just working round the clock to make this happen.
ये नहीं है, this is incorrect. This is futures options. Okay, fine. Compared to यहाँ पे पढ़े हैं.
India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer. It's a tinge of green across major indices. Midcaps, they are lagging today. But we did touch that 25,000 mark. But we've come off from those levels. But a lot of moving parts in terms of earnings. And that continues to come in.
You're absolutely right. After hitting the 25,000 mark, quite a bit of selling pressure. But today, after a while, we're actually seeing the broader end of the markets lag when it comes to the top end of the markets or the frontline indices. So that's one trend that we're seeing today, but quite a lot lined up on the show. Let's start off with the top headlines. Benchmark Nifty Index finally tops the 25,000 mark. Healthcare and banks are key gainers, even as realty and auto drags. Mid-caps underperform.
Nifty Auto slips nearly 1% amid muted July auto sales numbers. Ashok Leyland sees flat total sales on a YOY basis. The stock is down over 2%.
First, those solutions at a record high after the company raised the guidance for FY25 in terms of revenue. Birlasoft, however, continues to stay under pressure after a muted Q1. Sonata Software slips post Q1 results. Management tells CNBC TV 18 that AI is becoming an integral part of large deals.
KRBL slips over 7% after reporting its Q1 numbers. EBITDA is down 53%, while margins contract to 9.8% versus 17.8% on a YOY basis.
GTND sees its margin expand to 19% versus 7% on a year-on-year basis in Q1 FY25. Meanwhile, revenue rises 34%, stock gains over 5%.
Okay, all right. Those are the top headlines. But, we've been talking about mid-caps lagging today. So this is our segment, Mid-Cap Movers. We have Hormas to take us through the mid-caps that are moving around in trade. Hormas.
Plenty of movers in the broader markets, and I'll start off with those that are losing in today's session. Dixon Technologies is one of them. It snapped a 4-day gaining streak today. India Mart continues to sell off after its results. Titagarh also after the results is seeing a bit of a sell-off, and Navin Fluorine 3.5% lower in today's session. A lot of earnings reactions as well. Sonata Software, the top loser on the Nifty 500 today, 7.5% lower. Reddington, Birlasoft, Prestige Estates, all of them seeing a negative reaction to their earnings. But two stocks bucking the trend. The RPSG group names PCBL and First Source at record highs, both of them in today's session, 6.5% and First Source 9% higher. Stocks doing well on the back of volumes. Jubilant Pharmova, Adani Energy, of course, after the QIP at the highest point of the day, now 14.5% higher, and of course Aster DM after the results doing well on strong volumes, and some bit of sell-off seeing in the PSUs as well. HAL is under pressure, as are REC, BHEL after the results, and BEL also not having a good day today. Back to you guys.
Thank you so much, Hormas, for that. Let's now focus on Tata Steel. The company reported a mixed set of Q1 numbers. Our colleague spoke to TV Narendran, the CEO and Managing Director of the company, and began by asking him about the global steel pricing. Let's listen to that conversation.
Chinese prices have been a concern for the last year or so, ever since China started exporting almost 8 to 10 million tons a month. And I think that level of exports continues. China prices are depressed, but as you mentioned, at these levels, it's not sustainable. Chinese steel companies are already losing money. I think they're losing about $40 to $50 per ton on the HR coil at these prices. So it has to start moving up. And coking coal is not moving down as much as it should if steel prices have to stay at these levels. So I do expect that we are pretty close to the bottom.
All right, so that's heartening to hear. Let's focus on business then, and let's take the positive side of the business first. The India operations, fairly steady, EBITDA per ton more or less in line with what the street was working with. Give us a few details. You have Kalinganagar that's going to be commissioned in the next couple of months. What is the total volume growth you're looking at for the India business for this year? Because there'll be contribution that will be coming in from there. And also, given that there is some softness in coking coal prices, what is the outlook on the EBITDA per ton?
Yeah. So as far as volumes are concerned, the guidance we have given for the year is about 1.7 million tons coming out of Kalinganagar. We have another 200,000 tons coming out of Nilachal. For India, that's 1.9. But we are taking out 500,000 tons because we have a blast furnace, G blast furnace in Jamshedpur going for relining. So the net volume increase that we have guided is 1.4 million tons for India. As far as coking coal prices are concerned, like I said, it's stickier than it should be at today's steel prices. It's still around $220 because the liquidity in the coking coal market is not as great as it is in iron ore. So you typically see iron ore prices reflecting steel prices better than coking coal prices reflecting steel prices. And that's what we're seeing even today.
Okay. And what about for the past quarter, coking coal prices? How much lower were they in quarter one if I compare it to quarter four? And for quarter two, how much lower will they be?
So I think for Q2 compared to Q1, we are guiding that in India, it will be about $25, $20 to $25 per ton lower. And I think last Q1 compared to Q4 was about $15 lower. Yeah.
Got it.
Consumption. I'm talking of consumption cost.
Got it. Okay. All right. Fair enough. So that's about the India piece. What about Europe? The good news was the losses were lower because Netherlands has turned around. But UK is going for the entire realignment. So keeping that in mind, do you see Europe actually move into the green? Or do you think UK operations will continue to drag? And what about Netherlands? It only improves from here on?
So as you know, the Netherlands business suffered last year because of the blast furnace relining. The blast furnace came back on stream in February. So we've had the first quarter of full production after a long time. So that's why you see the volumes pick up in Netherlands. The markets are not great in Europe, so the spreads have been a bit lower than we had thought. But overall, obviously, Netherlands has moved from negative to positive. We expect Netherlands to stay positive EBITDA for the next few quarters at least and beyond. But Q2, of course, will be challenging for everyone because we are at the lowest point in steel prices the way we see it. UK, as you know, is going through major restructuring. We had guided that Q1 and Q2 will be significant EBITDA loss, which is what it is. But by the end of September, we would have closed the remaining blast furnace. We've already closed the 4 ovens in one blast furnace. And that will put UK into a neutral or a slightly positive operating EBITDA territory. But there would be, of course, one-off losses as we do the restructuring and we do the VRS and things like that. Okay, so for the second half of the year, Europe is definitely going to be in the green as of current reckoning. Definitely better than the first half, I will put it that way. And because there will be some one-offs, like I said. But on an operating basis, it will be in the green. Yeah. Got it. And what about India? India is doing around 13,700. Give and take everything. Pricing, benefit of this, $20 of coking coal cost. EBITDA per ton improves? No, there will be some compression because steel prices are still soft. Coking coal prices, we will absorb. We will get some of the benefits. So there will be some compression. But again, I look at Q2 as being the low point of the year. And hopefully Q3 and Q4, things will look better because we'll also have additional volumes coming in from Kalinganagar. All right, let's focus on the balance sheet then. The net debt has moved up to around 82,000 crores because you've incurred around 3,800 crores of capex. With the capex that have lined up, I think it's around 16,000 crores. How do you see this debt number move on an absolute basis? And where do you think it peaks out? If you could give us an absolute number on the debt. Yeah, so a lot of the movement just now is because of working capital. when you always compare March to June, most companies will show an increase because of working capital, because you're typically hitting the lowest point in the year by the end of March. So there's a bit of working capital adjustment. Second adjustment is because as we shut the blast furnaces in the UK, we are shipping out slabs and coils from Netherlands and India to the UK to keep the downstream businesses running. So there's a little bit of working capital going there. But overall, what we've guided for the year is the net debt will be flattish, but the net debt to EBITDA will come to below 2.5. It was over 3, and it will come down to below 2.5.
Okay, all right. Net debt to EBITDA to sub 2.5. Got it. Let's also focus on this crucial Supreme Court verdict. Now, you all have gone ahead, Mr. Narendran, and put a contingent liability of close to around 17,000 crores. If in case there's an adverse scenario that plays out, and this is on a retrospective basis, so we'll have to wait for that judgment. But could you tell us, if it is implied on a prospective basis, what could be the hit on an annual basis?
You know, the contingent liability is something that has been on our books for the last many, many years. So every year, if you look at the annual report, it has always been carried. So it's not anything fresh. I think we thought it was good practice for us to be transparent about that. But having said that, the impact is far more than Tata Steel. And I think the impact is on power cost, because coal prices will go up. Impact is on iron ore, impact is on bauxite. So there is a larger impact across the economy, and that's a larger concern. On an ongoing basis, that what in the past the state had planned to tax, I think the impact would be about 1,500 crores a year. But honestly, we are waiting for more clarity on the the ask as well, because the laws were not notified in some of the states too, and so there's a lot of work which still needs to be done before we get to some specific numbers.
Do you think the probability of this getting enforced is low?
I don't want to comment. It's sub judice, so we'll wait to hear what the outcome from the Supreme Court is.
All right. The other beat that I track is cement. A lot of consolidation is taking place out there. Over here, you have, the top 4 players that hold bulk of the market share. But there are a couple of assets that could come out. One is Mr. Agarwal's asset. The other one is NMDC Steel and RINL as well. In the past, you've said that you want to focus more on organic growth. But if these assets come up, is Tata Steel interested?
Now, preference is always for organic growth, because we have the land now between Kalinganagar, Nilachal, and the Bhushan plant. We can add at least another 20 million tons. So we have enough land available to grow significantly with the existing assets. And you grow in the same spot, you help competitiveness as well, because you spread your fixed costs over larger volumes. So that's our preference. So I don't think we look at all the options, but as of now, our preference is always for organic growth.
All right, that's the word coming in from Tata Steel's management. With that, we'll slip into a break. When we come back, we'll get you on more on the markets. We'll also connect with Mr. T.B. Mohandas Pai, former Infosys CFO. Infosys has received a GST demand notice. We'll discuss that and more. Stay tuned for that conversation.
From mere programming to AI/ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow.
Welcome back. Well, Infosys has received a pre-show cause notice for a hefty 32,400 crore rupee GST amount, which the company counters saying it is fully compliant and eligible for refund against exports as well. What does this really mean? What could the implications be on this one? To discuss this, we have TV Mohandas Pai, former CFO and board member at Infosys. He's also the chairman of RN Capital. Mr. Pai, good afternoon. Thank you so much for joining us. Well, I went through Infosys's press release, and there are two things here. First, it's a pre-show cause notice. So basically, an audit observation sheet where officers issue observations and ask for some data. And second, they are talking about doing the payment in full, and it's for a branch office which is abroad. So ideally, there should be no tax in that. What is your take on this? Do you think this will get solved at the pre-show cause issue notice level already?
This is continuing tax terrorism to which India Inc. has been shown for the last 20 years. It happened in UPA, it happened in NDA. In 2014, Finance Minister Jaitley and the NDA manifesto said they will stop tax terrorism. The disputes were 4,25,000 crores. Today, the disputes have gone to 12 lakh crores. And see this document. This is a budget document. Taxes raised but not realized. What do they say? 1 year to 2 years, the amount in dispute is 6,58,000 crores. All right? So there's a deliberate attempt at tax terrorism for the last many years, and government has not been able to solve the problem despite this. Now, let me come to this case. Look at this case. There was a notice from the Karnataka tax authorities. The company said they went and met them and showed them the business model. What is the business model? You have a branch overseas which bills the client. The branch collects the money and remits the money to his overseas account to India. All right? And then you bill directly from here for anything that you do from here. All right? And the branch files a tax return overseas. There is no tax from the branch to the head office or head office to the branch, because the branch does not provide any services to the head office. All right? They're two distinct entities created for a particular purpose. You could have a company there, a legal entity, or you could have a branch. That's how people work. And this has been how industry has been working. Large parts of industry have been working. This is a business model issue. Now, and then what happens after that? Just yesterday evening, suddenly the media says tax evasion 36,000 crores, alleged tax evasion. Then the company in the press release says, we heard it in the media, then we got the release. So who is doing what? So the dispute, they read it to the media and create a fear and create something else. Then they send to the company for what? They could have called the company and said, we have some questions to ask you. Can you please explain what is your business model? Then what do they say? Oh, they had a branch, they have to charge tax. It has to be on a, they have to charge it there, then get a refund. Now there is a company has said that there is a circular issued in June, which from the, from the ministerial committee, which says very clearly that there cannot be GST from an overseas branch to an Indian company.
Sir, if I could just interrupt you there, the tax period mentioned is actually from July 2017 to March 20. Yeah.
No, look, I understand all this. The clarification issue to say it was never there earlier also, because it's a very vague. Now, if you have a tax dispute, raise it within 1 year. You're raising after 5 years when the group of ministers or whatever it is has said very clearly that, this is not applicable. So what are you trying to? So issue a tax release. Look, I don't mind them calling a company, anybody, please do it. But why release to the media?
But I think Infosys, Mr. Pai, Infosys says they've already submitted all the relevant documents. So do you think?
Please read that. No, please read that. They went and met the Karnataka authorities and given all the documents, everything to them. And then DG Delhi issued this again. And this is a press.
So anyway, and yes, I do get that. And anyway, by law, you cannot issue two different notices for the same period, two authorities, right? So that anyway at the starters does not look right.
Look, I'm concerned about one thing. This tax terrorism, why are you deliberately issuing things to the public to say alleged tax evasion when there's no tax evasion and hurting people's reputation? Why are you hurting people's reputation? Why are you creating this kind of a crisis? You could have called them over and told them, come and explain the business model, because you don't understand the business model. It's a business model issue. It's not tax evasion issue. But it's an alleged tax evasion.
So what is the way forward now for Infosys, or what is the team at Infosys planning to do?
Look, it cannot be held under law, is illegal, unconscionable. But see, please remember the problem in the country. Taxmen can issue any notice, create any demand, do whatever they want and say, go in appeal. I have met them as CFO. They told me I got a tax target. I will issue the demand. You pay me and go in appeal, you'll win. And appeal takes 15, 20 years. This is tax terrorism at its worst. And it's been happening for many years. That is the challenge that we have to face.
Yes, I totally get you.
This is not going to impact the company. They don't have to provide anything because the pre-tax, they will explain. And, I'm sure, government, I'm sure the government will take note. I'm sure the NASCOM will come, because there is a business model issue and the circular is very clear. The law is very clear. I mean, this is nitpicking at the worst. And why are you doing it? What is the motivation for doing all this?
Yes.
That is what government should do. And why are you harassing companies? Today, business in India is living in fear. Business in India is living in fear. Tax rates, they announce everything. 60 to 70% of all appeals are lost. 60 to 70% all are lost.
Yes, we do get your point. And since it is just a pre-show cause notice right now, and the sources are suggesting company would just submit the documents. They've already, as you said, spoken to the Karnataka tax authorities as well. We'll have to see which way things go. But before that, of course, submission of documents on this particular thing will be very important. And as you said, this is a model which has continued. It was there in the service tax era as well, when a company had a branch office abroad and there was sharing of services there. But we take your point, and we'll, of course, keep discussing this. Thank you so much for joining us today with your take and giving us a sense of what is happening on ground as far as this notice is concerned as well. We'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that.
With CNBC TV 18, now streaming live 24/7 on YouTube. Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters.
Welcome back to Mid-Cap Radar. Well, one particular segment of the market that's showing very interesting moves is actually the mid-cap IT space. Now, within that particular space, if you pull up the chart of Birlasoft, yesterday the stock fell almost 5% on the back of weak results. Even after the conference call, today you're actually seeing Birlasoft fall another 4%. In fact, it's the top laggard as far as the F&O space is concerned. The other stock, which is having differing fortunes is Firstsource Solutions. Firstsource Solutions declared its results a couple of days ago, and remember, the company actually upgraded the revenue growth guidance for FY25. On the back of that, the stock is up 9% today. But with that, that's all the time we have on this edition of Mid-Cap Radar. Mutual Fund Corner when we return.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today, with the Nifty at 25,000, we decode and answer if it is advisable to invest right now. If yes, what are the sectors that one should look for? And are large caps a safe haven currently, given the long ongoing rally in the broader market? The Nifty continues to trade at a premium to its long-term average of around 18 times PE, so should you still invest? To discuss this and more, we have with us today Sumit Agrawal, Senior Vice President, Equity at Bandhan AMC. Mr. Agrawal, good afternoon. Thank you so much for joining us today. And it is on a day when markets are making new highs. And, we have been talking about this, that calendar year 2025 could be the year of large caps. They've done well, but mid and small cap rally continues. So how do you look at the entire large cap space in this regard?
Yeah, thanks for having me on the show. Very fair point that while the initial expectation for CY25 was that large cap should actually do very well and probably some moderation in the mid and small caps, but that is clearly not played out. Uh, the I see a lot of reasons behind this. Probably, the corrections which have been there in the broader market never really lasted beyond 3 to 4 days, especially in this calendar year. In fact, we have not seen subsequent like 4 days, more than four days fall, continuous fall in mid and small cap segments. Every time it falls, there is some follow buying, and actually it's a new rally. So yeah, to that extent, this rally has continued, but what it has done is it has equally made the large cap space much more attractive from a valuation point of view because earnings in this space continues to grow very well. And for some reasons, the premium to discount thing that we measure from vis-a-vis mid and small caps, I think that is clearly in favor of large caps. Although in the near term, momentum is working towards mid and small cap, but from an entry point of view, I think valuations look favorable for the large cap space, and therefore I think CY25 still holds a lot of promise for this segment to do well.
Okay, the way we have seen the moves, right? We think that 25 is over, but there's so much still left, right? But let's talk about the performance so far. What has been the large cap performance vis-a-vis small and mid cap, say, over the last 10 years? Can't consider the last 3-4 years because that has been very different.
Yeah, so see, the good part about statistics is that, you can look at the way you want to look at. So if you look at today, the 10-year compounding in Sensex or Nifty is about 12-13%. But the same compounding in a mid-cap index or a small-cap index is about 18%. So that is a clear differential of about 6%. And assume there is a new investor who is entering into the market right now, he can clearly get colored by the extra 6% CAGR that the mid and small cap is actually offering. But if you go ahead and visualize the same 10-year CAGR maybe 3 years ago, probably the mid, small, and large were all giving you a CAGR which is almost at the same levels. And perhaps if we look at in the COVID bottom, wherein markets corrected heavily and mid, small corrected much more, at that point in time, large caps were appearing to be the clear winner, and mid and small cap, even on a 10-year basis, were lagging big time. So my advice is, when you look at statistics, please do have some context of the history, how are near-term returns coloring the longer-term trajectory, and that is where a little bit of experience and a little bit of time with the market actually helps.
Okay, so what is your sense on Indian markets in general then? Because we are at the 25,000 mark, we've seen that rally, as you were pointing out, mid and small caps much more. Do you think they're overvalued right now across most of the segments?
Not really. I would not say across most of the segments, but if you look at large caps or let's say BSE 100 for that example, not even Nifty, the top 100 companies, that index is currently trading at around 20%, 15 to 20% higher than its long run average. And I'm talking about a 10-year price to earning multiple. So I would say that is not expensive. 15-20% premium is still something which is easily digestible. But if you look at specifically mid-cap index, that is actually trading at almost a 50% premium versus its 10-year history at a forward P of somewhere around 30-32 times. And I think this is the level that we have not seen in the past. Same goes with small cap index as well, because that is the index also which is almost trading at about 40% on a price to earning basis, which is again at one of the historical highs. Last time when we saw this index trading at such level was just after the COVID recovery, somewhere in 2021. Wherein earnings were actually very low in terms of projections, and therefore the PE was looking much elevated. So I think clearly, if you look at purely from a valuations perspective, large cap is still offering you the largest valuation comfort, and mid and small cap probably because of being very concentrated, like mid cap concentrated between like top 100, between 100 and 150 stocks. Probably it's quite expensive. In small caps, people can actually find some alpha, depends on the fund manager's skill set. What is the level of companies he is willing to explore? Is he willing to go down the market cap curve further? But on the whole, I think it's quite expensive given the strong rally that we have seen in the past 1.5 to 2 years.
I know, you're absolutely right. So in that case, just wanted to follow up on this. You've explain the valuation differential that we are seeing in large caps versus small and mid caps, and the premium that these individual spaces are trading versus historical averages as well. That's very helpful. But in that case, are mid caps and small caps at a juncture where it is little tricky and a little scary to invest at certain levels? Is this time for caution in that space?
Actually, depending on the mid and small cap, it's clearly an individual's investor's appetite. It depends on that. For example, if you look at the standard deviation of returns, especially in the small caps and mid caps, that is much higher than the large cap segment as a whole. So the broader market tends to give you higher returns, but at the same time, they're equally volatile. So if an investor has a temperament of actually taking care of that volatility and he's okay with it, I think then it's okay. But otherwise, from a risk-adjusted return point of view, which is what I call, like sometimes on a Sharpe ratio, or you divide the returns by standard deviation. I think that is where large caps have one of the least drawdowns. Historically, also, if you see, if markets correct, on an average, large caps have corrected about 14-15%, but the mid and small caps have actually given you drawdowns on an average of about 20%. And when it becomes slightly more deeper, it can go to as high as 40-50%. Thankfully, we are not in that zone currently, but an investor needs to keep in mind the drawdowns that can be expected in different asset classes or different segments of the market, and accordingly take a call between the large cap vis-a-vis the broader market exposure that he's having.
Okay, so let's talk about Bandhan's strategy in this case. What would your strategy be for choosing stocks in large cap funds right now?
Yeah, so we have been following a very time-tested BMV framework, which is called, business management and valuation, which focuses on buying good businesses run by good management, and available at an acceptable valuation, not a very cheap, perhaps not very expensive, but an acceptable risk reward. I think our focus is on giving a better risk-adjusted experience to the investor. We do not focus on chasing a lot of momentum or buying very, very expensive stocks in the fund. And I think that is a strategy which has helped us in the last 7 years or 8 years that I've been managing the fund. As of now, as we speak, we have been overweight on some of the defensive sectors, and that has actually helped the fund. So if you look at the characteristics of the fund, generally, in down markets, we tend to fall less, and in up markets, we equally capture the upsides. And that is exactly the science of risk-adjusted returns that I'm talking about. So very plain, vanilla, simple, time-tested philosophy, because that goes well with the steadiness of the large cap as a strategy that it provides.
Okay, all right. So this is what the strategy at Bandhan AMC is when it comes to large cap funds. Mr. Agrawal, it's a very interesting conversation, but we have to get into a quick commercial break. On the other side, we'll continue our discussion with Sumit Agrawal on large cap funds and what should the strategy be with large caps now. Stay tuned.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So
Welcome back. You're still tuned into MF Corner. We have with us Sumit Agrawal from Bandhan AMC. We're discussing everything about large cap funds, whether it's a good time to put in more money here and what Bandhan AMC's strategy is when it comes to large cap investments. So Mr. Agrawal, let's talk about the sectors where you see an opportunity in the large cap space now, because you did say that it is cheaper than mid and small caps and there is some valuation comfort here. Do you like banking? Is it energy? Some of the spaces you can tell us, and why do you like them?
Yeah, so see, large cap investing also offers you a very large options available on the sector side. So there are somewhere around 12 to 14 large sectors that you can actually pick up. Obviously, when you go to mid and small cap, the choices of sectors available expands, but I'm just restricting myself to large cap here. I think few themes that we like very much is, especially from a risk reward perspective, is financials. Especially private sector banks, and this is a space which is actually clearly underperformed in the last 2 to 3 years. While profits of these entities have grown at a reasonable number, but stock prices have actually not grown as much, and therefore the PEs have actually contracted. So clearly you see a lot of opportunity in financial space. In fact, we have a dedicated strategy for financial services in a fund plateau. And when I say financials, I also talk a bit about why financials is not just restricted to the top 4-5 banks or top 8-10 companies. In fact, it's a much wider choice which is available today. You have things like insurance, asset management companies, capital markets, fintechs, and so many other things which you can actually invest in some bit or the another, even in a large cap fund, that actually can give you some flavor of longer term themes rather than the traditional time tested banking stocks which are there. So financials again is one of the major themes that we like. Followed by, we have a preference for, and especially in our fund itself, we have been slightly contrarian and overweight on information technology or IT as a sector. In fact, if you see, while the commentaries may not be as great, but results somehow have been better than the expectations, and with the outlook on the rate globally softening, I think the investor positioning in this sector is much lower than it ought to be. In fact, if I recollect correctly, IT weight in Nifty used to be somewhere around 12.5% to 14%. It went to as low as about 8-9% in the last 1 year or so, and it is gradually coming back. And I think this underpositioning by investors in this sector will itself lead to the sector actually outperforming, in addition to obviously the underlying earnings. So I think that is a position that the fund has taken quite early and has also benefited from it. So tech is one such sector. Followed by, we like consumption. This is also a sector which is underperformed in the past 2 years, specifically the rural aspect of the nation or the economy, because that is where the problem has been. And with things changing, we think consumption will also pick up, and therefore consumption again is a large weighted sector in the index, about 6-7% on the staple side and remaining 6-7% on the discretionary side. So I think this as a pack again should do well. So these three sectors altogether, I think, is a chunk of where our bets are, followed by obviously auto and even Nifty Pharma, I would say, which is the healthcare sector, which again did very well during the COVID time, but after that somehow it has been subdued. So I think that also should do really well. So these 4 pockets is where our exposure is slightly on the higher side versus the benchmark.
Okay, that is very helpful. So that explains why you're looking at some of these themes, be it banking space or IT space as well, and the other names that you mentioned. But you know, Mr. Agrawal, we always come on this ongoing debate. What do you make of the active versus passive investing debate? What kind of mix should one see in the portfolio? Does one theme or one style work for everyone? What's your take here?
Yeah, so being a large cap fund manager, I have often faced this question, and my straight clear answer is that it's not active versus passive, but I think both of the strategies can coexist, and I can clearly give some examples about it. So in the past 10, 15 years, you have had phases wherein markets tend to be very narrow, or it tends to be very broad. So in narrow markets, generally only a select number of stocks does well, especially on the large cap side. And that is the era wherein passives generally tend to do better. But when markets actually broaden, which is likely the current phase going on since last 2.5 years, actives generally tend to do well because that is where the benefits of stock picking and they can actually take some bets even in the mid and small cap up to 20%, which is allowed, and that is where actives actually generate alpha. So in fact, if you see for our fund itself, Bandhan Large Cap Fund, in the past 7 years, we have generated alpha versus passives or versus the index almost 5 years. Only 2 years we did not do well, which was 2018 and 2022, and these are again narrow market years basically. So that goes well with the thesis. And even if you see today, the BSE 100 is actually outperforming Nifty 50. So even within large caps, not necessarily the top 50 which will do well, even the next 50 among the large cap stocks are doing relatively much better. So I would say, and here again, as I started the conversation, the near 1 year returns or the near term returns do color your longer term returns as well. So please keep that thing in mind. As we speak, I think most of the funds on the active side would be outperforming the passives. But there might be time when passives actually come back if markets correct and market framework becomes slightly narrow, which incidentally is not appearing so far. But if that happens, perhaps passives can come back. But as I say, for an investor, it's good to have an intelligent mix of actives and passives, obviously in consultation with your advisor, because that is what will help you in the long run.
That makes sense. So, in that case, I just wanted to understand more from a macro setup perspective as well. How are you looking at the current macro setup, considering the global backdrop as well, a possibility of interest rate cut? We got the Fed meet outcome as well. What do you make of it?
Yeah, so I think from a macro stability point of view, I think India is very, very well placed because, amongst all the competing economies of the world, we are one of the fastest growing economy as of now. In fact, if you look at all the projections, the next 5 years will be the third largest economy. Already we have a large consumption base, and at the same time, on hard assets like infra and capex and the government push, that thing is continuing to do well. At the same time, our FX also remains quite steady with about $650 billion plus of FX reserves, very comfortable import cover, and that's why you're seeing a very stable currency as well. So from a macro standpoint of view, I don't think there is anything to worry as of now. In fact, with the latest outcomes of the Fed meeting and the commentary there around, it's quite clear that rates might soften earlier as it is anticipated to be, and which will actually help the inflation globally and more so countries like India. So, and sheer transition that we have made in the last 10, 15 years, is mind-boggling. So I would say macro setup remains quite benign for India, and as a result, it's not only going to benefit the broader market, but also the larger companies and therefore large caps as a strategy. I mean, you can't imagine a country doing well without the largest steel company doing well, or without the largest construction or largest cement company doing well, or the largest banks doing well. So I know broader market is in favor right now. It's a seasonal thing, but you can't do well with the larger guys not participating, and that's where my comfort for large caps, especially given the valuation differential also. That's where it stems from.
No, absolutely. And the helpful table that you have provided us with as well, India then and now, 1991 versus 2023, where forex reserves have grown to $600 billion versus $5.8 billion. We have share in the world GDP, which has risen to 3.1% versus 1.2%. Gross domestic product in purchasing power parity has grown to $11 trillion, which compares with $1.1 trillion. That's a 10 times growth that we've seen. And of course, the other statistics are there for you on the screen as well. So, Mr. Agrawal, we have around 3 minutes on the show. So last question before I let you go. The recent big event that we saw, and markets have waded through everything that has happened actually. First we had elections, now it was budget. What did you make of the budget and the changes that were announced? How would that impact, say, the growth prospects, the mutual fund industry going forward? What's your take?
Yeah, so I think budget was a welcome event, and there might some jitters around the capital gain taxation changes, but I think it's a good balance between capex, fiscal prudence, and welfareism. We've seen government had already spent a lot on capex in the earlier years, so probably this time around it was a bit moderate, but I think the same has been taken care by spending a lot of money to revive the consumption. And if you recollect my earlier talk about how rural consumption specifically has been weak in the country for the last 2-3 years, I think the steps regarding increasing employment or skill development, or maybe even in the new tax regime there is an incremental money that flows in the pockets of people. I think all that thing will add up to some amount of increase in consumption. It will help the activity levels to go up in the market. And in a way, when you are in a new, the same government has got re-elected and it's just the first year, in a way, it's a continuity which is prevailing. So that also gives a lot of comfort from a policy-making point of view, and even business houses can take a view because you clearly have a continuity which is there. So therefore, I think stock-specific or maybe sector-specifics, I think consumption is a clear winner from the budget point of view. I think a lot of things have also been done in the earlier aspect on defense and capex as such, which is continuing very well, and because of that, you're seeing a lot of activity from the private guys also. My only hope is that even private sector capex should now pick up. So far, only government sector capex has been doing very well, but private sector was somehow on the back foot. My hope is that in the next 1-2 years, we should see that pick up, and therefore the entire journey of India moving from top 5 to top 3 economies in the world in the next 5 years. I think all these things are essential in that aspect to move on. All in all, it's good if we pay taxes because that is how governments generates revenue, and ultimately it is used for country's benefit. I'm personally quite happy if we have more clarity and more uniform rate of taxation across asset classes over a longer run, because then make decision making on investing, decision making on wealth creation, or decision making on investments that you make becomes much more clearer. So I think all this is a thing in the right direction. So I would say I would say it's a good budget from that aspect.
All right, we take your point, and thank you so much for joining us with your insights and expert comments today, Mr. Agrawal. It was a pleasure speaking with you. With that, we'll take your leave on MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.
Access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
It's a mixed picture as we speak. Most of the indices are trading with gains.
DGGI, Bangalore zone, claimed Infosys for tax evasion.
Fed is closer to rate cuts if data cooperates.
There is the Supreme Court verdict overhang, and for now, they've put in a contingent liability of around 17,000 crores.
25,000 plus on the Nifty is what you have, and we are at a fresh all-time high, of course.
Currently, the market mood is slightly more driven by liquidity and sentiment.
M&M, we've seen growth very substantially, even in a flat market.
Nifty sitting at around 25,000 at this point in time.
Sources have told CNBC TV 18 that the company started its conversations with a single player here, and that is KEC International.
There are 3 potential suitors that have received this fit and proper certificate from the RBI for the acquisition of IDBI Bank.
The demand has been slightly muted this year right from the beginning.
We will be $68 billion of the size of the market by CY28.
Mid caps, they are lagging today.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Okay, well, 25,000 is done, and I think the market is just taking a break. This is, of course, Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surubi and Nigel. Guys, hi, good afternoon.
Hi, good afternoon. So we got 25,000, then some profit taking, that kind of a day. But I don't know, maybe taking profits not such a bad thing at these levels.
You know, the last few minutes, what's happened is the Nifty Bank actually has slipped, and SBI comes out with a set of numbers, I think, over the weekend. So that one actually has taken a sharp knock. Let's see how things go. The problem, I think, today is the broader markets, which have been outperforming, but today it's coming for a bout of profit again.
I mean, I think actually started yesterday. Yesterday in the last hour, the small cap index sold off, and today it discontinued. So you look at the small cap and mid cap indices, there is a full 0.75% cut on each of those sectors. Actually, it's more now. So that this 0.75% at about 220, and as we start, there's been a bit more of a slip. So full 1% plus cuts coming through on the mid and small cap part of the market. Market breadth has been negative from the word go, actually for after the first 1 hour, to be fair. 2:1 declines to advances, so market breadth is negative. It is largely a few large caps which are holding the index higher. So 20 odd points on the Nifty is what you have, 30 points below that 25,000 level. No help from the Nifty Bank once again. That has been the weaker of the two indices, and I think that is also one reason why even on large caps there isn't very much by way of momentum which is visible. So can't complain too much because, I mean, the market here has been astoundingly strong, even though some of the global markets, even US, for example, over the last few days has had 1.5–2% cuts, but the market here did not budge. So you're just kind of sort of catching up a little bit to what has already happened around the world. So don't look at the last night's 3% rally on the Nasdaq, and so expect a sort of equal kind of a reaction here. There is what has happened over the last 2-3 weeks or so, which is a bearing as to why the market is not responding in full force. I think some of the global markets also should come up a little later on the screen, and they'll explain the picture more. Surabhi.
Absolutely, Prashant. In fact, I was looking at that. Today, we're in the middle of what US did, the exuberance over there, and what Europe is doing right now, because European markets are down over 1%, many of them. The major ones, the DAX, the CAC, all these markets are down between 1 to 1.5%. So in that context, and then, of course, you had the Japanese market sell off big time today. So in that context, maybe not too bad. We are managing to just about stay around the flat line. Now, the push and pull factors for the large cap screen. The thing is that, of course, it was Infosys which started with that negative news on the GST demand in the morning. But a couple of other tech stocks are also now more on the red side of the screen than the green side. So that's one area that's putting in some pressure. A lot of auto stocks losing momentum today. That's been the story right from morning. Not just Mahindra and Mahindra, but other names. Tata Motors, which is going to be reporting today, down 2.5%. There are the others like iSure, etc. So auto as a space is losing some ground. Tech as a space is a bit weak. There are the biggies like L&T on the downside of the screen. And then you come to the banks. Banks are really split. Had it not been for HDFC Bank, the bank Nifty picture itself would have been a lot weaker because SBI, Kotak Mahindra Bank, IndusInd, all of them are down. This one is making up for it. So that's why the bank Nifty isn't looking at a bigger decline. On the upside, batting for the bulls, apart from HDFC Bank, a couple more names. So some of the PSUs are having a great show today. Coal India, Power Grid, these are stocks, even NTPC for that matter, ONGC. So the powerful top PSUs, large cap PSUs, they continue to have a good run. We had Sun Pharma's numbers come out just a while back. That is a stock about 1% higher. And then Reliance to the rescue, keeping the Nifty just around the flat line, at least for now. Nigel.
Well, that's right. Let's get straight then to how do you trade the final hour of trade. Keep in mind, we have the Nifty weekly expiry as well that plays out. Yesterday had the Nifty Bank monthly expiry that played out. So Mitesh Thakkar is back with us to help us out with the trade out there. Mitesh, what do you read of today's action? We started about the 25,000 mark, but we couldn't hold on there. Also fill us in with your trading picks.
Imagine two things. One, we made a fresh high, and two, I think the indicators have failed to make a fresh high till now. So one, in case we break 24,800, then I think we might go into a corrective mode. Otherwise, we need to get past the today's high to make some momentum and see that the indicators carry through the momentum. So it is not a market, which is very comfortable in the sense that we try to get past the important level, but we fail to do that. And again, the culprit is Bank Nifty, which is already in the negative, and Bank Nifty is clearly still showing signs of underperformance. Wait it out. I think, for the timing, I am not wanting to buy anything because I would want to buy it closer to 24,800 or on a breakout about 25,050. That's the way we'll approach it. And then, we'll take it forward from there. This is not a market which is giving clear signals because we've been continuously trying to make new highs, but at every high, the Bank Nifty has been not, able to get past the previous high or even start making lower highs. So a market which is clearly showing divergence. On the stock side, I have a sell on Glenmark with a stop at about 14.55. Look for targets of around 13.95, 13.90 on the downside, maybe more. And Tata Power is conditional buy. I think it's just on the verge of getting a breakout into fresh highs. So buy it above 465, keep a stop at 455 and look for targets of 485.
All right, got that. Thanks very much, Mitesh. We'll come back to you in a bit and get some more trades in, but lots of earnings to analyze. Let's start with Sun Pharma, the Nifty heavyweight, which released numbers just a while back. Let's go across to Ekta. Ekta, how do the numbers look?
Well, largely an inline set of numbers, you'd have to say, for Sun Pharma this quarter. So, for example, the revenue is up around 6% on a year-on-year basis. The street was estimating around an 8% growth. The EBITDA has come in at around 3,600 odd crores, which is better than estimates. So, it was an operational beat which came in. It margins at around 28.5% with versus estimates of around 26% versus 27% that they did same time last year, around 28 odd percent. Profit also better than estimates, came in at around 2,800 odd crores. Q on Q as well, there was a margin improvement of almost 300 basis points. So that seems to have stood out in terms of the performance this time. We'll wait by for more details such as the specialty business, etc. But if you look at the US formulation sales, they came in at around $466 million, which was down around 1% on a year-on-year basis. Street was anticipating more than $500 million, but one will need to see the details and the fine print of that. Generally, whether or not the specialty business sales are included in that or not. Otherwise, it seems as though the focus was on the operational viability of the company or the margin improvement, and that has come through this time.
Okay, all right, got that. Ekta, thanks very much. Well, let's welcome Deven Choksi into the conversation. Deven, good to have you on. Lots of earnings to discuss. Let's start with Sun Pharma. What did you make of the numbers, and what's your stance on the stock?
Good afternoon, Survi. Well, on the face of it, the numbers looks, I think, impressive. I think for sure. Maybe I think better than the expectation that we carried from the company. In general, I think most of the pharma companies possibly are showing the higher amount of growth in the numbers in this particular quarter. Maybe due to one of the reason that I think the products in specialty generics particularly are fetching them better realization and at better prices, I think, in most of the categories in which I think they've been launched. Not in specific along with the Sun Pharma, but I think rest of the companies as well. So that's what our gathering is. Maybe I think once we study the result in detail, I think we'll get more confirmation of this particular thesis. But overall, I think the number looks, I think, pretty steady. Maybe I think the impact of better realization is expected to be seen across, I think, in different product categories or therapeutic categories that we are expecting.
Okay, all right. Hi, Deven. I wanted your view on Ambuja Cements, but let's run through our viewers first. What brokerages have to say? There are a slew of downgrades that have come in on Ambuja Cements. Starting off with DAM Capital, they have gone ahead, they've downgraded the stock to neutral, target price around 700 rupees. They say yes, the company is on a solid footing. The problem is most of the positives are priced in. They've gone ahead and they've trimmed their EBITDA estimates by 3 to around 4% because they're factoring in lower probability. Why lower probability? Because the weak pricing scenario that's existing, because of the aggravation of aggression from various larger players. And the second factor is, the closing out of the South-based Penna acquisition. That's what's going to weigh on profitability. They also highlight that valuations have turned unfavorable because they're rather expensive and they're rich. The stock is trading at around 17 times EV per EBITDA, even after factoring in volume growth of close to around 16.5%, even if after factoring in a CAGR on EBITDA per ton improvement of around 9%. So from a longer term perspective, they say the cues are in place. The problem is the stock has run up a little too steeply, and also that's why they're trimming their rating on the stock. Moving to Jefferies, they have trimmed Ambuja Cements consolidated estimates by around 10% for the coming year and by 2% for the next 2 years. What they go on to say is that the key reason is the pricing pressure of the industry. They've also highlighted the cash position has come down. From close to around 24,000 crores, it's come down to around 18,000 crores because of the capex spend as well as working capital cycle has got stretched a little bit. They maintain their positive stance though on both the stocks, that's Ambuja as well as on ACC. Moving to Nuvama then, they have downgraded the stock from buy to hold. They revised the target price of around 722 from around 767. Weak pricing environment, uptick in the stock price, that means that in the near term, well, things could be a little bit subdued for the company. So all these three, DAM, Nuvama, as well as Jefferies, they've gone ahead and they've trimmed estimates, or in fact, they've downgraded the stock, and that one's down close to around 3%. Devin, what's your view on Ambuja Cements?
Yeah, Nigel, I guess I think in the commodity segment, probably I think in a given situation, you may find that the stock is expensive. But I think most importantly, both ACC and Ambuja in the Adani portfolio, they are actually, I think, driving on few counts. On one, I think they want to expand the capacity, combined capacity, about 200 million metric tons in the near future. Important point. Second most important point, I think they have got significantly large amount of limestone reserves. So given the kind of capacity expansion that they want to carry out, I think this result should come handy to them. Important another point would be the logistic arrangement, including the transportation between East Coast to West Coast of cement transportation because of the inland water transportation port facilities available with the group. And last but not the least, I think the energy cost reduction, I think, which is expected to come up. So in all put together, I think it's a pure play on the volume. It's a pure play on, I think, how you bring down the cost. And that's where I probably do not like to look at the company on a quarter-to-quarter basis. I think this particular business should be seen on a relatively longer period of time because they are bringing up the larger capacity and it's going to be a volume play going forward along with the valuations.
Okay, so you'll maintain your positive stance then on them?
That's right.
Okay, all right. So longer term, Ambuja Cement still looks up. Devin, I wanted a view on Tata Steel, but let's run our viewers first. Why the stock opened up in the green and then it did come under pressure. First up, the numbers looked good. Absolute EBITDA number was better. Margins as well on absolute basis was better. India EBITDA per ton was in line, while in Europe, well, we had the loss that was lower than expected. So that's a positive as well. The net debt number, though, that moved up on a sequential basis from around 77,000 crores to around 82,000 crores. What's the problem then? You know, the debt is moving up. They have a big capex underway. So the street is a little bit cautious on that front. There's also an event risk because the Supreme Court's final judgment, that's going to be a bit of an overhang. What's that? Last week itself, the Supreme Court said that the states can go ahead and they can levy higher taxes on these mining companies. So for the time being, Tata Steel, they have been marking this out. They continue to mark this out. They have now marked close to 17,000 crores as a contingent liability if this higher taxes by state governments is levied on a retrospective basis. In terms of the commentary that they gave us, they made this point that Chinese prices, yes, they're under pressure, but they're likely to have bottomed out. They're guiding for around 1.4 million tons of additional volumes in the coming year in comparison to last year from India because Kalinganagar comes on stream. They're saying India as well as Europe in the near term. That's for Q2. Profitability will be under pressure, but for the second half of the year, they're expecting some kind of a revival. And net debt to EBITDA for the year will be more or less flattish. They go on to say with regard to the contingent liability on a retrospective basis, it will be 17,000 crores. But if from here on a prospective basis, if those higher state taxes need to come into play, then they'll be hit by close to around 1,500 crores on a per annum basis. So put all this together, the numbers look good. The problem is on this contingent liability as well as the rising debt. Devi, in your view?
Yeah, Nigel, I think you summarized it all. I guess I think the challenge is that if the Supreme Court ruling favors the state to levy the taxes on the mining in Orissa with a retrospective effect, this could be, I think, a very dampening kind of a situation because I think that would probably give freedom to one and the other state, I think, to start bringing this entire tax management under the retrospective basis. Hope, I think, that doesn't work that way. But I think if it is not retrospective and if it is, I think, on a prospective basis, then probably I think they have at least the ability to pass over the cost on this particular tax that I think the states are talking about. So to a greater extent, I think a lot would depend on this particular overhang of the Supreme Court judgment. I think one will have to wait and see. Till that point of time, I believe that the stock possibly, even though the fundamentals are in place, profits are, I think, absolutely in place, demand scenario remains buoyant. All in all put together, I think the minus this particular factor, the company should otherwise do well in coming period. But we'll have to wait and see on this particular judgment which comes out in due course of time.
Okay, afternoon, Devin. What about the auto sales? So M&M is seeing a sharp fall of about 2.7%. In the month gone by, the automotive sales were a bit disappointing. We had a chat with the management also earlier. Where do you stand on Mahindra & Mahindra?
Well, again, I think, Dima, good afternoon. Again, I believe that I think don't look at these companies on a month-to-month or a quarter-to-quarter basis. I think the long-term prospects seems absolutely convincing in most of the auto companies, be it Maruti, be it Tata Motors, be it Mahindra & Mahindra, for that matter. I think on one side, the commercial vehicle segment is showing a distinct signs of growth and I think smart growth with the profits also. On the other side, I think the passenger vehicle, though in 1 or 2 months, I think may remain a little subdued. But I think given the kind of demand scenario which is emerging in the country, I would remain bullish. So maybe corrections in the price, stock price, I think is a welcome opportunity. In fact, I think in most of the companies' case, I think the price have actually, I think, reached to the premium level. In this kind of a scenario, when the premium level price gets corrected, it becomes a buy opportunity. So as a long-term direction, I think we remain fully convinced about the auto and auto play. Maybe corrections would mean meaningful entry back into these counters.
Right, Devin, we'll leave it on that note for today. Thank you very much for joining in. Got lots of earnings to go over, and Dabur's come out with numbers just a while back. In fact, the numbers came out, I think, just less than half an hour ago. And they look pretty good. The volume growth is about 5.2%. The poll was expecting, growth of around 5 to 6%. And we're looking at the EBITDA rising by about 8.3% year on year. That's come through. To talk about this, we have with us Mr. Mohit Malhotra, the CEO of Dabur India. Mr. Malhotra, great to have you on. Thanks for joining in. And I'm going to take off from, where we left last quarter, where you were telling us that the rural recovery is really looking strong. So tell us more. I mean, how has rural performed and what's the difference between urban and rural growth for you right now? This 5% volume, how much of it is rural India? How much is urban?
Right. Thank you for having me. So rural definitely for past 3 quarters is inching ahead of urban. For it's around 350 basis points ahead. Rural is ahead of urban. My rural growth was 9% and urban growth was in the range of around 5%. So therefore overall around 7%. And we are very positive about rural and that's how the growth has been coming. So we've been putting ahead of the curve, a lot of distribution initiatives in rural, a lot of activations have happened in the rural. And third vector has been, a lot of media has been increased in FTA channels. There's a 50% increase in the media for mobilizing demand in the rural. So all this has paid off and 9% rural growth is, we are very happy with it, yeah.
That's absolutely fantastic. I think last quarter you were 8% rural growth. Now that's moving up to 9%. Given the strength of the rural recovery and what you're seeing, would you want to increase your overall guidance? I think you were at about 8 to 9% growth for the full year. But now with rural doing so well, would you look at double-digit growth?
I think we really don't know how it, waves up. So while the monsoon has been great and the government outlay also has been increased for rural, for both agriculture and also the rural sector. So I think sequentially there should be improvement. And 4, 5, 6% has been sequential in past 3 quarters. We expect improvement to happen. To give an exact guidance, it will be very difficult for me to give, but we stick to our guidance for the full year, which is high single-digit kind of a volume growth, and majority of the growth will only come from volume because there's not much of a price increase there, maybe a 2% on price increase, and the rest will all come from volume growth driven by rural recovery.
Okay, so high single-digit kind of volume growth, and you expect the sequential recovery in volumes to continue. So rural, at least comfortably, we can say should be in double digits, right?
We think so, yeah.
Yeah, okay. What about the international business? What's the sustainable revenue growth for the next 3 quarters?
The international business has grown by around 18.4%, and international business across markets has been growing at double digits for us. MENA, which is a very big percentage of our business, has grown by around 12.5%. Turkey business around 18%. Egypt has been growing at around 64%, etc. So overall 18%. So we expect a double-digit growth trajectory to continue for the full year in constant currency in international business for us. There has been currency depreciation. That's why the translated growth in India has been low. But double-digit constant currency growth on back of market share increases in consolidating our business in all our international markets will continue going forward.
Right. Mohit, hi. So just 2 points. One, have you taken price? You indicated last time some 2-3% price increases. Have increases come through in the quarter?
See, we've taken around 2% price increases in the quarter. Major price increases are flow through from our previous quarters to this quarter. If you look at the overall price increases are to the tune of around 5 to 6% in our healthcare, around 1% in our home and personal care, and no price increases in our beverage portfolio. So that's the way the price increases have been. Inflation is coming down. Overall, we've seen deflation in the quarter of around 2% or deflation. But as the food prices backed by fruits, vegetables, cereals inching up, the food inflation is high in the country. So we might take some price increases in our foods portfolio going forward here.
Mr. Malhotra, since you mentioned beverages, I have to ask you this, right? Because the quarter also saw lots of noise around what can be called 100% real juice and what can't be, the FSSAI ruling. What has been Dabur's approach? Did you undertake any new branding or rebranding exercise? And did that have any impact on demand, on the sales?
Not at all. I think as of now, there's nothing. And whatever happens will be happening for the entire industry. So I think Dabur will not be an exception to whatever is happening in the industry. But we have made representations to FSSAI, and scientific board of FSSAI is actually evaluating on what the industry has to say. So CII FICCI, and we are a part of it, and we've represented to them, and they shall come back to us on the labeling requirements for the juices, yes. But we are 100% juice, so therefore representations have actually gone to them.
Last quarter, you had gained about a 20 basis points market share in oral care. What's the market share in the current quarter? Because one of your peers, Colgate, reported some very strong numbers.
Yeah. So I think our numbers in the oral care category, we've gained around 15 basis point market share in oral care. The herbal category continues to grow ahead of the non-herbal category, and herbal category is now around 31% of the overall market, and we are market leaders in the herbal category. We're growing the category as leaders ourselves, and the Red Toothpaste, which is our flagship brand, continues to do very well and gain market shares. Our growth in oral care has been to the tune of around 12.2% in secondary terms and 11% in primary terms, mainly driven by, again, volume surges of around 8% there. Yeah.
Okay, and final question on margins, Mr. Malhotra, you're very close to 20%, and you're saying that raw material inflation has actually come off. You're looking at some more select price hikes as well. So is 20% plus, is that a territory that you think you will be in for the rest of the year?
Again, guidance is difficult for us to give. We've increased our gross margin on back of deflation and some price increases that we have taken. Apart from the gross margin increase, we've invested in media. Our media has grown by around 15%, which is double of our top line growth of 7%. So we'll continue to invest behind media. And whatever balance, Samriddhi benefit and cost optimization that we do during the course of the year will flow into our operating margin. So it will definitely be better than last year, but I can't really tell you how much to what level it is. 19.6 is what we registered. So I don't know to what extent it will be great. Giving you guidance is actually difficult at this stage. But
Mohit,
we
thank
will
you.
definitely maintain or be better in margins, yes.
Okay, so double-digit volume growth, high single-digit volume growth, and will maintain or do better on the margin front. Thank you very much, Mohit, for joining in. We'll get into a break. On the other side, we'll invite Karthik Kumar from Axis Mutual Fund. Stay tuned.
What a great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube. Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters.
Okay, welcome back. You got the market, which is, I don't want to say momentum flagging, but it's not building on after taking out the 25,000 mark. So just under it, 24,982. Broader markets much weaker, as has been the case. Mid-cap and small-cap indices are both down 1% each. Karthik Kumar is fund manager at Axis Mutual Fund. Karthik, good to have you with us here on the program as always. Since you run a quant fund, could you give us a sense of how you are looking at the market structure, underlying momentum, relative strength, etc. Is it in the near term? Is it looking as strong? Momentum elsewhere around the world has been intermittently flagging, except here.
Firstly, thanks for having me. In terms of the market itself, while the risk appetite has been pretty good, as is evident from the fact that market's been able to digest a bit of negative information over the last couple of months, be it from politics to change in LTCG and SCG and so on and so forth. But what you see is the risk appetite is still there. One is you can see it from the flows, strength of the flows. The other is if you look at the performance of the bucket of most volatile stocks, that bucket of volatile stocks still continue to do well. So clearly we are not in a risk of mode by any means. But what we are seeing is there is a change in the underlying structure if you scratch the surface. Earlier, if you go back 3 to 4 months back, from a style perspective, the markets were driven by valuations followed by growth and momentum very closely. But now over the last 2-3 months, what you're seeing is quality has taken the lead. It has come back after some time in wilderness, and quality and valuations together are doing well. That is also evident from the fact that some sectors, the sectors that have done well over the last couple of months, be it staples, healthcare, IT, pharma, all of them more representative of like the quality basket. That's one way of looking at it. The other way of looking at it is markets looking at laggards now. Participants are looking at laggards now. Whether you define laggards in one of the two ways, one is that it's lagged from a price return standpoint over, let's say, 1 to 2 year horizon, or you look at it as a laggard / valuation reversion theme where some of the sectors that have lagged are at a valuation discount to the markets are also kind of catching up there. So that's what I see from a trend perspective, from an underlying style perspective, and that presents fair bit of opportunities from a positioning standpoint.
But, IT, pharma, staples, you'd rather describe them as defensive or quality? Because when you assign them the quality label, it automatically means the other stuff is not high quality. And also, secondly, Karthik, that was just in jest, but actually, you may want to answer it if you want to. Second is, as you go higher, as you keep going higher, in every market it happens, right? The quality of new ideas keeps coming down because at the end of the day, there's only so many high quality ideas that one can come up with. But if money is coming in and you've got to put in money, you are hard pressed for ideas. So you start to look at things which you normally would not do. So does that kind of make sense to the last point that you made, which is laggards, which are starting to pick up? Go on.
Firstly, you're absolutely spot on in the sense that with quality, even the basket of quality, the nature of the quality basket has changed over the last 4-5 years. Previously, they would be dominated by these sectors for a lot of fundamental reasons that we could have gone in detail had we had the luxury of time. But over the last 4-5 years, what we've seen is the quality basket itself has diversified to include a lot of these cyclical sectors as well. I also refer to some of these sectors more from a popular view standpoint, where these sectors are normally associated with quality. With regards to your point on the fact that as markets start rallying, as markets start going up, finding quality ideas become difficult. While that is true, what we've seen in our markets is that the market was broad-based even from the start. So it was never concentrated in the top 10 or the top 15 stocks, whereas which was very unlike the West, and it was quite broad-based. So the breadth of the market has been working for quite some time. So I look at laggards more from a valuation reversion standpoint is how I look at it.
Getting specifics, getting to a bit specific. What about technology? You were, I think, earlier underweight on technology, but now some of the large cap IT companies have reported green shoots in their growth metrics. Would you be looking to change your assessment on tech?
I still continue to remain underweight tech. While the numbers that companies have reported are pretty much in line and they've reiterated their forecast, and that has resulted in the earnings environment for the IT companies in general, earlier the earnings revisions were quite negative, and that pace of revisions has come off materially. So that space has improved, but still the earnings environment over the next 2 years hasn't flipped to positive. So I still continue to remain quite selective within IT, and I continue to remain underweight the space as a whole.
Okay, so underweight IT. What about some of the other sectors? Let's look at auto, for instance, or anything else through which you would play manufacturing. What would the picks be?
I've been overweight autos, auto ancillaries. I've been overweight the entire power theme through different sectors. Obviously, the power theme can be played across sectors, and so I've had exposure to power theme through different sectors and subsectors. So those are the two ways we are playing manufacturing. But apart from that, I'm also overweight pharma, and I'm overweight staples as well. Selectively within staples. But staples is more a function of stock selection rather than sector allocation call.
What about QSRs? They've been laggards. Are you expecting any sort of a mean reversion here?
QSR, I still don't see it as a mean reversion candidate because the earnings environment still continues to remain tough. The results that have come in so far have also been lukewarm as well. So I think with QSR, we continue to remain bearish on that space.
Specialty chemicals?
Specialty chemicals, I've had increase in that I've increased allocation to that sector, through stock specific bets there. Less of a sector bet. That and staples are less of a sector bet, but more of a stock specific allocation.
By the way, I just want to sort of just to pull back, Karthik, to go back to that laggard point. Is this? Do you find more and more looking at opportunities where it's all relative? I mean, you're not looking at absolute ideas, but you're basically, as you yourself said, right? You're looking at some of these mean reversion ideas. If something is trading at this, why shouldn't this trade higher? I don't know how. Is that it works absolutely, but. What would you make of it? And do you find yourself doing that? I mean, all of us do, I guess.
See, all of us do, because at the end of the day, for us, the market is the opportunity cost, and when our options are limited to what we see within the market. So if we do see sizable differences in valuation spectrum, then we all are bound to take advantage of it. But that on its own will not work. Just because a stock or a sector trades at a valuation discount to its historical valuations, or for that matter, its peer valuations or other sector valuations, that alone is not the reason for it to work. You need to have other drivers. It could be through better cash flows, or it could be through better earnings expectations, or there could be other near-term kickers in there that will cause that reversion play to kind of kick on. But that on its own is not the only condition you would look at.
Well, we'll leave it there, Karthik, for today. Thank you very much for your time. Appreciate it very much here on CNBC TV 18. Well, that's a quick conversation with Karthik of Kotak Mutual Fund with perspectives. Sudarshan is here, our colleague, with what the July sales overall is looking like. What's the takeaway? Sudarshan, take it away.
So it was largely a muted month for the auto companies, with majority of the companies reporting sales below estimates or were largely in line. So we'll start with Bajaj Auto. Amongst all the companies, it's the one company which has reported numbers that were largely in line. So total sales were at 3.54 lakh units versus Nomura's estimate of 3.50 lakh units, and the sales were up 11%, and two-wheeler sales were up 11% as well. Exports have seen a minor growth of 2%. Speaking to CNBC TV18, company says it expects sales momentum to continue going forward, and overall growth in exports is going to be steady but in small steps. Next is M&M. Again, here also it was a mixed set of numbers. Auto segment has missed estimates, while tractor segment has reported numbers that were higher. Total auto sales were up 0.5%, while tractor segment sales were up 8% year-on-year. Company says upcoming festive season is looking very promising for the tractor industry. Next is Escorts Kubota. Total sales have seen a minor growth of 3.6%, and like M&M, it also expects rural demand to improve during the festive season. Next is Tata Motors. Overall sales were below estimates, dragged by CV segment. CV segment has seen a fall of 18% year-on-year, and total sales were down 11%, and EV sales also have seen a fall this time, and it has fallen 21% year-on-year. Last is Ashok Leyland. Again, it has missed estimates as M&CV sales have seen a drop. Total sales were at 13,928 units versus Nomura's estimate of 15,000 units, and it was down 8%, and M&HCV sales were down 12%, 8,440 units. So overall sales for the month of July were largely muted for the majority of the auto companies.
Thank you very much for that. We will slip into a very short break. On the other side, we'll get a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls from our technical experts.
Welcome back. Well, keep an eye out on Zomato. Those numbers are just hitting the exchanges and they look quite good actually. Explains why the stock has moved to the high point of the day. The EBITDA number for the quarter has come in at around 177 crores. That compares with an EBITDA loss. Even on the revenue front, that's seen a massive growth of more than 70%, coming at around 4,200 crores. Or I think most of the street were anticipating a number south of 4,000 crores. So that in itself is a beat. And that explains why the stock has moved up. Keep in mind, it's already rallied considerably. But for the time being, prima facie, the numbers that we have, well, they look good. And that's why we're seeing a bit of an uptake. But to get further analysis, Mangalam will be joining in just a bit to give us the fine print. But for starters, these numbers look good. Well, good time then to find out what's going on in dealing room. By the time Mangalam, fixes those numbers, Nimesh joins us to tell us about today's session. Well, Nimesh, finally 25,000 came.
Finally 25 came,
but
yes.
we couldn't hold about those levels.
And that's going to be some technical reasons as well. So nothing, much to read into it. Honestly, a bit of profit booking is par for the course. But again, the bigger thing is that there is buying interest. And this rally is led by institutional buying, especially the DI buying. So that seems to be the trend today as well. In fact, today the ratio seems to be quite, in the favor of the buy side. So the ratio is almost 4:1. So there are 4 buys and 1 sell. That's the kind of ratio which has been shared to me in the morning. In fact, there is a small MOC buy as well at a leading FI desk. So looks like some bit of buying will come in the last 30 minutes of trade. The only explanation that I got for a bit of underperformance in the broader market today seems to be largely technical in nature. We all know that the circular had come, right? That 1,000 stocks will be out of the funding list in a phased manner. Yeah. Today is the first phase where the 30% haircut will be removed, right? So that explains that there is a bit of pressure in the broader market stocks, purely technical in nature, and that's the reason why that index is also down nearly 1%, and also that explains a bit of underperformance in the broader market. Selectively, there is a bit of buying back in the PSU names, again a bit of interest from the domestic mutual fund. So broadly, it looks like there is enough cushion from the domestic mutual funds who are absorbing the FI sell flows. And again, as I said, the mid-cap underperformance seems to be purely technical in nature.
To sum up whatever you said, Nimesh, it looks like it's more positive than negative. So that's good news. But you're talking about some PSUs. I think one of them wants to raise some money as well. Tell us the stocks you're tracking.
Right. So in terms of individual names, the first stock on my list is Entro Healthcare, a recent listing. That stock is buzzing in trade, good volumes as well, up 5% last I checked. The street is anticipating now a large acquisition from the company very soon. That's the corporate development on which potentially the stock has been buzzing in trade today. So that's the first name. The second stock is PNB. Within the bank, PSU banks, this is one stock. Post earnings have done well, been reacting to positive numbers as well. Now the buzz is that maybe the bank is very close to raising money via QIP very soon. So that's the second name. The third stock is NBCC. Again, been a big mover of late. But again, there is a lot of traction from larger HNIs, seems to be quite active as well. And again, from a flow perspective, I understand some domestic mutual funds are quite active buyers in NBCC of late. And the last couple of stocks, cash stocks, where there is a selling pressure, which is CDSL and PB Fintech. Both are under pressure today, largely on back of sell flows at FID. So expect high delivery volumes. And there is delivery selling in both these names today.
Okay, thank you very much for that. But the stock of the moment right now is Zomato on the back of the Q1 numbers. There's a big profit of about 250 crore and a sharp jump in the company's revenues to 74% increase. Mangalam joins in with the highlights. Mangalam.
Well, that's the beauty of operating leverage, right? When the company turned profitable for the first time, same time last quarter, they turned in a profit of 2 crore rupees, and in 4 quarters, the numbers actually swelled all the way up to 254 crore rupees. What is this led by? This is led by improved operational performance in their food business, reduction of losses in the quick commerce business with massive growth coming out there as well. So if you just look at all the numbers that are reported, 74% growth in their overall revenue, close to 4,200 crores. The EBITDA from a loss of 48 crores has turned into 177 crores in terms of EBITDA. Margins at close to 4.2%. Net profit at 253 crores versus 2 crores. Remember, Zomato, by virtue of the near 12,000 crore cash that it has on its books, also generates a fair amount of other income. And this time around, the other income has come at around 236 crores versus 181 crores. Now, onto the segments. Food delivery has continued to grow 41%. We were awaiting about 20% GOV growth, but the net revenue of the food business has grown 41% and the EBIT has grown 73%. Margins in the food business improved from 13.5% all the way up to 16.5%. Quick commerce, that has actually, excited the street the most out there. Revenue growth has been 150%. The street was hoping for more than 100% GOV growth out there. So net revenue growth of 145%, the street really likes. And look at the operational improvement out there. Same time last quarter, they had an EBIT loss of 105 crores. Now that's turned EBIT positive to the tune of 43 crores. In the previous quarter, that's Q4, they made an EBIT positive growth of close to around 2 odd crores. That itself has surged all the way up to 43 crores, and that's something that the street likes. Hyperpure as well, while it still continues to be loss-making, the revenue growth is something that is exciting. A 96% jump out there from 617 crores to 1212 crores. Net-net, all levers for Zomato firing. Good growth in their food delivery business with operational performance improvement. Massive growth in quick commerce with reduction of losses and possible EBITDA positivity as well. And good growth continues for Hyperpure. All in all, 2 thumbs up for Zomato's numbers.
Okay, can't fault these numbers for anything, can we?
This calls for a delivery.
Actually, Swiggy in my lunch, but never mind. That's a really great number from Zomato. Mangalam, thank you very much for that. TVS Motors, the monthly sales numbers are coming through. 3.5 is what they have done. 9% higher. Seems to be slightly higher than some of the estimates that we had on the street. That's Zomato. Let's get TVS Motors, the other stock up, which is also reacting quite well to those monthly sales numbers. So some good news coming in on a couple of these stocks. Mitesh is joining in. Mitesh, while we talk, the final calls, just throw in a word on Zomato as well, because fundamentally the news has just gotten consistently better. The stock has also had a great run. What's the view now?
Yeah. See, Zomato, I think, continues to make new highs, and that is a very positive chart setup. Now the previous high was around 229, and today is trading above that. I think this can be trading by with a stop at 226, and 250 should be the next target area over here. And on my stock side, Ultratech Cement, I think that's a BTST. Ultratech Cement is closing at the day's high. So buy here with a stop at 11,900 for targets of 12,200 plus. And Shriram Finance is a BTST with a stop at 2970 for targets of 3040.
Okay, thank you very much for that. Ambrish Baliga is now joining us on the show for the last 12-13 minutes of trade. Ambrish, first, Zomato, would you recommend a buy at these levels?
Yeah, I mean, especially after the sort of numbers which have come, I think one can still look at buying, although the stock has moved up quite sharply. Clearly that a platform fee also which they had introduced, they've increased that now to 6. I think that has also contributed to a certain extent in these earnings. And clearly, the sort of EBITDA roadmap which they had set out to achieve, I think that's clearly being achieved. So I think we should see levels of about 270, 280 possibly in the next 4 to 6 months.
Okay, all right. Got that, Ambrish. Just want to focus on a couple of mid-cap IT earnings that came in. We didn't speak about them. So many of earnings have come. But today's real disaster has been Sonata. Sonata is nursing losses to the tune of almost 9 to 10%. Margins, compressed very sharply. I think about a 300 basis points margin compression is what the company reported. Though there was top-line growth, and the stock is really on a roller coaster. Some of the other numbers as well. Sasken was a little flat. OnMobile Global had a tough quarter. I think there was a loss over there. So some of these, tech companies, tier 2, tier 3 tech companies, not had a great reporting over the last 24 hours. Amrish, any thoughts? I don't know if you look at them. Sonata, if you do, big disappointment over there.
Right. That's true. I think it's a big disappointment. And I suppose across some of the mid-cap IT names, I think we will see that amount of disappointment even going ahead with the numbers which are remaining. I think it's still time to pick up the large cap IT stocks. Even a stock like Infosys, although there was this adverse news, I think that's an option to buy these at slightly lower levels. Because clearly in IT overall, we are seeing some green shoots. And I think the large caps will be the first ones to benefit out of that. So still on my buy list is Infosys, TCS, as well as Wipro, where we had seen some disappointment, but I think even Wipro at these levels can be bought.
Okay. By the way, the Nifty is also moved up, not to the high point, because the high on today is 25,078. So one is still about 60 points away, 55 points away from the high, which was right, of course, at the word go this morning. But definitely a big improvement over the absolutely lackluster kind of session we were having when we started. When we started, it was absolutely flat on the Nifty. Look at the Bank Nifty as well, if we can, before we go into a break. The banks have nothing, no help from Nifty Bank, absolutely flat. and mid caps and small caps are the other places. There is a small recovery, 20 basis point recovery on the mid cap index, and something similar for the small cap index as well in the last 10 minutes, 20 minutes or so of trade. Take a break. We'll come back. Ambrish, of course, is still with us. We'll ask him for his pick and some more stock ideas. Stay tuned.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000.
Welcome back. Markets are moving back towards the high point of the day. HDFC Bank, that one's coming for a big spike as we speak, and that's the big boy that's taking the markets higher. But in fact, the other big boy, ITC, will be reporting its numbers post-market hours. Manglam joins us to help us out with the key expectations. Manglam?
Well, in the month of July, ITC had a good run, up almost 16% because there was no tax hike in the budget coming in, improvement in rural outlook and valuation support. All of that took the stock higher. So now what is it that the street is expecting this time around? Let's put it down to numbers. 2 to 3% volume growth in the cigarette business, 7 to 8% in FMCG revenue, 8 to 9% increase in hotel business, which would be a bit of a slowdown given the weakness in seasonality in the sector. Agri revenues 0 to 2% flattish out there, whereas the paper business would be negative in terms of a top line performance, largely because of sectoral weakness itself. So club all of that together on an overall basis, you expect around 5.5% growth in the standalone revenue of ITC, 16,700 crore on the top line. EBITDA grows about 2.5%. You're looking at margins around 38.5% odd, and that would result into a net profit growth of about 4%. The number you're looking at 5,100 crores. The company obviously does not give any cigarette volume growth guidance, but any uptick out there is something that the street would like. And apart from that, the improvement in FMCG margins is something that we'll keep an eye out on in particular.
Okay, all right. Thanks a lot for that, Manglam. We'll keep an eye out on ITC. Big recovery in the last 45 days or so, from 420 to around 490 rupees. But let's go back to Amrish. Amrish, let's keep ITC aside. You normally give us one pick that you're looking at. Which one is it this time around?
Nigel, my pick is APL Apollo, which is the largest structural tube manufacturer in India with a market share of about 50%. Globally, in fact, they have the widest range. And the company has consistently expanded its capacity. I mean, if you go back to 2006, it was 53,000 tons per annum, and now it's about 4 million tons. I mean, they've grown through organic and inorganic route. And currently, again, they're expanding this capacity to about 5 million tons by end of FY25. I think it's an attractive bet as structural steel tube consumption has been increasing because of its use in residential and commercial buildings, hospitals, educational complexes, warehouses. And as far as airport construction is concerned, they have a 70% market share. And now I think railway station redevelopment, I think that's a huge opportunity going ahead. If you look at the Q4 numbers, they were a bit disappointing, but with the expected capacity like ramp up in the Raipur and the Dubai facilities, I think the Q1 margins should see a decent uptick and could actually surprise the street. So looking at FY26 EPS of about 50, my target is about 2,000.
Okay. All right. So that's APL Apollo. By the way, some of the PSUs are closing with a flourish today. Power Grid, Coal India, ONGC, a lot of these stocks on the upside. I know, Amrish, you've been, cautioning on PSUs given the huge rally, but is there anything you like, maybe the larger names, anything that you would still buy?
I would surely buy into the power stocks like NTPC. That's still on my buy list. Although we have seen a decent move, but still from here, I see a level of about 480 to 490, possibly over the next 6 to 8 months.
Okay, got that. By the way, out of the results which are coming through, Amrish, anything caught your eye today, yesterday? Flurry of earnings, and many times, especially the smaller ones, you get a reaction a day or two later. Take Zaggle as an example. Big move today. Earnings came a couple of days back. We had the management a couple of days back with us, but 8% higher today.
I don't track that stock very closely, but the stocks which we just discussed, the IT mid-cap, I think that's where possibly we could see even further disappointments. The one which came today, Sonata, I think that was a disappointment to a large extent. So mid-cap IT, I would be going a bit slow. Like I said, I would prefer to possibly concentrate on the large cap ones.
We had Mr. Sanjeev Goenka with us, and his group companies are all buzzing once again. Big numbers, though, and why not, right? It's not a broker which is putting out estimates. This is the promoter of the company. Philips Carbon Black, CESC. You like anything in that space? I'm not asking about the IT company because you already said disappointments there. The other two.
Among those two, I would surely prefer CESC, which again I've been recommending all through. Right from the 90 levels, I've been recommending CESC, and every time I've increased the target. And even now, I would say, a stock like this can easily see levels of about 200, 210.
Adani Energy is a big one today. Big mover, 11% gain on pretty large volumes. Amrish, anything here? They came out with the numbers. There is that QIP fundraise too.
You're talking about Adani?
Adani Energy, yes.
Yeah. Because of fundraise they've done, and I think they've done at extremely decent levels despite the discount. Looking at that fundraise and the performance, I think we should see better levels from here. I'll not be surprised if we see levels closer to about 1450, 1475.
Okay, all right, Amrish, we'll leave it on that note. Getting down to the close now, and let's see if the adjusted close can indeed be above 25,000. That's where there was a bit of a fight, but for what it's worth, the milestone was crossed today. A lot of PSU stocks leading from the front: Power Grid, Coal India, ONGC, NTPC, HDFC Bank out with a charge, really outperforming the rest of the bank Nifty because it was just HDFC, a lone ranger. A lot of other banking names like Kotak Mahindra Bank, SBI, etc., they've all had a negative session, but HDFC really was standing tall. It had company in the form of Reliance, the other one that managed to pull its weight to keep the Nifty above 25,000. Other gainers of the day included the likes of Adani Enterprises, Tata Consumer, Shriram Finance, and Maruti Suzuki. Speaking of Maruti Suzuki, some of the other auto stocks have had a lot of profit taking today. M&M, Hero, Moto, as well as Tata Motors, all these stocks down between 1 and 3%.
Well, the mid-cap index ends with a cut of about 500 points, so 0.8% lower at the index level. On the way up, Zomato deserves mention, came out with numbers, a big profit number of 250 crore. The stock spikes up 3.7%. Other notable gainers include CESC, even FirstSource. So the entire RP Sanjeev Goenka group was higher. FirstSource ending with a gain of about 10%. Philips Carbon Black or PCBL also up nearly 7%. And this month itself, PCBL is up nearly 37%. Oil India, Adani Energy are some more which catch your attention.
Absolutely. A lot of action, but more down than up in the broader markets, as you said. It's a wrap on this edition of Closing Bell from all of us here. Goodbye. Thank you for staying with us. Markets Forward picks up on all the action in just a bit. Stay with us.
10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18, weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
The Nifty conquers the 25,000 mark, closing at record highs for the 5th straight day. Mid-caps see a sharp intraday fall. Banks underperform in trade.
Tata Steel delivers in the first quarter, but the stock falls as the street fears tax liabilities from states. But Coal India gains nearly 3% after a good first quarter show.
Infosys refutes claims of GST evasion by the central and state GST authorities, says pre-show cause notice of 32,000 crore rupees is untenable as expenses were incurred by the company in the overseas branch offices.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day, as well as, of course, all the action. There was plenty of it today. I'm Surbhi Upadhyay. As always, with me on the show is Nigel D'Souza. Nigel, 25,000 finally.
Well, finally, it was there for the taking. Well, in the next 20 minutes or so, we'll tell you all the key corporate developments. We'll get you all the top corporate voices as well, and all the events to track moving ahead as well. But let's kickstart the day with the market action then. It's going to be in today's trading session. The knockout punch was there because the Fed didn't disappoint, and that's why the Nifty in the first tick itself, we went ahead and we took out that 25,000 mark. So that was good news because the global cues were supportive. PSU power-related stocks, well, they outperformed in today's trading session. The top gainers on the Nifty were Power Grid as well as Coal India, and we'll tell you about Coal India in just a bit. The Nifty Bank underperformed DS, but in the final hour of trade, if you pull up the intraday chart of the Nifty or even HDFC Bank came to life in the final hour of trade, which explains why the Nifty Bank, yes, it was a relative underperformer, but it did much better because of the strong close that we had on HDFC Bank. Metal stocks, they started off well in the green. The problem was there is this Supreme Court verdict that is pending, and the street fears that maybe states will go ahead and increase taxes. If that's the case, these metal stocks will be under pressure. That's why if you look at the intraday chart, metal stocks started off well in the green because they believe that the Fed is going to go ahead and cut rates, which is good for metals. But otherwise, from the top, you had all these stocks that came off closer around 2% or thereabouts. After the first hour, we did see some selling, Surbhi.
Absolutely. And then, of course, besides this, we had a lot of individual earnings that the market was reacting to, which we will talk about. But at a headline level, I mean, the good news is that 25,000 is in the bag. And there was some profit taking throughout the session. So the moment we hit that in opening trade, after that, there was profit taking throughout. And it was actually in sync with how Asia was trading, because while Wall Street had a great finish thanks to the Fed moves, Asia, particularly some of the markets like the Japanese markets, were under pressure. Europe was under pressure while we were trading as well. So, comparatively, this is not a bad close at all, with a gain of about 0.25% on the Nifty. Apart from banks, which weren't looking too good, IT and auto stocks were also slightly weak. Auto in particular, stocks like M&M losing quite some ground. Nigel mentioned HDFC Bank. What a star. And it had company in the form of Reliance Industries to take the market on the green side finally by the closing bell. The problem today was the mid-cap space. There was continued underperformance throughout the day. That index was down between 0.75% to almost 1%. And the market breadth was negative. The advanced decline ratio was negative throughout the session. So that was a bit of an issue. But maybe you can just attribute it to some profit-taking, considering we are at these lofty levels. So that's the market. Let's tell you what the lineup is like today. All the movers and shakers coming up with Vivek in just a bit. The sector of the day is mining, as Nigel has been telling you, and we'll tell you why. Of course, also get into the numbers that Tata Steel and Coal India have posted. Vedanta has also been in focus today. Then, of course, we'll talk about all the key events to watch out for tomorrow. But starting it off with the movers and shakers with Vivek.
Thank you so much for that. 25,000 was on the Nifty, quite a few gainers. First up, we are starting off with Power Grid. Top gainer in the Nifty this particular week has been very good for the company. After the results, the company increased capex capitalization guidance, and the street continues to like that. The second stock on the radar was Coal India. Again, the second most or the second best performer as far as the Nifty was concerned, almost 3.5% higher after a strong Q1. And now coming to the broader end of the markets, look at a name like Aster DM Healthcare. Came out with its results yesterday, good set of numbers. After that, today, strong volumes, higher by almost 6%. And then two stocks, from the Goenka Group companies. The first one is First Source Solutions. The company declared its results a couple of days ago. Company raised the revenue growth outlook and the guidance stock higher by 10% today almost. And the second stock was Philips Carbon Black, that is PCBL. Today, it continued its stellar rally amongst the top gainers as far as the NSE 500 was concerned. And this particular week itself, this particular stock has gained over 12%. On the other hand, today you actually saw a bit of selling pressure emerge as far as the auto index was concerned. And quite a few auto stocks lost ground, actually after seeing an initial bit of green. So M&M, Hero Motor, Tata Motors, Ashok Leyland, all of them for varied reasons actually saw quite a bit of selling pressure emerge. The other stock on the radar from the broader end of the market was Aegis Logistics. Even yesterday, after a weak set of results, the stock fell quite a bit, and today down by another 8%. And the last stock, of course, was Birlasoft. Amongst the top laggards as far as the FNO space was concerned, weak set of results. Street also is wondering about whether they would be able to go ahead and achieve the targets that set for FY25. Today down almost 4.5% after yesterday's weakness.
Okay, all right. Thanks a lot for that, Vivek. Well, let's welcome our guest on the show then, Amrish Paliga, as well as we have Prabhudas Leeladhar, senior analyst, Shilpa Raut, who joins us on the show. Hi, Shilpa. Hi, Amrish. Thanks a lot for joining in. Shilpa, you go first. What do you make of today's trading action? It seems we've got the 25,000 in the bag, but where do we go from here?
Definitely, we have hit that mark, but as you can see, the trade setup, we are in a very very narrow range on a daily to daily basis. Where there's limited upside, and of course there's also limited downside. We're not falling, but definitely that upside move that we've been getting used to. That upside rally surge instantly of 100 or 200 points for Nifty is particularly not happening. So which means that Nifty is showing some sort of exhaustion here. So from here, I believe you are positive, but cautiously positive is the right term that we are supposed to use. And as far as Bank Nifty goes, Bank Nifty, till it is not reading above 52,300, we are not expecting any sort of fireworks here either. So probably this consolidation phase to, little bit of time correction is going to happen where, little lower levels for Nifty around 23,700 can happen as well on the downside. And Bank Nifty in that matter can test 50,500. From there, probably again, a new surge can happen for new highs.
Got it. All right. Thanks for that, Shilpa. Well, Amrish, I'm going to come across to you because mining was the sector of the day. And as I said, the metal index itself, started off well in the green because of the positive global cues, but they came off the high point of the day. First up, let's run you through with regard to the couple of stocks that we're looking at. Tata Steel, the stock started off in the green because the results were better than expected. So, the EBITDA number as well as the margins were better than what our poll threw up. Point number two, if you look at the India business, well, the EBITDA number came in at around 13,700. That was in line. The European business, actually, the losses were lower than expected because the Netherlands business had turned around over there. They had a blast furnace shutdown, which now turned around. So that was positive as well. The problem, though, is that in spite of having good operational numbers, the debt in the books is moving up. The capex in the books, in fact, they've incurred in the first quarter is around 3,800 crores approximately. So that's point number one. The bigger problem is the Supreme Court verdict is pending and the arguments have been made. Now, the management has gone ahead and they've said they're taking a contingent liability. They've been doing it for the last few years. So from around that 16,500 odd, now they have marked out that contingent liability of more than 17,000 crores if, in fact, a higher tax is levied by states retrospectively. So that's the problem, and that's what weighed on the stock. Intraday, the stock did come off the high point of the day. I spoke to the management and they said that they believe that Chinese steel prices are bottoming out now because all those Chinese miners, they're making nearly $40 to $50 of losses. The other point they made was that there'll be volume growth this year because Kalinganagar will come on stream and that will add some volumes out there. UK business, the EBITDA per ton will improve both in India as well as in UK in the second half of the year. And the net debt number will be more or less flattish for the year. I went on to ask them that you made 17,000 crores as a contingent liability on a retrospective basis if it is implied. But going ahead, what if it is implied, if there is a higher state tax that's levied, then they said the hit would be close to under 1,500 crores on a per annum basis. So that's one of the big losers today, Tata Steel. On the positive side, though, you had Coal India. That did well. The numbers were very good. You can't compare it with our poll because they've changed the way they account for the stripping ratio. But that stock ended with solid gains, 3.5% on. Top line was strong, with regard to the volumes. The EBITDA number, well, we did see a bit of a decline, but that's par for the course. Why do these numbers look good? The employee cost was lower by 5% on a year-on-year basis. The street liked that. And the stripping activity, they changed the way they account for it. So there was a credit over there this year as well as for the last year. The blended realization was pat in line at around 1,670 rupees. So you had the two big stocks, the winner, Coal India, and the loser, Tata Steel. Amrish, you heard what I had to say. Tata Steel was a little bit nervous. You like any of these counters or would you stay away?
No, in fact, I like both the counters because this time if you look at Tata Steel, Netherlands business, I think was a bright spot. UK performance, I think, should improve going ahead. I think the only issue is the Supreme Court verdict. But anyway, they have already provided for most of it. So I'll not be too worried. The downside I see for Tata Steel could be about 150, 154 levels. But then, the upside can be as high as about 200 to 220 levels. So at lower levels, I'll be a buyer in Tata Steel. And when you talk of Coal India, I think the good days are still there and going ahead should be better because if you look at India overall, I mean, we had the highest ever coal production in FY24. If you look at Q1 FY25, that's about 10% better. So Coal India also should be performing, better than this overall, because that's the leader, going ahead. And if you look at what's helped them, it was a single window clearance portal for the coal sector. That's helped, improve, the production. And at the same time, as far as India overall is concerned, captive coal mines were encouraged to sell about 50% of their annual production in open market. That's helped to a very large extent. So I think overall, if you're talking of the coal sector, I'm quite bullish. And in that, the leader is Coal India. And here, in fact, I have a price target of closer to about 580-600 levels.
Okay, all right. Got that, Amrish. Thanks for the take. Let's focus on some more stocks that came out with earnings. And we had a very sharp reaction coming in on Zomato. Numbers came in the afternoon, and it seems the profits are only getting better. Manglam has the details. Manglam, tell us more.
Well, it was good performance overall coming in from Zomato. If you just take a look at the revenue, that grew by about 74%, much ahead of street expectations at 4,206 crores. Also, the margins, the operational performance. Same time last year, the company reported a net profit of about 2 crores. That was largely led by a lot of other income, but that has now turned into 253 crores because the EBITDA has come in at 177 crores. This compares with a loss of 48 crores as well. What's doing well for Zomato? The food delivery business, which is stabilizing in its growth, is now 40% higher revenue-wise, but the operating performance has improved from 13%. The margins have gone up to 16.5%. Quick commerce, which is the big growth driver, Blinkit that is, showed a revenue growth of almost 150%. And out there as well, the EBIT came in at around 43 crores. This compares with a loss of 105 crores. So out there too, the margins were 4.6%. Short point, food delivery growing well with improved performance on the operational side, and quick commerce continuing to be the growth driver. With the 12,000 crore balance sheet that they have, cash that they have on their books, what they do of that will be extremely crucial to watch out for going forward.
Okay, all right, Manglam, thank you very much for that. Let's quickly go across to Shilpa. Shilpa, Zomato's had a dream run, right? The stock itself is up some 150, 160% in the last 1 year. How do you look at it now? And also throw in a word on the metal names that Nigel was discussing earlier, Coal India as well as Tata Steel.
Definitely, Surabhi, talking about metal names, yes, Tata Steel, on any declines towards 158, should be a buyer. Keep a stop loss of 155. It can do 190, 195 very soon. Also, NMDC is looking very, very strong. It has a very strong support at 220. It can do 280 again in coming, it is a positional trade. Talking about Zomato, we saw the results coming in, and there has been a lot of buzz now that it's been very, very strong quarter for them, and stock now can move towards 255 to 260, I believe. So definitely, maybe tomorrow's trade can give more clarity whether there's a dip or not. But whatever it is, I guess the stock is trading around. Stock is heading towards 250 now.
Okay, 250 on Zomato is possible. Got that. Let's quickly move on and look at some more stocks and earnings in focus here as well. We are talking about Sun Pharma. Sun Pharma came out with numbers in the second half of the day, and the stock was a little subdued. The margin for the company came in at about 28.5%, which is actually a lot better than the estimates. The estimates were 26%. The margin also showed a year-on-year improvement. Revenue growth was in single digits, up about 6% on the year. And now this was a little below estimates. The expectation was the top line will grow 8%. It grew only about 6%. Profit was above expectations. The firm recorded US generic sales of about $461 million, and that is flat year on year. So the US business not really growing too much, flattish trends out there. Let's talk about one more stock that was in focus, and this is Infosys. Nothing to do with earnings, but a big GST issue seems to be brewing. Now, here's the story. There is a demand both at the central level and the state level in terms of the GST authorities, the Karnataka State GST Authority as well as the DGGI, which is a central level authority, on alleged non-payment of GST dues to the tune of 32,403 crores on Infosys. Just to quickly talk about what's the issue at play here. Now, the GST authorities are claiming that Infosys has not paid adequate GST in terms of the expenses incurred by its overseas branches. That's what's the heart of the matter. The company is denying it. The company is actually saying that as per a recent circular that was issued by the government itself, the overseas branches are actually not liable to pay any GST. GST cannot be levied on them. That is Infosys' own contention. And they're saying that if at all there is a GST payment, there is a credit which is available against export of services. So those are the two arguments that Infosys is making. And it's saying that we are completely compliant and there are no outstanding dues. So let's say the company is expected to respond to this pre-show cause notice, as it's called. And there was some negativity surrounding the stock on the back of that development as well. Nigel.
Okay, all right. I think on that note, though, we'll have to slip into a short break. But on the other side, we'll get you all the events that need to track for tomorrow's session. Don't go anywhere.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have a
Welcome back. Well, auto stocks were under pressure in today's trading session. Some of them came out with the auto sales numbers. Sudarshan joins in to fill us in with a quick wrap of all those sales, all that sales data. Sudarshan, over to you.
So it was a muted month for most of the companies, with majority of the companies reporting sales below estimates. So we'll start with two-wheelers. Bajaj Auto. For Bajaj Auto, sales have come in largely in line. Total sales were 3.54 lakh units against